Good morning, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous. A very busy Thursday morning for investors. Moments ago, we heard that 6.6 million Americans filed for unemployment benefits in the past week. That has brought the tally in just the past 3 weeks to more than 16 million Americans needing to file first-time unemployment claims. Also, just moments ago, we learned the Federal Reserve has unveiled details of its $2.3 trillion program to help small businesses and others in support of the overall economy. And as a result, we have stock futures rallying, Dow futures up better than 200 points right now. I want to get right to Brian Chung for this Fed news this morning. Brian, did this come as a surprise to you? And what is exactly in this $2.3 trillion program?
Yeah, well, the big announcement was really the addition of their municipal debt plans to buy more debt directly from states and local governments, in addition to expanding their existing facilities to take on some commercial mortgage-backed securities and some high-yield stuff, including collateralized loan obligations. But you're referring probably to the part where we heard about the Fed wanting to launch its Main Street lending program, in addition to trying to backstop those Paycheck Protection Program loans that the Treasury, in conjunction with U.S. banks, have been trying to disperse since last Friday. So the Federal Reserve now offering more details on that. In sum, all of these facilities would provide $2.3 trillion to the economy. That's what the Federal Reserve estimates. You had Jerome Powell issuing that statement earlier this morning saying the Fed's role is to provide as much relief and stability as we can during this period. Again, one of those things that it's doing that's relatively unprecedented is by going out there and directly buying municipal debt, not in the form of quantitative easing. This is going to be through a special purpose vehicle, which the Federal Reserve has used for its other liquidity facilities as well. The way it works is that the Fed works with the Treasury to set up a separate entity that then goes into the open market and then buys these types of securities. The Fed does the purchases, but the Treasury ultimately backstopping it with either credit protection or with equity that's provided to back up that facility. So the numbers on this are also new. So the Federal Reserve saying that it's a Main Street lending program, which it'll lend 4-year loans of a minimum of $1 million to businesses. That's actually going to be $600 billion. That's going to have $75 billion of backing from the U.S. Treasury. And then something else that's also worth mentioning is, again, the expansion of those programs that it was already doing to buy investment grade debt. They call that the primary, secondary market corporate credit facilities. That has been expanded to support $850 billion in credit. For those that are wondering, does the Fed have the authority legally to do this? The answer is yes. So they have authorities under what they call Section 13.3 of the Federal Reserve Act to provide lending when it's due. They can't necessarily buy everything directly on the balance sheet, but they were authorized about $454 billion to provide these liquidity facilities through the congressionally passed CARES Act from 2 weeks ago. Alexis?
You know, Brian, what does this mean, the fact that the Fed's now going to be taking on unprecedented amounts of high yield debt? What does it mean for the companies that hold that debt? Are they basically just kicking the can down the road for those companies, and at some point it's going to come to roost?
Well, it's important to understand the mechanics of all of this. So the Federal Reserve is buying the debt, but it's doing, again, through that special purpose vehicle, and it's taking it on as collateral through what they call their term asset-backed lending facility. Now, what that does is basically it takes on the collateral temporarily and provides cash infusions to any sort of broker dealers or banks that are holding on to those leveraged loans or to those types of securities that they can't ultimately liquidate in the market because things are dried up so much. So it's not necessarily the Fed taking on permanently these positions, but it does raise the question of, is the Federal Reserve artificially inflating a lot of these already junk-rated companies that were already troubled before the coronavirus? So this is, I guess, just another question that will kind of be part of the overarching long-term, I guess, viability of the Fed's actions now. For what it's worth, the Fed doesn't seem too concerned with worrying about that type of stigma. It's been going through these types of programs, announcing them aggressively because it wants to message to the public that monetary policy is going to do exactly whatever it can do to try to stop the bleeding from the coronavirus.
Yeah, just when we thought the Fed might be out of ammunition, they come out with this. All right, Brian Chung, thanks for breaking it down for us. And once again, folks, we are getting stunning numbers about those who are unemployed in our country. 6.6 million Americans, new folks applying for first-time unemployment benefits in just this past week alone. What does it all mean? Let's check in with Emily McCormick now. And Emily, over the past 3 weeks, stunning numbers here, right? We've topped 16 million Americans applying for benefits.
Absolutely, Alexis. And it is worth reiterating the numbers that we just got out for last week. So new unemployment claims for the week ended April 4th were a seasonally adjusted 6.606 million. That was higher than the consensus expectation for just 5.5 million. That was according to Bloomberg compiled data. So the prior week's new unemployment claims, which had already been at a record, were revised even higher to 6.867 million from the 6.648 million previously reported. That means, as you mentioned, that more than 16 million new unemployment claims have now been filed over the past 3 weeks alone. Looking at the continuing claims for the week ended March 28th, those are reported on a 1-week lag. Those jumped to a record 7.46 million. That was a jump of more than 4 million continuing claims from the prior week. Breaking down the new unemployment insurance claims by states, we have California leading by far with 925,000 claims not seasonally adjusted, although this level of new claims was down from the more than 1 million claims that had been filed initially for the prior week. I also want to highlight that Michigan, New York, Texas, and Georgia also had high numbers of new claims. Each of those states posted more than 300,000 for the most recently reported week. We did get a shorter statement from the Labor Department this week since the impacts of COVID-19 on the labor market are now a given. It said today, quote, the COVID-19 virus continues to impact the number of initial claims, and its impact is also reflected in the increasing levels of insured unemployment. So we are seeing elevated levels of new unemployment claims, continuing claims, and that's something that economists are expecting to be the case as this pandemic and the social distancing measures remain in place. Alexis?
All right, Emily McCormick, thank you. And it's important to note that this number, 6.6 million this past week, does not include all of those people who cannot get to the office to deal with their claim, cannot get on the phone, or the website keeps crashing. So there are a number of people out there who haven't even been able to put their claims in, although they want them to. So that's 6.6 million. The real number is probably even higher than that. I want to welcome Brian Belsky now to the show. He is Chief Investment Strategist at BMO Capital. Brian, thanks so much for being with us. You just heard us talking about these jobless claim numbers. Does each additional week of historic high jobless claims basically dim the prospects of a V-shaped recovery when we do come out the other side of this pandemic?
Oh, good morning. No, we don't think so. And again, the reason why the market is recovering the last couple of weeks as we've seen these employment numbers is principally because we as investors know how to handle, know how to understand, know how to deal with these economic data points. And I think the proof is going to be in the pudding with respect to how companies' earnings are looking over the next quarter or two. 0% of zero is zero. And at the end of the day, we know that the longer this shutdown continues, the more that earnings are going to be hurt. The market is a fundamental creature. And what we've been talking to investors about with respect to what this means in terms of monetary and fiscal policy is clearly that monetary and fiscal policy does not create a bottom, but it fuels the recovery. And so I think people are way too enthralled with whether or not this is a V or a W or an M or a U. Stop trying to figure it out. Stop trying to instead look at what's happening on the company level. And there's going to be some good news and there's going to be some bad news. But the market's telling you that the less negative news that we're seeing in terms of second derivative on COVID-19 coronavirus is the key factor. Monetary and fiscal policy will fuel this. Stop trying to figure out whether or not it's an L or a V, and just let the market and the companies come back and get back to business.
Brian, just crossing the wires, we had General Electric come out and warn that their first quarter earnings will be materially below their prior outlook, warned slightly on cash flow, yet the stock's up about 3% in the pre-market. What does that tell you about investor risk appetite ahead of earnings season?
Well, we went back and looked at what happened after big pullbacks and recessions of the market, whether or not it was 1990, 91, or the threat of a double dip in 94, the Asian currency crisis in the late 90s, and then, of course, 9/11 and 2008, 2009. At some point, investors like to come in and buy momentum-type turnaround situations or, quote-unquote, companies that have been having fundamental problems, i.e., like GE. There's a certain tone, quite frankly, in the investment workplace that we want to get more cyclical, meaning industrials, materials, and energy. From our lens, in terms of being an investor and a strategist, we think those are short-term trades. So again, we think when you see these types of moves, they're more trading opportunities versus an all clear, green light go in terms of a company like GE.
And Brian, what do you think about these claims peaking? At what time, what week might we see that happen? Because we know that the rules have changed and now more people are able to apply for these unemployment benefits, the self-employed and contracted employees who normally wouldn't fall into that pool. When are you expecting to see a peak in claims?
Well, I think trying to call a peak in claims is like trying to call a peak in coronavirus or a peak in the market. It's a fool's game. I think it's really going to come down to human nature in terms of getting back to work. And I think the key thing in terms of trying to call a peak, I think don't try to do that, ladies and gentlemen. Try to call and look for a second derivative less negative. When we start to see claims start to roll over, still be negative, quite frankly. That's why the market and how the market rallied in 08, 09, and how it has rallied in other types of recessions. And stop trying to call some sort of a big call on that. Just see that as companies and people start coming back to work. Remember, companies are going to front end load some of these layoffs, and that's exactly what we've seen so far. And so we actually think that we're going to start to see over the next several weeks as we hear more about certain states going back to work and the peak already happening in terms of coronavirus. We're going to see people come back to work, and we're going to start seeing less negative employment claims.
All right, Brian Belsky, Chief Investment Strategist at BMO Capital. Thanks for being with us and stay safe.
Thank you. You too.
Want to get a check of the European markets now. Lots going on there as well. The European markets have been pretty volatile this morning. Joining us with the details is Yahoo Finance's Oscar Williams-Groot from London. What's happening over there, Oscar? Good morning.
Morning, Alexis. Yes, it's been a choppy session here in Europe. Markets opened strongly higher with the FTSE 100 up as much as 2%. Investors were still focusing on hopes that we're reaching the peak in this global pandemic, but some of that optimism started to fade as the session went on. By lunchtime, we had the CAC 40 in Paris and the DAX in Germany, both in the red. However, just over the last hour or so, as we've had these US jobless numbers and this Fed announcement that has spurred US markets higher, we've seen, again, it's turned around. The DAX is now up over 1%, and the FTSE 100 is back up over 2%. So real choppy session here. I think part of that is to do with the fact we're heading into a 4-day weekend here in Europe, and there is some nervousness among investors about holding positions for that long, given the extreme uncertainty around at the moment.
And also, Oscar, I understand that the Bank of England is giving some assistance to the UK government. What are they doing exactly?
That's right. This morning, the Bank of England and Treasury announced jointly that the Ways and Means facility has been expanded. This is essentially a kind of overdraft at the Bank of England held by the Treasury, a way of getting money directly from the Bank of England, and it's quick cash. This hasn't really been used since the financial crisis, and typically it stands at about 400 million. They didn't actually say how much they were expanding it by, but to give you some idea, in 2008 alone, the facility was tapped to the tune of £19.9 billion. And I wouldn't be surprised to see a similar magnitude now, given the huge amounts of spending that have been announced. Now, quite surprisingly, the Bank of England governor, in fact, ruled out this type of intervention just as recently as this weekend, suggesting that we might not see this sort of thing. But actually, the markets have not been riled by this at all. The pound is largely unfazed by this.
All right, Oscar Williams-Groot in London. Get some rest over the long weekend, and thank you.
Thanks.
All right, we'll be right back after this short break. Quick check of the markets shows us a nice rally here on this Thursday. Dow futures up 1.5%, broader market higher by about 1%. On news, the Federal Reserve is stimulating this economy even more with a new program worth $2.3 trillion. We'll be right back. Welcome to Yahoo Finance Live. I want to get to Anjali Khemlani for the latest on the coronavirus. And Anjali, I understand the number of cases in the U.S. has now topped 430,000. Are we getting any closer to flattening the curve here?
Hey, Alexis. Yeah. So, according to the experts, we really are. Even though the numbers do continue to increase, they're supposed to start to increase at a much slower rate, as we saw in Spain and Italy. We know that right now there are more than 1.5 million cases globally, with nearly 90,000 deaths. And in the U.S., as you mentioned, 435,000 cases, with nearly 15,000 deaths. And of course, New York maintains the lead with both cases and deaths. And we're waiting to see how this week pans out, as we're expecting sort of that trade-off, right? Of the more deaths we see, the fewer hospitalizations we see. Hopefully that is playing a role in mitigating and flattening that curve there.
And Anjali, I understand there's this dispute going on between Dr. Deborah Birx during the White House task force press briefing. She was talking about how healthcare workers should or could have been tested for coronavirus, but there weren't tests or there weren't enough tests. What's going on with that?
Right. So from what I can gather, the White House has been pretty silent. I've requested multiple times for some more clarity on this, but from what I can gather, it's about the type of instrument. So we know that we heard so much news about which types of instruments have been approved for testing, which type of test. The president has talked about the Roche and the Abbott test, and then that portable test that gives results in 15 minutes from Abbott. So one of those tests, basically, one of the initial high throughput tests that was approved, is largely found in hospitals and universities. And so that is where, the point of care, that site where nurses and healthcare workers are, is where they could be tested. But from what I gather, large clinical labs are not using that same instrument. So, what we're getting tested on as the general population is actually going to those large commercial labs, which are largely using the Roche test. And so that discrepancy is partly lending itself to, why aren't we testing as much? Why can't we get as many tests through? Because the higher throughput tests are actually in these hospitals where we aren't seeing as many tests going to. And so that may be leading to the issue right now. We know that she had a call last night with labs, so hopefully we'll get some clarity later today at that press briefing.
All right, hopefully. We know you're on the case. Anjali Khemlani, thank you. There could be some possible activity in Congress before we break for the long weekend. We've got Greg Valliere, Chief U.S. Policy Strategist at AGF Investments, joining us now. Greg, always good to see you. Thanks for being here. So now we're hearing the Treasury is trying to push through an additional $250 billion in aid for small businesses. A vote is expected, I believe, in the Senate today, but we already know House Democrats are opposing this. What are the chances it gets passed?
I am not real optimistic, Alexis, about getting it done this week. First of all, the Democrats in the House and Senate want another $250 billion in addition to the $250 for small businesses. That extra $250 would go to state and local governments, hospitals, food stamps. I don't think the Republicans are ready to go there, but even if they were, there's another snag that has to be addressed, and that is in the House, there'll probably be at least one or two dissenters, which means you've got to bring back half of the House to get a quorum. This is antiquated. I mean, haven't they heard of Skype or haven't they heard of, conference calls? So my hunch is that it would require the Senate and House to come back next week to get this done. I think Mnuchin's done a great job. I think he can cut a deal, but I don't think we're going to get this money right away. And if you want to get small businesses up on their feet, they need money ASAP. This is going to take maybe another week.
Greg, we saw Chuck Schumer earlier in the week float this idea of folks getting $25,000 hazard pay. How realistic is that?
Not right now. I think you've got a lot of Republicans saying, let's just slow down and take a look at what we've already done. They did $2.2 trillion, as you know, about 10 days ago. I just think that they are worried about maybe stampeding, doing too much. And frankly, I think that Jerome Powell knew that there could be a snag this week. And I think it's one of the reasons why he unveiled this dramatic new proposal this morning.
I want to pivot here, Greg, to politics and the 2020 election. We know that Senator Bernie Sanders finally dropped out of the race yesterday, so it looks like the Dems now have their nominee in Joe Biden. And at the same time, we're seeing Trump's approval rating sliding back into the mid-40s. He did get a bit of a pop prior to that. and in most polls, Americans are not satisfied with how the administration is handling this pandemic. Would you actually call the incumbent in this election year an underdog at this point?
Not yet, Alexis, but I think the view earlier this year that Trump was the clear favorite has now diminished greatly. I think that a lot of Americans feel, especially that the aid to small businesses has been chaotic, has not been rolled out very well. I think Trump's press conferences are becoming unproductive for him. I mean, all of his self-congratulation and then picking fights with the World Health Organization and the media and governors. I think these press conferences are doing him no good. So all of a sudden, the number that has shocked me the most is that by a clear majority, the public thinks that the government isn't doing a good job. And I would say that this lead that Biden has now over Trump is not illusory. I think Biden has a chance to win.
And I mean, I know it's hard to say, and November 3rd seems like very far off at the moment, but how do you think voting is going to change this year? I mean, the physical act of voting, we've been talking about mail-in ballots. There have been instances of fraud with that. When you envision the actual act of voting, what does it look like?
Well, first of all, God willing, there'll be a great drop in new cases and we'll have a normal election. But if the virus is still persisting, there could be a mail-in, there could be other ways to vote. That's going to be totally chaotic. I think all of us in Washington dread that scenario. I think it's unlikely. One other real quick point I'd make, even if Biden does win, I don't see a big problem for the markets because I still think the Senate stays Republican. And if that happens, the Senate is the firewall that would block all sorts of radical legislation, Medicare for all, Green New Deal coming from the House. So I think as long as the Senate stays Republican, the markets could handle a Biden victory.
What needs to happen between now and November for Americans to change their opinion of President Trump?
Well, I think obviously we need to get the cases down. We need to get the economy growing. But again, I don't think Trump helps himself by boasting about what a great job he's done. And I've talked to Democrats who say that the ads this fall for the Democrats are going to just consistently hammer away on when he said we just have 15 cases going down to 1. We're going to hear that soundbite over and over again. And also when he said, I'm not responsible for the problems with the testing kits. We're going to hear that soundbite over and over again. One of many reasons why I think he is hardly a shoo-in in November.
All right, Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. Always a pleasure. Have a great weekend.
You too.
Stay with us. Much more straight ahead, including the opening bell here at Yahoo Finance. We'll be right back.
See you guys.
We have stock futures extending their gains into the open here. Let's get right to Jared Blickery for why. Jared?
Yes, we do, Alexis. And just dialing up the Wi-Fi interactive here, we're going to see that, it's failing on me. That's a human error. The stock futures surged at 8:30 a.m. So we got that terrible jobless claims number. Unfortunately for that, it was tempered by the Fed's action. It's going to be 2.3 trillion more dollars that it's allocating in potential funds and lending funds into the economy. Particularly, what caught my attention was it's going to be serving the high yield market, the so-called fallen angels, those companies that had investment grade credit and now they are sinking into junk. So that's my main focus right now. Now, the 10-year T-note yield is down about 1 basis point. And in the pre-market, we have energy, financials, and industrials leading in the market. And to the downside, we see staples and materials. So should be a nice rally day potentially, but I would note that tech is underperforming.
Should be. All right. Thanks a lot, Jared. We'll be right back with the opening bell. And Invesco's Christina Hooper to break it all down for us right after this. The Federal Reserve making more bold steps to help this economy inject more money into the markets and to also help small businesses. That has sparked a nice rally here on Wall Street. And a new day of trading underway on Wall Street ahead of a 3-day holiday weekend. We have got Christina Hooper of Invesco with us. She is their chief market strategist, and the Dow opening up 300 points. Also, this just breaking now, Treasury Secretary Steve Mnuchin on CNBC saying that it is possible that businesses will be open in May. I'm just reading this now as it's coming through. That seems hard to believe for me. But that is what he is saying, and we'll see if that adds to the positive momentum on Wall Street. I want to say good morning to Christina. Thanks so much, as always, for being with us. We've got a lot to dissect this morning. Let's start with those jobless claims, which the market seems to be discounting for the moment, Christina. 6.6 million Americans, a record number of Americans filing for unemployment benefits in this past week. What does that mean, do you think, to the recovery when we come out the other side? I put this question to another guest earlier. Are we not going to get that V-shaped recovery?
Well, I think that what we're seeing in terms of initial jobless claims indicates that health protocols are being followed. And so you can see this as a silver lining. Yes, there's an enormous increase in unemployment that is coming our way, but it's because we're following the appropriate health protocols so that we can be on the other end of this sooner, so that we have a better chance of having a V-shaped recovery.
Christina, Brian here. Does it make sense for investors to watch the coronavirus infection totals as closely as they have been the past few weeks? When you have the Fed coming out here, $2.3 trillion in loans, 0% interest rates, is that still the most important data to watch, given how much the Fed has come out here to try to help support the markets?
I think the most important data to watch is really threefold. It's got to be our statistics when it comes to new infection rates. We want to see lower growth rates in infections in the US. And that's what we've seen in recent days. And I think that's very encouraging. We're going to have to expect that economic activity is going to fall dramatically. So don't be scared by PMIs. Don't be scared by initial jobless claims, but focus on what we're getting in terms of fiscal stimulus and what we're getting in monetary stimulus. And this was a big day for the Fed.
And then, Christina, on that point, then, as we start to get some of this bad data, which I'm already thinking the April employment report could be pretty dour, do you buy stocks into those bad prints?
Well, what we've learned historically is that when the Fed is supportive, particularly when we see the kind of massive asset purchases that we saw during the global financial crisis, that caused support and actually it caused stocks to rally. And so we can hope to expect a somewhat similar scenario. So I would discourage any kind of deviation from long-term asset allocations, but for tactical allocations, this could be a time to begin buying. I would suggest that we're going to see volatility going forward. This is not going to be a straight line up for the stock market. In fact, stocks are going to be buffeted by news about health statistics and fiscal policy and monetary policy. But this could be a time to initiate opportunistic buys that are dollar cost averaged into.
You know, Christina, the last time we spoke, you were talking about liking the Chinese stock market and seeing opportunities there. Do you still feel that way? And also, if you go into the broader emerging markets, many of them are now, those countries are now going to the World Health Organization saying, we need more money to help fight this pandemic. Is that the place to be right now in these other emerging markets?
Well, I'm still positive on China, but I do believe we need to be cautious and selective when it comes to emerging markets in general, because you're absolutely right. There are some emerging markets countries, particularly LATAM and India, that look like they're going to be headed for some real difficulties, some real headwinds as a result of this pandemic. So we want to be very selective, but there are some Asia EM countries that are on the other side of this or who have gotten by relatively unscathed that look attractive now, particularly given all the Fed accommodation that we're seeing.
You know, Christina, let's take Treasury Secretary Steven Mnuchin at his word. Let's say parts of the U.S. economy opens up in May. And considering that, plus coupled with what the Fed just did right now, can we see a powerful rally on the street, the likes of which not a lot of people have seen before in their trading lifetimes?
Well, we could certainly see a powerful rally based on what the Fed has done today, because it has certainly bent over backwards and is really expanding everything. It's expanding a lot of its powers. It's expanding policy beyond what we've seen before. But I will give you the caveat that we need to see continued fiscal stimulus. We got a great phase 3, but I'm worried about phase 4. It needs to be very significant as well, and I'm not sure we're going to get it. I mean, what we learned about past crises is that stimulus needs to be two things: big and fast. We got big and fast with phase 3. I don't know if we're going to be as lucky with phase 4. So we're going to want to watch that closely, because that could send stocks in the opposite direction.
Yeah, to your point, today the Senate is supposed to pick up this $250 billion additional package, right, for small businesses. We already are hearing the House is saying no go. We want other things attached to that stimulus. I want to check in with us, Jared Blickery, now, because Jared, I'm looking at my screen. I see green arrows across the board, not only for all three major stock indexes, but also for gold and for oil. It looks like investors are really ignoring those 6.6 million jobless claims and focusing squarely on what the Fed is doing to help us out.
I think that's exactly right, Alexis. $2.3 trillion in additional commitments here. We see the Dow up 335 points. The NASDAQ is up about 1%, kind of the laggard here. Tech has been lagging over the past few days and when we had this rally underway. And then the S&P 500 up 1.33%. I just want to take a look at a year-to-date chart here. We cleared an important resistance level. It depends on where we close, but about 2750 was something level that traders were looking at here. Also, the Russell 2000 outperforming once again, as it has been for the last several days, this entire week, up 4.6%. And you mentioned crude oil. So let's take a look at that. That's up 6%. It looks like there was some disappointment. We'll look at the intraday chart for this. There was some disappointment just after 7 a.m. about the prospects of a cut that would be coordinated among the world's oil producers. But that meeting is going to happen at 10 a.m. nonetheless. But after 8:30, we did see this risk-on rally in crude oil, and I expect to see the same thing in gold here, very much so. So once again, above 1,700, climbing towards the highs of the week, and those are 7-year highs, Alexis.
All right. Christina, what are your thoughts on what the Fed did this morning? One of the things it unveiled in that $2.3 trillion package is that it's going to take on more high yield debt from companies that were already debt laden prior to the pandemic. Is that a good idea?
Well, it's certainly what the Fed thinks they need to do to ensure that the economy remains running, that it is solvent, and that we're able to get through this crisis and ensure a better, more robust recovery. So I'm not going to second guess the Fed, but I am overwhelmed with the level of support they've announced today. Lending facilities from municipal to Main Street, really impressive, and again, expand the Fed's role. In the absence of adequate fiscal stimulus, we need to see that from central banks, and the Fed is delivering.
Jared, let me get back to you. I've been watching General Electric all morning long. The stock was higher in the pre-market, and I'm surprised by that action. They came out and warned in the first quarter, saying their first quarter earnings will be, quote, materially below their prior outlook.
That's right, Brian. GE has been on a roller coaster ride over the last year, over the last several years, kind of bouncing back and then got hit by this whole coronavirus thing. Unfortunately, my charts are frozen right now. I'd love to show you a picture of what it's doing after the open here, but suffice to say, it is up materially, Brian.
All right. Christina, bouncing off that GE announcement, I mean, we're going to be entering earnings season in a big way next week. The banks are going to be out with their earnings to kick things off. What are you expecting? I mean, it's really hard in an environment like this to even estimate at this point.
Oh, it's absolutely difficult, almost impossible to estimate. We're certainly going to get guidance that downwardly revises expectations significantly from companies, but I think that for many companies, it's a moving target for them as well. And so we have to assume that earnings are going to get bad, but that this is likely to be a short-term phenomenon. We need to look past that, and I think it's more appropriate to focus on fiscal stimulus and monetary stimulus, and of course, the health statistics.
Christina, do you think it makes sense even to play this rally or even go into equity? Why not go into fixed income? If you have the Fed coming out here pretty much backstopping all this stuff, isn't that the better play?
Well, what we know about previous Fed action has been that during QE, stocks benefited as well. But certainly there's an attractive play to be had, particularly in investment grade credit. We think that's an ideal area. I shouldn't say ideal, but that's a good area to focus on right now, given all the Fed backstops there. But certainly equities should benefit as well from what we're seeing. And of course, there are more attractive valuations today than there were a few months ago. So if one wants to be opportunistic, this is a good time to begin the process of moving into them.
All right, Christina Hooper of Invesco. Thanks, as always. Great to see you.
Thanks for having me.
All right, stay with us. Much more to come. A little later on, we're going to talk to Wedbush's Dan Ives on his call for Microsoft and Apple during this time. Stay with us. We'll be right back. Good morning, everyone. Welcome back to Yahoo Finance Live, where we have a rally underway this morning for all three major stock indexes. Let's say good morning to our editor-in-chief now, Andy Serwer. Hey, Andy, good to see you again. Hey. I know you spoke with Anthony Scaramucci, who is the founder, of course, of the hedge fund Skybridge Capital. He was also briefly the White House Director of Communications, and he's been quite vocal about how the administration has been handling this pandemic. What did he have to tell you in his latest interview?
Yeah, Alexis, Anthony Scaramucci has kind of a complicated relationship with Donald Trump. I think that's fair to say, having briefly served, as you said, as communications director at the White House, was a big supporter, then has become a big critic. And it was interesting to get his perspective on how the White House has responded to the coronavirus. Here's what he had to say.
I am very happy with where we are now. It's been 11 days since he made a 180-degree turn. And so thank God he did that, because it will save lives. Had we moved as quickly as South Korea did, remember the first cases showed up in South Korea on the same day as the United States. We were advised to move in their direction. The pandemic experts and the epidemiologists here in the United States advised the White House to do that. The president made a decision not to do that. I don't want to be the Monday morning quarterback. But clearly, had we moved in February, we would have lower death numbers. And the great irony is he's the business president. It would have helped out the economy immeasurably if we had moved in February. But we're here now, and I think the response over the last 11 days has been way better. But I can take you back to last week, where we were talking about opening the economy on April 12th. There was nobody on Wall Street that has gotten up to speed on the mathematics of this situation that thought that that was real information. You know, the president talks about fake news all the time, but a lot of the things that he's saying coming out of his mouth are sort of like fake science. So what I'm hoping is we can get what's coming from the White House to be more congruent with the reality of the situation.
Yeah, and what you're not hearing there, and what Anthony told me in a later part of our conversation, is that he's actually, maybe not surprisingly, pretty positive about the American economy's ability to respond and the resiliency, and ultimately that we're going to come out of this thing maybe a little bit quicker than some people think. And his point was that the Fed is sort of doing everything that it can. And, you know, of course, we saw that in spades this morning, you guys. Back to you.
All right. Thanks a lot, Andy. And of course, you can catch more of that interview with Anthony Scaramucci and Andy Serwer on our website and also our app. All right. I want to bring in Brian Chung back into the show now, our Fed correspondent, because Brian, you got an article out on the site talking about Goldman Sachs making a call saying that there is a case for a V-shaped recovery after this pandemic is behind us, making the argument that we could actually see multi-million job gains when we come back. I mean, on the same day that we're hearing 6.6 million Americans applied for first-time unemployment benefits. Break that down for us.
Yeah, well, obviously, as we know, those jobless claims numbers are not very good and probably don't make a very clear argument for a V-shaped recovery. But Goldman Sachs had a note yesterday saying that if this event that we're going through right now is in some way similar to the 1981-1982 recession, we could see a rebound. So keep in mind, 1981-1982 was the Volcker recession. That was when Fed Chairman Paul Volcker dramatically raised interest rates to try to stem inflation, which at the time was rising to the tune of nearly 10%. We saw millions of people lose their jobs during that recession as well. But it was very akin to a temporary shutdown, as Goldman points out, very similar to the way that the government is telling businesses to shut down right now. And after the 1981-1982 recession, we did end up seeing a multi-million job rebound in 1983 and 1984. So Goldman Sachs saying if it is similar to that, maybe we do see a similar bounce here with the coronavirus once we do ultimately at some point get the economy back up again. So Goldman saying there is a silver lining to all of these negative data that we're receiving, but we still need to rely on the health response to be able to tell us whether or not we can actually get that sharp rebound.
And Brian, real quick here, break down for us what the Fed did this morning, unveiling the details of that $2.3 trillion package.
Yeah, $2.3 trillion, which the Federal Reserve is going to be using to expand its existing facilities on primary and secondary corporate credit, investment grade. They did slightly expand the scope of those facilities, not only by size, but also to include some collateralized loan obligations, which would cover some high yield stuff. And then they also announced a little bit more detail on the Main Street lending facility. It will provide 4-year loans of a minimum of $1 million to businesses that are slightly larger than those that are being targeted in that Paycheck Protection Program. The Federal Reserve saying it'll backstop those loans by having the banks hold on to 5%, but the Fed will take credit protection for the other 95% of loans to basically tell lenders, hey, go out there and try to make sure you provide this credit to those businesses that really need it.
All right. And all that news, of course, sparking the rally we're seeing right now on Wall Street. Brian Chung, thank you. Stay with us. We've got Wedbush's Dan Ives up next. We're going to talk about everything with him. I don't know, a little Disney, a little Apple, a little Microsoft. Don't go away. We'll be right back. We've got a powerful rally underway here in the early going on Wall Street. Dow up nearly 500 points right now. I want to welcome to the show Dan Ives of Wedbush Securities. Dan, always good to see you. Lots to get to this morning. And I want your thoughts on what Disney said yesterday. Disney said that subscriptions for its Disney Plus, which is its new video service, has now hit 50 million or surpassed 50 million. I mean, it doubled in just about 6 weeks. Where does this leave other streaming services, especially Apple service, which is fairly new?
Yeah, I mean, look, that was a jaw-dropping number, 50 million, double from where they came out in early February. I think it just speaks to the content and the pricing. I mean, it's the magic formula. It's really Iger's brainchild in terms of what's come out. It's firing out of the gates. And I think fundamentally it does pose not just a threat to Netflix, but when you look at Peacock, HBO, and of course Apple, there's a competing sort of mind share for just a dynamic that, of course, no one ever envisioned. With consumers in a lockdown, streaming services and subs and viewership were up 25%. So this is the opportunity. And that's why Apple, they continue to have the strong demand, but content's lacking.
Dan, I don't know if I should be calling you Mr. Ives. I see you're getting an ETF named after you using your last name. Congrats on that. That's some cool stuff. But just wanted to continue on what you just said on Apple. The read through, at least to me, Disney racked up 50 million subs. That's a huge number. What are the numbers looking like for Apple on its streaming initiatives?
Yeah, and right now, and remember, those are paid subs for Disney, whereas Apple, because of their promotional, in terms of a lot of those are free, we think it's somewhere between 30 to 40 million. but a fraction of those are paid. So for Apple, the key is going to be how do you keep those subs after a year for paying? That's why it's going to be content. And we continue to think they're going to be forced into doing more content acquisitions or potentially a studio acquisition. Also remember, any new project can't be rolled out right now. They can't be taped because of the pandemic. That further just stems original content, which is a major issue for them.
I want to stick with Apple for a minute, Dan, because they're supposed to be releasing that low budget iPhone. I mean, in the next few weeks. Is this a smart time to be doing it during this pandemic?
Yeah, look, I think it's been a quagmire for Apple in terms of what they should do here. I do view it as a low touch, low fanfare type of release. It's an entry level model. We call it an SE2 or iPhone 9. So I think they'll release it. In my opinion, you're still talking maybe 20, 25 million units. The bigger issue for them is 5G, because those 5G phones, do they release them September, October? We think exactly at that point, just given what we're seeing in the pandemic, post even lockdown, that they'll push that out to probably holiday season, because they cannot release that into a tempered environment. You get one shot at releasing a 5G phone.
Dan, I've been following your Tesla notes, and to me, it seems as though you're staying hopeful on Tesla this year and into next year, but more short term. We saw this week they're starting to furlough their workers. Do you think they're looking at or nearing a potential, either an equity raise or a debt raise, and how would the market respond to that?
Yeah, and I think the smartest move the board and Musk made was raising capital when they could. I mean, they've raised, cumulatively, if you think about 2.5 billion tranches, the $5 billion now really takes any capital raised in the near term off table, because liquidity-wise, they're in a good position. I think Tesla, it's a tale of two cities. The next quarter or two are just going to be nightmarish, given you got Fremont shut down, a consumer lockdown. So you're not really going to see that sort of trajectory. And I think just to put numbers around, they call it 540K units for the year. Now the whisper somewhere between 4 to 415K. But it's all about, very similar to Apple, it's the other side, the dark valley. What are names you want to own on the other side? I can just tell you, investors I talk with every day, they're focused on when the normalized environment, what valuations look like, especially when you look into 2021. That's what a lot of these stocks are being valued on.
And we know, Dan, you like cloud-based stocks. Your new ETF named IVES is all about cloud. You call Microsoft the Rock of Gibraltar of cloud stocks to own right now. Why?
Look, and it speaks to, even with the ETF, with Wedbush and ETFMG, it was really, the focus was $1 trillion of spending, and to come up with a vehicle that goes after that. And when you look at what Microsoft's done, I mean, Microsoft, more and more, even what we're seeing today, it's an acceleration of that cloud trend. That's why that stock continues to hold up well, because you look at areas that are stress tested, they're still seeing spending, it's cloud. And Microsoft, and of course AWS from the Amazon side, are really the bedrocks of that. And I think that's something where, even in this environment, on the other side of the dark valley, that's a name that continues to be a top pick, and the overall cloud theme and names that fit into it.
The other side of the dark valley. Dan? All right, let's check in with Jared quick for a last check of the markets. Jared? Oh, Jared, just unmute yourself there.
Yes, unfortunately, that took a little bit longer than I thought. Sorry about that. We are seeing a broad-based rally right now. And as I get the Yahoo Finance Wi-Fi Interactive up and running here, let me just say that financials are leading, along with real estate, which is apparently the new cyclical, along with materials and energy. And if we look at some of the breakdown of what's been happening recently, it's been a very positive week for equities overall. And we were just talking about some of the streaming names, but let me just show you on a 4-day chart. So that covers Monday through today. A lot of green here. Apple up almost 12%. Same for Alphabet. Facebook up nearly 15%. And if we look at the Dow Jones heat map here, we see a very similar story. Let's sort by performance and see the top ones. So Dow Inc. up 34%. Raytheon Technologies, after merging with United Technologies, is up 33%. American Express up 32%. Goldman Sachs. You get the picture. To the downside, we only see the staples lagging. Procter & Gamble, Walmart, barely up about 1%, Alexis.
All right, Jared, thanks so much. Taking a look at the Dow now, up better than 500 points. JP Morgan Chase, Dow, and Raytheon leading the advance there. Stay with us. More Yahoo Finance Live to come right after this.
Welcome back to Yahoo Finance Live. You're seeing the market in good old rally mode as the Fed comes out and rips out another bazooka out of its back pocket. I want to get right to our Fed correspondent, Brian Chung, with the latest. Brian?
Hey, Brian. So we actually have Jay Powell making remarks at the Brookings Institution right now. Some of these lines are just crossing. He said, quote, "We will continue to use these powers forcefully, proactively, and aggressively until we are confident that we are solidly on the road to recovery." I want to read those adjectives again: forcefully, proactively, and aggressively. Chairman Powell did offering a little bit of insight into also the labor market, saying he expects, quote, "very high, although temporary levels," end quote, of unemployment. No specific projections, but he did have some inside the Federal Reserve System projecting unemployment reaching as high as 30% annualized. Powell again saying also in his remarks, again, these are the first remarks that he's made publicly since his appearance on the Today Show a few weeks ago. He said, "In the meantime, quote, we are using our tools to help build a bridge from the solid economic foundation on which we entered this crisis to a position of regained economic strength on the other side." And all of these remarks are really coming after the Federal Reserve only a few short hours ago announced that it would be launching $2.3 trillion in funding, which would support the Main Street lending facility that it had previously announced, and also a number of new measures, including opening up a municipal debt facility that would buy some short-dated municipal debt from states and large counties and cities, in addition to expanding the scope of its primary and secondary corporate credit facilities to actually take on high-yield debt in the form of some ETFs and also collateralized loan obligations. So the Federal Reserve clearly saying here, we've got a number of tools we could still use. Our emergency lending programs are not out of ammo yet. Brian?
Brian, even still, the market can care less about this right now on what they're doing to their Fed. The Fed is doing to their balance sheet. But a lot more risk on that balance sheet is coming.
Yes and no. So we have to distinguish between quantitative easing and some of these temporary liquidity programs that they're providing. Most of the announcements in that $2.3 trillion announcement today are for these liquidity programs, which in some respects can increase the size of the balance sheet, but really is technically not being taken on by the Fed. So when we talk about asset purchases for these municipal debt instruments or for some of these high yield instruments, they're actually not going directly to the Fed balance sheet. They're being taken on through a special purpose vehicle, what they call an SPV, that's open in conjunction with the Treasury. So the Fed buys the purchase or makes the purchases through probably the New York Fed or other types of facilities, and then they're actually held at the SPV with credit backing or equity that's provided from the Treasury. For those that are wondering, where's the Fed and the Treasury getting this money from? A lot of the money is coming from that $454 billion of appropriations that Congress gave to the Fed and the Treasury to do things like this. So the Fed is not blown through all $454 billion of that money today. They still have probably about half of that money they could still use, which means we should pay attention to the Fed to see if they have more tricks up its sleeve in coming weeks.
The world, leaving a tragic and growing toll of illness and lost lives. This is first and foremost a public health crisis, and the most important response is coming from those on the front lines in hospitals, emergency services, and care facilities. We watch in collective awe and gratitude as these dedicated individuals put themselves at risk in service to others and to our nation. Like other countries, we are taking forceful measures to control the spread of the virus. Businesses have shuttered, workers are staying home, and we have suspended many basic social interactions. People have been asked to put their lives and their livelihoods on hold at significant economic and personal cost. We are moving with alarming speed from 50-year lows in unemployment to what will likely be very high, although temporary, levels. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we're taking to contain the virus represent an essential investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. The recently passed CARES Act is an important step in honoring that commitment, providing $2.2 trillion in relief to those who've lost their jobs, to low and middle income households, to employers of all sizes, to hospitals and healthcare providers, and to state and local governments. And there are reports of additional legislation in the works. The critical task of delivering financial support directly to those most affected falls to our elected officials, who use their powers of taxation and spending to make decisions about where we as a society should direct our collective resources. The Fed can also contribute in important ways by providing a measure of relief and stability during this period of constrained economic activity, and by using our tools to ensure that the eventual recovery is as vigorous as possible. To those ends, we have lowered interest rates to near zero in order to bring down borrowing costs, and we've also committed to keeping rates at this low level until we are confident that the economy has weathered the storm and is on track to achieve our maximum employment and price stability goals. Even more importantly, we have acted to safeguard financial markets in order to provide stability to the financial system and to support the flow of credit in the economy. As a result of the economic dislocations caused by the virus, some essential financial markets had begun to sink into dysfunction, and many channels that households, businesses, and state and local governments rely on for credit had simply stopped working. We acted forcefully to get our markets working again, and as a result, market conditions have generally improved. Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today, and only with the consent of the Secretary of the Treasury. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing from the Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers, not spending powers. The Fed is not authorized to grant money to particular beneficiaries. The Fed can only make secured loans to solvent entities with the expectation that the loans will be fully repaid. In the situation we face today, many borrowers will benefit from these programs, as will the overall economy. But there will also be entities of various kinds that need direct fiscal support rather than a loan they would struggle to repay. Our emergency measures are reserved for truly rare circumstances, such as those we face today. When the economy is well on its way back to recovery and private markets and institutions are once again able to perform their vital functions of channeling credit and supporting economic growth, we will put these emergency tools away. None of us has the luxury of choosing our challenges. Fate and history provide them for us. Our job is to meet the tests we are presented. At the Fed, we're doing all we can to help shepherd the economy through this difficult time. When the spread of the virus is under control, businesses will reopen and people will come back to work. There is every reason to believe that the economic rebound, when it comes, can be robust. We entered this turbulent period on a strong economic footing, and that should help support the recovery. In the meantime, we are using our tools to help build a bridge from the solid economic foundation on which we entered this crisis to a position of regained economic strength on the other side. I want to close by thanking the millions on the front lines, those working in healthcare, sanitation, transportation, grocery stores, warehouses, deliveries, security, including our own team at the Federal Reserve, and countless others. Day after day, you've put yourself in harm's way for others, to care for us, to ensure that we have access to the things that we need, and to help us through this difficult time. Thank you. And David, I'll look forward to your questions.
Hi, can you hear me now?
Yes.
I'm David Wessel, Director of the Hutchins Center at Brookings. I appreciate your remarks, and I particularly want to reinforce the point you made at the end that a lot of us have the luxury of working from home remotely, but there are a lot of people who don't, and they have often been forgotten in the past. And I think we all celebrate the work they're doing and the risks they're taking. Chair Powell, and I have a number of questions of my own and some that we've gotten from people who sent them in by email or via Twitter. In the past 3 weeks, more than 15 million people have filed initial claims for unemployment benefits. That's huge. We all know that the second quarter is going to be awful, but I wonder if you could help us look ahead. You and your formidable platoon of economists, what do they see for the rest of this year? You talked about a robust recovery. Do you expect that to begin this summer or fall, or do we have to wait longer for that?
We have terrific economists with different specializations right across the Fed, and it's really a great honor to work with them. And if you ask them today what their expectation is for the economy over the course of the rest of this year, they will tell you that it really depends on the path of the coronavirus. How quickly will it spread? How quickly do we get it under control? How quickly are we able to reopen the economy with confidence? People can go back to work knowing that it's safe. Businesses can reopen knowing that it's safe. So that's really the thing. These are not typical economic questions that our great economists are practiced and skilled at answering. So they'll tell you that. And so I would say, generally, my expectation is that the second quarter will be a very weak one. And that's because businesses are shut down. Workers are either working from home, or they're furloughed or laid off, or they're just, the businesses that they work at is closed for the time being. So we do expect to see a very low economic output and big increases in initial claims for unemployment and in unemployment during the second quarter. When the virus does run its course and it's safe to go back to work and safe for businesses to open, then we would expect there to be a fairly quick rebound as people do go back to work and start resuming normal levels of economic activity. I think most people expect that to happen in the second half of this year after the second quarter, which of course ends on June 30. To try to be precise about where that would be, I don't think that would be appropriate. I will just say that it does depend on people staying home, staying healthy, doing everything we can to get the virus under control. The more we do that, the sooner it will be safer to go back to work.
Thank you. So as you noted, the Fed has cut interest rates to zero. You've bought hundreds of billions worth of Treasury bonds and mortgages. You've launched an alphabet soup of lending programs, including some new ones today for state and local governments and mid-sized businesses that you say could lend up to $2.3 trillion. Is there any limit to how much money the Fed can create, how much it can lend without having some unwelcome side effects like inflation or asset price bubbles?
So I'll just say that these programs that we're using under the law, we do these with the consent, as I mentioned in my remarks, with the consent of the Treasury Secretary and with fiscal backing from the Congress through Treasury. And we're doing it to provide credit to households, businesses, state and local governments as we are directed by the Congress. And we're using that fiscal backstop to absorb any losses that we have. And what we've been doing is looking for places that are very important to the real economy, things that really affect people's lives and economic output, and where credit to those parts of the economy has broken down. And those are the ones I've mentioned. And so that's essentially what we're doing. And we can keep doing that as long as those needs arise. Our ability to do that is limited really by the law. We have to find unusual and exigent circumstances. The Treasury Secretary has to agree. And we are using this fiscal backstop. But there's no limit on how much of that we can do, other than that it must meet the tests under the law as amended by Dodd-Frank.
But isn't there a risk that with all this money coming out of Congress, the money that we're lending, that we'll end up with something that we don't like, as in more inflation than we like, or asset price bubbles?
So inflation has been an interesting phenomenon. Back when 12 years ago, when the financial crisis was getting going and the Fed was doing quantitative easing, many people feared that the increases in the money supply that would, as a result of quantitative easing, asset purchases, would result in high inflation. Not only did it not happen, the challenge has become that inflation has been below our target. So that is globally the challenge has been inflation below target. And honestly, it is not a first order concern for us today that too high inflation might be coming our way in the near term. Far from it. There are certainly, I would say, these are programs that we're developing at a high rate of speed. We don't have the luxury of taking our time the way we usually do. We're trying to get help quickly to the economy as it's needed. And I worry that in hindsight you will see that we could have done things differently. But one thing I don't worry about is inflation right now.
A number of people wrote questions that go something like this. Think of somebody who works at a small restaurant. She's lost her job. The restaurant's closed for how long, really nobody knows. All the things that you're doing, how do they help people like her, the owners of that small restaurant, and the millions of people like her in that position?
So she sounds very typical of what many people are unfortunately enduring at the moment. And I would say the most important thing that she can do is to stay home and stay healthy. The more people do that, the sooner we will get control of the spread of the virus, the sooner we'll be able to go back to work. It's also important, by the way, that our healthcare authorities develop a plan for that to happen in a careful way that doesn't result in another outbreak, and then we have to go back to square one. In the near term, the biggest relief that she will get is probably going to be from the expanded unemployment insurance under the CARES Act, which I think added $600 per week for people's unemployment insurance. She'll probably find that it's hard to get access to that right away because there's so many newly unemployed people that there are backups at the unemployment offices. But that money she's entitled to that money, and she will get that money. It may take a few weeks longer than it should. So what is the Fed's role in this? Our role, as I mentioned in my remarks, is really to try to provide some stability and some relief during this period when the economy is partly shut down. That involves keeping interest rates low. So if she has a mortgage or credit card debt, she'll feel lower interest payments from that. Also, we've, as you mentioned, David, we've used our tools to keep the financial markets functioning. That's going to avoid significant further damage to the economy. And really, the most important thing we can do is, while providing stability during this period, will be to support a robust recovery when it does come. That's really what our tools are most important for.
You mentioned that Congress has done quite a bit. You mentioned correctly that you don't do taxes and spending, Congress does. But everyone, including members of Congress, look to you for advice. In your judgment, do we have to do a lot more on the fiscal policy front to respond to this crisis?
So I'll just stress that we don't, as you know, we're not responsible for fiscal policy. We don't give public advice to Congress on fiscal policy. I will say that, as I mentioned in my remarks, in many cases, what people really need is direct fiscal support. Rather than a loan, and what we can do is loan. So there's a big need for fiscal policy. I do think I hear many voices on both sides of Capitol Hill and in both parties talking now about further support. I do think that's likely to be appropriate. They will have to decide as elected officials what that might be, but you already hear, for example, further funding for the small business SBA loans, and also perhaps more direct funding for the states and for hospitals. Again, not our job, but I would see that as more likely than not to be needed.
And a good idea.
Yes, absolutely. I would say broadly, people are undertaking these sacrifices for the common good. We need to make them whole. To the extent we have the ability to make them whole, we should be doing that as a society. They didn't cause this. Their business isn't closed because of anything they did wrong. They didn't lose their job because of anything they did wrong. This is what the great fiscal power of the United States is for, is to protect these people as best we can from the hardships they're facing.
Congress has allocated in the CARES Act $454 billion to backstop Fed emergency lending. If I did my arithmetic right, today you used $195 billion of that for the various programs you announced this morning. What are your priorities for the rest of that money? How do you think about how you'll use it and what you'll have to use it?
So our priority really for all of it is the same, and that is what's happened is in our big, complicated economy and financial markets and banking system, we rely on those who have funds to lend through various channels to those who are borrowing. And what happened when the spread of the coronavirus around the globe became clear is investors all over the world had really struggled to assess what that meant for the economy. And so they pulled back from other kinds of investment and really went to the safest short-term investments like T-bills. And the result of that was that many parts of the capital markets and lending more broadly stopped functioning. And that is exactly the situation that our emergency powers are meant to address. So we have moved in, and as I mentioned, our priority are those areas of the markets that are most fundamental to supporting the real economy. And you see the programs. We've now announced, I think, 9 different facilities, and those really are the priority areas where we thought that help was needed. As we identify other areas, we won't hesitate to move into those areas. In addition, we may find that some of the programs we've announced need adjusting and need to be larger, or didn't need to be as large as we thought, or need to be changed. We're going to be watching all of that and very much willing to adapt.
There is, I think, a consensus that one mistake made during the global financial crisis a decade ago was that banks were allowed to deplete their capital by paying dividends for too long. Now, several big banks have voluntarily suspended stock buybacks to preserve their capital. I'm curious why it hasn't suggested or directed them to suspend their common dividends as well.
Yeah. Maybe I'll start by saying that businesses distribute earnings really to their shareholders through buybacks and through dividends. And that's just a way of saying that that the owners may have better use for those funds than the business does. It's a perfectly normal thing in our capitalist system. And our largest financial institutions do about 70% of those distributions through share repurchases. All of our 8 largest, most systemically important institutions have stopped distributions through that channel, as have a number of the large regional banks that account for a big part of the banking system. And that's a good thing. They haven't stopped dividends. And in my way of thinking, I don't think that's something that needs to be done at this point. I think our banks are highly capitalized, far more highly capitalized, with more high quality capital than they were before the financial crisis. And we'll be watching to see how things evolve, but I don't think that step is appropriate at this time.
I see. One of the things that distinguishes this period, which is pretty extraordinary, is what's going on in the mortgage market. We've seen a sharp spike in delinquencies. It's hard for people to buy. It's even hard for people to refinance mortgages. There's questions about the mortgage servicers. Do you think there's steps that need to be taken now by the government, broadly defined, to make sure that a mortgage crisis doesn't make the economic recovery slower than need be?
Well, so a couple of things. First, I think the CARES Act does provide a moratorium on payments for some time for some mortgage holders. But you're absolutely right. The mortgage market is at the very center of our economy and very important for the real economy. That's why we bought so many mortgage-backed securities at such a historically aggressive pace over the last few weeks. We feel like the mortgage, that market, which is where an awful lot of individual home and other mortgages wind up, is now functioning more properly. We're watching carefully the situation with the mortgage servicers, and I will just tell you that we certainly have our eyes on that as a key market that does support households and consumer spending, really, which is of course 70% of the economy. So we'll be watching that carefully.
Chair Powell, I understand that a few minutes ago, the Treasury Secretary, Steve Mnuchin, said he thought the U.S. economy might be ready to reopen by the end of May, as soon as the president feels comfortable with the public health stuff. Does that seem right to you?
You know, we don't, this is not a judgment that is assigned to the Fed to make. And you know, that's a judgment that has to be made, I think, starting with health officials. I do think it's time to have a serious public conversation and a lot of analysis about that. You know, we need to have a plan nationally for reopening the economy. We all want it to happen as quickly as possible. We all want to avoid a false start where we partially reopen and that results in a spike in coronavirus cases, and then we have to go back again to square one. We all want to avoid that. So we're not experts in that here at the Fed. I would really rely on the medical experts principally, and then that will be a decision for really other parts of government.
I'd like to think a little bit about like on the other side here. What are you going to be looking at to decide whether it's time for you to pull back these lending facilities and maybe begin to tighten again?
You know, as you've noticed over the years, David, we tend to move gradually and predictably. We think that's a good way to do things. So I think we'll be looking to see, we'll be looking to see that the economy is well on the path to recovery. We'll be in no hurry to pull back on our asset purchases or on these programs. They're tentatively scheduled to stop lending on September 30th. If they have to go longer than that, of course they will. So I think the thing we'll be looking for is to make sure that the economy really is on a solid footing before we start pulling back. And then, as you know, when we start pulling back, we do so very gradually. If you think about the way we ended our quantitative easing back in 2013-14, we did it over the course of a full year. You can fully appreciate and expect that we will follow that playbook of well telegraphed in advance, quite gradual moves, and we won't start them until it's time to do so, which would be a time at which we are confident that the economy is on a solid footing again.
A number of people have asked whether you think you'll rely on a cap on short-term interest rates, a yield curve control kind of thing, when we come out of this thing. Have you considered that?
So we, of course, we've done a lot of thinking about what monetary policy might look like over the coming months. For now, though, two things. First, we think our monetary policy is just in the right place. We've got rates at zero, and we've said that we'll hold them close to zero, that is, until we are sure that the economy has weathered the storm and is on the way to recovery. So that's, we think, exactly where that should be. The principal focus now is not on adjusting what we see as quite an appropriate stance of monetary policy, at least for the next few months. The principal focus is on these lending programs and making sure that credit does flow in the economy. We saw what happens when the credit system breaks. It can really inflict much greater damage on the economy. We're doing everything we can to avoid that, and we'll continue to do that so that credit is flowing, households, businesses, state and local governments, as requested by Congress. And that's really the main focus now. All of those things that about monetary policy, of course, we're thinking carefully about what that might look like in the future, but they're not, something we're currently, thinking would be appropriate.
Are you at all worried about the Federal Reserve, which is, after all, unelected officials making decisions about who can borrow and who can, and what credit rating is eligible for your loans and where you're not going to lend?
So this is an area where during the global financial crisis that ended in 2010, let's say, the Fed really made those decisions, although did so with some consultation with the Treasury Department. One of Dodd-Frank's innovations was to say that we could only use these extraordinary powers with the consent of the Treasury Secretary. And I think that's actually a wise decision. Decisions of this magnitude really there should be some accountability, at least, for those who are elected by the public. We are not elected by the public. And that is the administration in the form of the Treasury Secretary. I think that's actually a healthy thing, that there be some connection to elected officials. So I think that's a wise move on the part of Dodd-Frank. So we don't make, the second thing I'll say is we don't make decisions about individual firms. We're only allowed under Dodd-Frank to have programs of broad eligibility, meaning classes of borrowers. Any borrower that meets the eligibility requirements for one of these facilities can take part in the facility. We're not going to be picking this firm but not that firm. It's broad eligibility, so there won't be that. I'd also say there are overlapping spheres here. The Fed has complete authority over monetary policy. Treasury does fiscal policy with Congress, but financial stability is really something where we both have a stake and both have authorities. The Treasury Secretary chairs the Financial Stability Oversight Council, for example. So we do work closely with them on these facilities, and I'll say that's been a very productive relationship.
And finally, I wonder if you could speculate a little bit about how the economy will be different when we come out of this. We'll have a lot more debt, that's for sure. Do you think that we'll be people saving more? Do you think our way of life will change? Do you have thoughts on that?
Our main focus is on the near term, and that's really our intense focus. But these are great questions, and my guess is that behavior will change. It won't change quickly. People will start to go back to movies, to theaters. They'll start to travel, and they'll gain confidence that it's okay to do so. And that process can be a fairly short one, but I think it'll be, at the beginning, it will certainly be gradual and tentative. Will there be longer run changes in our behavior? I don't know. That's a great question. We'll have to see.
And I think a lot of people are scared now. This is not something that any of us have lived through in our lifetimes, a pandemic like this that's caused the economy to stop and people will be afraid of interacting with their neighbors. I think people want to know that our leaders, people like you, are confident that we can get through this. So I want to give you this opportunity to, if you like, to reassure people about what lies ahead.
Thank you. So, David, I would say this is going to be and is a very difficult time for many, many people. People are getting sick. Their loved ones are getting sick. People are getting furloughed and laid off. People who started great businesses are seeing them shuttered. I wouldn't want to say anything that diminishes the suffering that people are feeling at all. It's going to be a tough time. But if the government continues to give people the support that they need, that includes us, that includes Congress, other parts of government, and if people stay home and stay healthy until it's appropriate to go back to work, and if the healthcare policy experts devise a plan for a good way to go back to work and reopen the economy, if we do all of those things, there's every reason to think that we can be back on the road to a recovery fairly quickly, and that can be a robust recovery. I actually thought Chairman Bernanke said it well the other day when he said that if we do those things, you'll be looking back on this and you won't see much, only modest effects, I think he said, on the economy from this event. And I think that can be the case if we do the things that I mentioned.
Well, as they say, from your lips to God's ears. Chairman Jay Powell, thank you very much for your time today. I thank everybody for watching and the very good questions we received. And we wish you all a very safe next few weeks as you continue the important job of steering our economy through this terrible storm. Thank you very much.
Thank you, David, and thanks, John.
Welcome back. You've been watching Fed Chair Jerome Powell discuss the new Fed initiative this morning, $2.3 trillion being pumped essentially into the economy. And one quick note for me here, interesting conversation with David Wessel at the Brookings Institute. Chair Powell would not be pinned down on the length or the time it would take for the economic recovery post-coronavirus. He simply said he expects a fairly quick rebound, but noted it may not happen into the back half of the year. I want to bring in our Fed correspondent, Brian Chung. Brian, you heard Fed Chair Jerome Powell's comments. What are some of your takeaways?
Yeah, well, no real timeline, as you mentioned, but Jay Powell is saying we shouldn't be expecting any sort of rebound in the second quarter, at least from a data standpoint. He said the second quarter will be, quote, a very weak one, end quote. This goes along with what he had said in his prepared remarks, where he projected that unemployment could be very high, although temporary, he hopes. A few other nuggets from what he said in that conversation with the Brookings Institution and David Wessel. He was saying that, he does think that healthcare policy experts are going to be key in determining the rebound and how quickly we can get out of this. But he said he's weary of trying to restart the economy too early. He said he doesn't want a scenario where you try to reopen the economy, but then people get sick again and then you have to close it again. So he says that it's really going to be on those epidemiologists and those healthcare experts to determine exactly when is the right time to be allowing people to go back into work and try to resume a normal pre-coronavirus life. A few other things that are worth mentioning from a monetary policy technical standpoint. He said it's not a first order concern for him on inflation. He's not too worried about any sort of pressures that might come from the Fed's asset purchases and also from its liquidity programs. He said we didn't see inflation after the Federal Reserve launched its unprecedented process of buying assets in the Great Recession of 2009 and 2010. And then another thing worth mentioning is that he said he would be in no hurry to pull back on those liquidity programs or those asset purchase programs. He said he wants to make sure the economy is on a solid footing before they try to pull back on any of those things, which says even if the coronavirus ends up abating at some point in time, the Fed could still keep those programs running.
And Brian, what struck me too is that he actually committed to saying that when we get on the other side of this, he expects the economy to bounce back and, in his words, be, quote, robust. And when asked what Congress has been doing, what their stimulus package has been, and whether or not more is needed, he sort of shied away from wanting to really commit to that, again, saying, and we've heard him say it before, it's not the Fed's job to deal with fiscal policy. But did you get the feeling that he definitely backs more aggressive stimulus coming from lawmakers?
Well, aggressive stimulus is probably something he would like to see because that's what the Federal Reserve is doing. So he may not be saying it directly, but he's trying to probably tell Congress, hey, let's match, set for set here. And that's the language that he used in his prepared remarks. He said he wants to use Fed monetary policy, quote, forcefully, proactively, and aggressively. And I don't necessarily take this as a jab at Congress per se, but a little bit of a slip when he was talking about the example of the woman on Main Street who lost her job and what she's having to do right now. And he said that right now, at least, Congress is providing an extra $600 per week through federal unemployment insurance through the CARES Act. But he said, quote, it may take a few weeks longer than it should for those people to get it, kind of speaking to a lot of the technical issues that we've seen with unemployment insurance because so many people are rushing to their local state offices to try to get that money. Very similar case for those PPP, that Paycheck Protection Program loans, where small businesses still haven't received a lot of the money that they've been promised from the federal government yet. So these are all things that I think Powell is trying to subtly address in his remarks and saying the fiscal response still has more legs to go in order to make sure that the economy can be set up for a recovery once the health implications of all of this are properly addressed.
Brian, real quickly, too, one other key point, he did note, quote, a big need for fiscal policy. Number two, he said, we need a plan to reopen the economy. Clearly, we haven't gotten that plan yet.
Clearly, no, not yet. And he said that that really is going to depend on health policymakers, as I kind of mentioned earlier. The big concern for him is don't restart the economy earlier than it really should be. There was discussion, a few weeks ago from the White House that we could try to get the economy reopened by Easter. That's definitely not going to be the case. But he's trying to basically warn policymakers, hey, we shouldn't try to get too eager to reopen the economy, because if we do, we can ultimately end up disrupting what might have otherwise have been a V-shaped or a good-looking recovery, as long as we make sure we get the curve flattened first. And I think that's what Jay Powell is trying to say here. Anything otherwise would be, quite frankly, irresponsible for the Fed to try to opine on, because they are monetary policy makers, not epidemiologists.
All right, hang tight, everyone. We'll be back in just a second. Much more on these markets and the latest from the Federal Reserve. Stay tuned. Welcome back to Yahoo Finance Live. I want to get right to Inez Ferre, who's closely watching these markets right after Jerome Powell's big details on the Fed's new stimulus package. Inez?
And Brian, the market's rallying with the Dow up more than 400 points, the NASDAQ and the S&P higher. As you can see, this is the picture that we're looking at right here of the Dow components right now. You can see also Disney, one of the top components today. This is after their more than 50 million subscribers for Disney Plus. But I want to get right to oil, because oil right now is surging. This is after a report that OPEC Plus meeting, which had started at 10 a.m., there's a report that Saudi Arabia and Russia may have reached a deal cutting oil production by 20 million barrels a day. So you can see WTI is up more than 10%. You've also got Brent futures that are up right now. You can see that spike right there. And also Brent up more than 8% right now. And just taking a look at a couple of tickers that are moving this morning, Starbucks, after Starbucks announces same-store sales and what happened with those same-store sales at the end of March. And also Facebook. Facebook is actually donating some more than 2,000 of its portal video calling screens to UK's NHS. That's the National Health Service. Brian?
Yeah, and I was also seeing some good, strong action off that rise in oil, like you mentioned, in Apache and Transocean. Those stocks are up close to 30% so far on the session. I want to get right to John McClain, though. He's a portfolio manager at Diamond Hill Capital Management. John, always good to see you. Quite the morning for news, quite the new morning for markets and the Federal Reserve. Love to get your thoughts off what the Federal Reserve just did.
Yeah, I would have to say that I've done a 180-degree pivot in terms of going from bearish to bullish on credit markets. And I would certainly give the Fed an A in their communication here. I think backstopping credit is incredibly important, and injecting liquidity into credit markets is incredibly important. And what you're seeing is going into and coming out of a recession, credit snaps back first. And we are explicitly backstopped by the government at this point.
And John, what about equity here? We're seeing the markets rally a bit. I would have thought we would have seen more of a rally, but I know you've been bearish on equities a good bit in the past couple of months, rightly so. What are you thinking now?
Yeah, again, I continue to be bearish in terms of valuation perspective on a go-forward basis. I think I would certainly take the under on 125 for 2020 EPS out of the S&P 500 here. And what you're seeing is companies are having to borrow a substantial amount of money. That is going to be now interest costs that could have gone to dividends and share buybacks or growth CapEx. And I feel like, similar to coming out of the financial crisis, when it was a bad look for companies to be buying corporate jets, it's going to be a very bad look for companies to be buying back their stock and paying dividends if they're furloughing workers.
And John, I'm curious what sectors like right now, or what are you hearing from clients, those who are staying in the market or perhaps putting fresh money to work in this market? Where are they looking to do that specifically?
From a sector perspective, it's things that are resilient. Things that we really like right now are things like cell phone towers. We would also say that media companies, things like Netflix, are certainly meaningful beneficiaries. And our mantra has been meaningfully upgrading the credit qualities of our portfolio. So I think there is a strong bend to large cap quality names at this point. I would certainly be taking this opportunity, if I had any oil exposure, to be trimming into this strength here. I would be surprised if we actually get 20 million barrels cut. But even so, we're still facing very large oversupplied market. And I do think that oil is going to trade at cash costs sooner rather than later.
You know, John, maybe you could break this down for us. For companies that thrive on cheap debt, like you just mentioned, Netflix, what the Federal Reserve just did this morning, what does it mean to those types of companies?
Their borrowing costs are almost back to where they were before we entered this really challenging point in time. We're seeing such a strong snapback. I'm seeing investment grade bonds trading 50 to 70 basis points tighter than where they were yesterday. High yield bonds trading 5, 7, 10 points higher. While we're not fully back to where we were, we're getting there at a very rapid clip. And, you know, for companies in the high yield market, there has not been very much issuance. The investment grade market has really been where we've seen we've seen the issuance and where those companies will bear a little bit extra interest costs for a period of time. But it has been about liquidity in this market. It has been about surviving, this unprecedented time.
John, do you agree with Chairman Powell's assessment? We heard just a few moments ago that he believes that when we do come back from this, we can have that V-shaped recovery and that it will be, in his words, robust.
No, I don't. I think he's optimistic here. I think we are going to have a long U-shaped recovery. Again, I think we will recover, and I do agree that we will come out of this longer term robust. But adding this extra debt is similar to what we saw coming out of the financial crisis. Banks had to delever. I think corporations are going to have to delever. I think the consumer is going to have to delever. Their safety net has been evaporated over the past 3 or 4 weeks, and it's going to take time to build that safety net back up. And I think individual consumers are going to want to have a much bigger buffer in terms of savings. And I think corporations, I think investors are going to be focused on resiliency. It's not going to be just-in-time supply chains. It's about how resilient is your supply chain? How redundant are your operations?
All right, John McClain, portfolio manager at Diamond Hill Capital Management. Always good to talk with you. Have a good weekend.
Thank you.
Do stick around. We'll dive into the surging work-from-home platform, Microsoft Teams. That's straight ahead. Welcome back to Yahoo Finance Live. And certainly with everyone working from home, we all have been using new technology. Look, we're working from home right now. We're broadcasting live from our living rooms. And I want to bring in Jared Spataro, Corporate Vice President for Microsoft 365. Jared, good to see you this morning. I just talked with Levi CEO Chip Berg yesterday, and he said we just transitioned to Microsoft Teams. What are you seeing in the business? Right now, are you winning more big accounts?
Well, Brian, it's good to be with you, and we certainly have seen an increase of usage on Teams. A couple of weeks ago, we talked about our exponential user growth. We are winning new accounts, but we're also seeing people use Teams in different ways. Today, for instance, we announced that we have over 2.7 billion meeting minutes a day now going through Teams. That's a 200% increase from the 900 million that we announced in middle of March 16th. Total video calls have increased by 1,000% in the month of March alone. So a lot of usage on Teams right now. And we're really pleased to be seeing our customers use it to power their businesses.
Jared, Alexis here. Thanks for being with us. Talk to me more about how people are using Microsoft Teams, because I have kids who are online now because all of their classwork has gone online. Are you seeing this being used for educational purposes in a way it hasn't before?
Absolutely. We certainly see that people are hardwired for connection. We see that because of the way they're starting to use Teams differently. They're turning on video, as an example, more than 2 times the rate they were before the crisis. And we're seeing that it's being used for work and using Teams for education. We have over 183,000 what we call tenants. Each tenant has multiple schools associated with it, and remote learning in Teams is happening in over 175 different countries. So whether it's work or learning, we are really pleased to be able to help our customers to accomplish their mission, what's important to them.
Hey, Jared, Dan Howley here. I just wanted to ask you a question. We've been looking at Zoom and the controversy there with security. What does Microsoft have to offer as far as security goes and, ensuring user privacy and safety on the platform?
Well, Microsoft privacy and security are just never an afterthought for us. They're deeply woven into who we are as a company and how we think about building our products. So as an example, you get to decide who attends your meetings, and you have great controls for making sure that anyone who you don't want there leaves. We also, for instance, comply with over 90 regulatory standards and laws. That includes HIPAA, GDPR, FedRAMP, the things that are important to make sure that our customers trust us. So for us, privacy and security are just the foundation of what we do. It's kind of fundamental to the trust that we build and maintain with our customers.
Jared, can you give us an update on some numbers? Last time we heard from Microsoft Teams, mid-March, 44 million direct active users. Big number, big increase month over month. What's the latest look like?
We're not announcing an update on that daily active user count today. What we are announcing is this big increase in usage of Teams for meetings, 2.7 billion meeting minutes in a day. And I guess what I would say that's exciting about Teams is what we've also seen is that video conferencing alone, we're finding, just as people, isn't enough to get work done. In order to be productive, we have to not only video conference, but we also have to work in between the transactional video conferences we're in. So we're seeing an increase of people using it for video conferencing, for chat, and for collaboration. That's very exciting for us.
Jared, I just want to kind of get a sense of the countries that are using Teams now. And then, we mentioned work and we mentioned education. Are people using it in their off hours as well? Kind of like, virtual happy hours, things along those lines.
Certainly. Let's start a little bit with some country data that we found from this index that we ran. As we looked at countries with the most active Teams users, we saw, as an example, in Norway and the Netherlands, that they tended to turn on video the very most, with about 60% of their calls including video. But we saw a wide variation across other countries. As we look to the US as an example, here in the United States, people, for whatever reason, only turn on video 38% of the time. So we saw some wide variation. And then as we think about just how people are using Teams to get their work done, we certainly are seeing differences in the patterns for work. We pulled out some data from the usage of Teams that showed that people are embracing what we would call a more flexible work schedule. I think we're all feeling this work-life balance tension right now. And during the month of March, the average time between a person's first use of Teams and their last use of Teams each day increased by over an hour. That doesn't mean they're necessarily working harder or longer, but it certainly means that we're seeing some patterns and differences in that flexibility of work.
And Jared, how will the platform evolve? I think this week you released some new features. Can you highlight those and what's in the works next?
You bet. Well, of course, one of the great things that people like about Teams is that it's not just video conferencing. They love the integration across chat, meet, call, and collaborate. So kind of these, what we would call different modes of communication. And we have been responding to customers in this crisis and listening very carefully to what they want. A couple of things that have been really important for us. We are right now rolling out what we call custom backgrounds, which allow you to replace your background in Teams, whether it be with a blurred background or even with a picture. We also are allowing you to do what we call real-time noise suppression. So this will actually, for instance, filter out dogs barking or children playing. And that combination of custom backgrounds and real-time noise suppression is really powerful. And then finally, another one that's been important for us has been raising hands. In a large meeting where you might have a couple hundred people together, just in order to kind of figure out who's going to speak next. Something like being able to signal a raised hand is very valuable.
Very interesting stuff. Jared Spataro, Corporate Vice President for Microsoft 365. Thanks for taking a few minutes.
You bet. Good to be here with you.
From Microsoft's Teams to potentially using Microsoft Teams in the college setting eventually. I want to bring in Rhiannon Shade, College Wise. counselor. Rhiannon, good to see you this morning here. Take us through what you're seeing right now. Schools are shut down across the country. What does it look like in terms of college admissions?
Sure. Thank you so much for having me. What we're seeing, at least initially here, is that obviously colleges have gone remote. And in the admissions landscape, there's tons of pieces changing here with regards to testing requirements, with the SAT and ACT canceled now through June at least, and potentially beyond that. We're seeing students not able to meet requirements that would have been in place before. And so colleges are now waiving some of those requirements. And the admissions landscape is changing rapidly as more and more news comes out and we are in quarantine for a little longer than we probably initially expected.
Also, Rhiannon, I'm curious if some parents are voicing concern about making that first payment. I know the first payment for colleges is due, or at least a down payment, May 1st. Are some of them reticent? Are they saying, hey, look, we don't really know what the fall is going to bring. Do we want to dump a whole bunch of money here and not know what the value is going to be in just a few months?
Absolutely. So there's a lot of uncertainty here, and the traditional deadline for making that initial deposit is May 1st. We are seeing lots of colleges move to a June 1st date, although that movement is still picking up steam. It gives families a little bit more time to figure out and get a handle on what's going on here. But there is certainly a lot of uncertainty around the deposit, and just with everyone not knowing what's to come in the next few months, we are seeing students really think more carefully and longer about these decisions.
Now, given the situation, Rhiannon, have you seen colleges come out and say, hey, we're going to lower our costs to try to get kids to sign up for school?
Sure. I've seen a few colleges freeze tuition or stop planned increases in tuition. We haven't necessarily seen colleges lowering tuition just yet. We have seen some partial refunding or full refunding of room and board charges for the spring semester, and who knows what will come to in the fall if things continue.
All right, let's leave it there. Rhiannon Shade, College-Wise counselor, thanks for taking a few minutes today.
Absolutely. Thanks so much.
I want to get right back to Inez Ferre, who's watching the markets pretty closely. Inez?
Brian, just taking a look at some of the energy stocks that are soaring right now. This is because of that OPEC Plus meeting, which had started at 10 a.m. Eastern time. And there are reports that from Reuters that Saudi Arabia and also Russia have reached some type of a deal. And this could result in production cuts of up to 20 million barrels per day. So you can take a look at Apache right now, up 30%. And right when that news broke, you can see right around here is when the news broke with that Apache had the Apache stock soared. Then also taking a look at Murphy Oil, that's up 23%. And you can take a look at Continental Resources, all of these double-digit gains. And just taking a quick look at oil right now, we're looking at oil that's surging off its highs from earlier, but still up. We've got WTI that's up about 8%. Earlier, it was up around 10%. Brent crude futures up more than 7% right now. So really oil surging on the news of a potential deal between Russia and Saudi Arabia.
All right, thanks so much, Inez Ferre. And real quickly recapping the Fed and Jerome Powell saying he expects a fairly quick rebound. Unclear when that rebound will start, but do stick around. We'll dive much more into what the Fed exactly did this morning and the impact on markets straight ahead on Yahoo Finance Live.
Yahoo Finance on this Thursday, April 9th. We're watching a market rally right now. The Dow up 420 points, NASDAQ up 60 points, the S&P 500 up 51 points. The major headlines today: initial claims for unemployment, 6.6 million on top of what we saw last week. 1 in 10 Americans now unemployed. The unemployment rate could be as high as 15%. Part of the problem, GE announcing it's going to pull its financial forecast. It's laying off 10% of its workforce and plans to furlough 50% of its maintenance and repair workforce. Major news from the Federal Reserve. Total $2.3 trillion just from the Fed to juice this economy. According to Jay Powell, they are moving with alarming speed because of unemployment. They are lending, they are not granting money, and these loans, he says, will be repaid. Among the incredible moves, $600 billion in Main Street lending facility. This is seed money from Treasury, but the Fed will be lending this money to companies with employees of up to 10,000 people. They are expanding to a $500 billion loan facility to buy state and municipal bonds. And they're going to increase the TALF program up to $850 billion, and that will include the purchase of collateralized loan obligations. Secretary of the Treasury, Steve Mnuchin, on CNBC says if a business doesn't get a loan today, there will be money. And then finally, the number of coronavirus cases worldwide. 1.5 million, 89,000 dead here in the United States, more than 435,000 people testing positive, with more than 14,000 souls now gone. To discuss how we get through this crisis economically and then reopen this economy, joining us in a Yahoo Finance exclusive is Gary Cohn, the former director of the United States National Economic Council. Gary, it's good to have you here. And I got to tell you, with all of this incredible news, starting with the Fed, you had just, 2 or 3 days ago in the Wall Street Journal, you said that these were the kinds of steps the Fed might take, but you warned practices forged over decades at sovereign wealth funds offer lessons. Their model combines rigorous disclosure, independent oversight boards, and investment decision-making by professional staffs. What can the Fed learn as it now gets ready to lend in ways it's never lent before?
Adam, thank you so much for having me this morning. Look, we tried to make 3 really important points in our op-ed earlier in the week, and I think you just hit on them, but I'll reiterate them. Number one, the Fed is moving with just extraordinary speed, and they continue to do everything within their sights to help stabilize the economy. But they're moving into uncharted territory for themselves. They are now taking securities collateral that they've never taken. They're now in the loan origination business, something they've never been in before. As they move into these businesses, which is quite appropriate for them to be in, given the current state of economy, there's 3 basic principles that I believe and we believe they need to follow. A, they need to get a professional staff that knows how to originate loans and knows what commercially acceptable terms would be. Number 2, they need some oversight. And the good news about the Fed is the Fed is made up of many regional banks. Regional banks have independent boards. Those board members have been vetted for all of their conflicts. So the Fed could go pull people off those independent boards for an oversight team. And number 3, and almost most importantly, they need disclosure. The Fed needs to disclose to the public who they're lending to, the amounts they're lending to, and what the terms are. And as long as they follow those 3 basic principles, I think they're doing the exact right thing, and we'll all be better off for knowing what they're doing.
You know, you bring up some interesting points, but I remember in the financial crisis 2008, being at the White House when the first TARP program in Congress failed. The speed with which the Fed and Treasury are acting now is just months ahead of what we witnessed, 12 years ago. Are they rushing too fast with these extraordinary measures? I mean, they're going to buy municipal debt. That's never happened before.
They're not. They're not rushing too fast. You know, this is not the same events as 2008. This is a global pandemic. This is a healthcare crisis that is having a dramatic impact in the United States. We now have 97% of the population in the United States being told to stay at home. They're actually being told to stay out of the U.S. economy. They're being told to only buy the necessary goods that they need, which is basically food and other basic necessities, and don't go out and spend any money. You actually can't go out because the stores are open. So we're in essence being told to shut down the entire economy for the long-term good and health of the country, which is very important, and everyone's doing it, and we're doing it well. So when you literally put your economy into a dead standstill, the Fed has no choice but to act very quickly, and I think they're acting quite appropriately as well.
Gary, it's Julie here. On the oversight front, I want to ask you not so much about Fed oversight, but of the oversight of the congressional stimulus plan, because as you know, the president has removed the person who was first appointed to oversee the apportion of all the monies as part of that. What's your level of confidence that the oversight of that is going to be rigorous enough?
Well, Julie, look, there's two parts of the oversight. One, there's an inspector general, which the president has removed. But two, there's also a board. There's a 5-person board that was put in the CARES legislation. That board has yet to be appointed, but I think that board is also going to have a huge degree of oversight in what goes on with this money. The other thing that I'll remind people is outside of the PPP program, the Paycheck Protection Program, the vast majority of the money in that program has not gone out the door yet. So as far as oversight, there's not that much to oversight. Unfortunately, I wish there was more to inspect right now because more money had gone out.
And of course, part of the reason that the money hasn't gone out is because there have been a lot of problems with paperwork, with bureaucracy, with the banks not necessarily being ready or being overwhelmed by what, the influx of volume they've been getting, requests for that. So what can be done about that?
Well, so this is a really interesting conundrum, and one that is going to deserve a lot of discussion, and there'll be a large postmortem on this. But remember, after the 2008 crisis, we spent the next 2+ years regulating our banking system in the United States. And what we're seeing now is a lot of the potentially unintended consequences of the regulation of 2008. So banks today are very concerned about the size of their balance sheet and the size of their asset base and how many loans they originate and put on their balance sheet. Banks cannot just grow their balance sheet today because they've got leverage ratios that they have to abide by, and they've got capital stress tests that they have to abide by. All these things came into place after 2008 to make our banks safer and sounder. It's my opinion that we should relax some of these regulations in times of stress. Many of these regulations were put on in an unstressful period of time, and what our regulators need to do now is say, look, we're not in an ordinary time. We need to give banks more latitude on their liquidity leverage ratio and on their stress capital ratios, and then I think banks could be a lot more aggressive in lending out money.
Gary, it's Julia LaRoche. I want to get your take on how we can put the economy back on the path to get to where we were pre-coronavirus. What is it that needs to be done? What do you think the next fiscal package needs to look like? And just what are some action steps to get the economy reopened?
So look, this is going to be a long process. This is not going to be an overnight big bang. And much like how we got into the shutdown of the economy, it's going to happen incrementally. It's going to be very involved, and it's going to be different. Every state and every city is going to have to approach this quite differently, as they have in how we have told people to shelter in place, how we've told people to stay home. We've had a different path depending on where state you're in, what city you're in, what part of the country you're in. The mayors and the governors are going to play a crucial role in this. There will be certain cities and states that can open much quicker than other cities and states. So if you think of more rural states where people are, not as densified and they're spread out, those states will be able to open quicker than states where you're highly densified, where you're dependent on public transportation, where you're dependent on elevators to get people in and out of buildings. So I think what we're going to need to do is we're going to need to look at each of these cities, and we're going to have to evaluate them to what the risk is. Simultaneous to that, we're going to have a very robust testing mechanism to back up the reopening of the economy, because we're going to need to know very, very quickly if we get a resurgence in infection in the country.
Gary, I'm curious, you just mentioned a testing program, yet there's a report that the federal government may be cutting the money it's providing for testing. And it is the key, everyone says, wide scale testing. So what happens to make sure that we get that testing in place to go back to work?
I don't think we can go through a full-fledged reopening of our economy without testing. We would jeopardize ourselves going back into another full-fledged outbreak in the United States and then having to shut our economy down again. That would be the wrong answer. The right answer is to start incrementally bringing people back to work in a very thoughtful process. You know, big businesses are going to have to think of dividing their workforces maybe into eighths or quarters and say, hey, the A team comes in Monday morning, the B team comes in Monday afternoon, and then the C team comes in Tuesday, and the D team comes in Tuesday afternoon. But the Monday crowd and the Tuesday crowd never cross, because if someone gets sick in the A and B crowd, we don't want them to contaminate the C and D crowd. So, but if we don't have testing when someone starts feeling ill and we don't know what group to isolate, we're going to end up having to isolate everyone again. And we see the impact of having to isolate everyone. It's going to be the only choice is to isolate everyone.
Hey, Gary, it's Brian Chung here. So we see the Federal Reserve trying to kind of cover the hole on all these different markets that might be showing stress, whether it's U.S. Treasuries or muni markets as of today. I'm wondering, from your vantage point, just on, with your context on Wall Street, what's the biggest concern for you from a liquidity standpoint? And do you think that Congress should be maybe appropriating even more money to the Fed, since it already blew through almost half of the appropriated money today with the facilities that it announced? And secondly, what do you think they should be targeting?
So, look, I think at this point, the Fed has basically gone off after every asset class that we have except equities. And I'm not saying that they should go after equities. They are putting money into every asset class that really matters. They're already down into high yield corporate bonds. They're in investment grade corporate bonds. They're in municipal bonds. They're providing enormous amount of repo money for the Treasury market. And the Main Street lending program that they announced today is also very crucial. We shouldn't overlook that. Remember, we started with the small business plan, which was companies 500 employees and less. And then we had a large business plan, which the Treasury and the Fed will be giving out. That's the money that can be levered up to $5 trillion. But there was a gap in the middle. There was sort of a donut hole there. And today, with the Main Street lending program, the Treasury and the Fed have plugged that hole, where they'll now be able to lend to businesses between 500 employees and 10,000 employees. So at this point, I think the Fed has basically covered all bases that are obvious. That said, if something appears in another day or another couple days, the way the Fed has been reacting, they will go and provide liquidity for that as well, it looks like.
Gary, Julie again. So it seems like the Fed has done a lot. Congress has done a decent amount and is probably going to do more. It seems like at this point, it's up to science. It's up to the doctors. It's up to folks to do more testing, to come up with vaccine, et cetera. And Axios reported this morning that there may be some conflicts arising in the White House. They quoted a senior health and human services official as saying, talk of reopening the economy at this point is, quote, not just myopic, but flat out ridiculous. As someone who was perhaps no strangers to struggles within the administration, who do you think wins here between those who are pushing for a prompt, maybe even May 1st reopening of the economy, and the folks in the medical community who are saying, wait, we have to be much more measured about this?
Julie, what I think the answer is this is not a one-size-fits-all. They both might be right. When you look at the U.S. economy, we are a very large country. We're something like 4 million square miles in this country. I think we have to look at each of those square miles differently. So when you think of North Dakota, which has the landmass greater than New York and 700,000 people there, you're going to have a different economic trajectory than in New York City with 8+ million people in a very small, tight area where people have to ride subways and buses to get to work. So in some respects, we will open up certain parts of the country and certain parts of the economy much faster than other parts of the country and other parts of the economy. So in many respects, they're both right. It just depends how you're looking at it. I do not think there can be a big bang answer where we say, okay, today's the day and we're going to flip the switch and everyone's going to go from staying home and only buying essentials to going out to dinner and going to movie theaters. I don't think that's practical.
You know, it's interesting, though, Gary, because the metro areas like New York, San Francisco, LA, Chicago, something like a quarter of GDP generated here. You've said that all of this is a wake-up call for Congress. And you were part of the team that crafted one of the largest economic booms in U.S. history in recent memory. Would you go back to Washington? Have you been in discussions maybe with the White House about whether we need some kind of czar for some kind of U.S. Marshall Plan when all of this is over?
Look, I've been talking to anyone and everybody in Washington who has reached out to me, and I'm doing everything I can to be helpful to everyone.
Would you go
Gary,
back? No one's invited me to come back.
Gary, it's Julia LaRoche again. I just want to dig a bit more into this. What is it that gives you the confidence that the economy can get back on track? Because I'm just wondering if some of the habits maybe from folks within quarantine might become sticky. What is it that will help really jumpstart the economy, especially the consumer?
So look, we are a consumption-based economy. 80% of our employment, 80% of our GDP is consumer-based. That's the way we have built our economy. Now, look, that's going to change a little bit. One thing we have learned in the last 2 months here is we're going to have to get back into the manufacturing of strategically important goods in the United States. And I've been arguing that for a long period of time, that we've got to figure out what are strategically important and essential goods, and we have to incentivize companies to manufacture those here in the United States so we can take care of ourselves. But the U.S. is the U.S. population. We are basically natural consumers. We like to go out and consume. We like to buy things. We like to go out and be entertained. We're used to going to theme parks. We're used to going to movie theaters. We're used to going to bars and restaurants. We're used to taking our kids out for fast food and getting that stuff. And look, we've got a long history of decades and decades of living through different dislocations on our economy and consumers coming back into the economy at some rate and at some speed. I'm not going to sit here and tell you what speed and what rate they're going to come back, but I'm confident enough to know that over time, people will return back to their normal habits. I was having a discussion with my wife last night about, Disney and Disney theme parks. And, she believes, and she convinced me last night that people are going to go back to Disney theme parks. All the kids right now who downloading Disney Plus and watching those movies are going to want to go back and visit those characters and see those parks.
Gary, there's wanting to and there's being able to. And I think one of the other interesting trends of this pandemic, especially as we start to get more and more data, is how it's affecting underserved populations. So, for example, the death rate among African Americans is larger than in the greater population. We've seen, I'm sure you've seen the pictures in New York City of the folks who still have to go to work, who are packed onto the subway, in which what's clearly not social distancing. What is this going to do to the issue of income inequality and racial inequality in this country coming out of this thing?
Look, this issue was here before this pandemic. It's now being brought further to light because as we see where the disease is hitting and what groups are most affected, we're once again reminded of the inequality of healthcare in the United States and the inability to get healthcare in certain parts of the country. And I think this is another wake-up call for us that we've got to treat our citizens more fairly, and people have to have access to healthcare, and they have to have better living conditions. But this is not a new issue. This is an issue we've been dealing with for a long time, and this, once again, is another reminder of that issue.
Hey, it's Brian Chung again. I want to touch on infrastructure really quickly. It seemed like there was some optimism that the Congress could work on something before this phase 4 kind of really took on the form of just coronavirus relief part 2. I'm wondering if that's a role that you think should be being played as the Senate still tries to work through getting something done as we continue to see the economy kind of roil out of this.
Well, I think you all know I have been a huge advocate of infrastructure for the last 3 years. The United States infrastructure is in a dire state. And by that I mean, all we have done for the last 30 years in the United States is we have done maintenance on our existing infrastructure. No one has come up with a new master plan in the United States and said, what should our infrastructure look like? I think it is past time in the United States for us to sit down and say, what should our infrastructure look like in the United States and how do we get there? One thing that may come out of the coronavirus is people may demand different forms of transportation. So when I think of one of the things that's lacking in our country, and one of the things that I would pursue in an infrastructure bill is high-speed rail. So why do we have airplanes flying short-haul routes in the United States, sort of 350, 400-mile routes, Northeast Corridor, the West Coast Corridor, Texas, all of these, these hour and a half flights? After we've lived through this coronavirus, how many people are going to want to get on airplanes? Less people are going to want to get on airplanes, but more and more people would want to get on trains that are less densified, where you can bring fresh air into trains. So if we're talking about an infrastructure package where we're saying, how do we help our economy, how do we help our environment, and how do we help our people, I think that would be an enormously great boost to our economy and help our country out.
Gary, as we wrap up with you, I just got to say, I think some people listening right now may be wondering why you're not running for office. You've already served in the public domain. But, in this last question to you, we've all been, I think, pleasantly surprised with the speed with which Secretary Mnuchin has helped shepherd through the crisis and the measures to save this economy. If you could advise Secretary Mnuchin or the president, if you had that one phone call, what would you tell them?
So I think Secretary Mnuchin and the Fed and the president economically have done everything they should be doing. They continue to look at ways to provide income and liquidity back into the economy. So the programs that they have instituted so far are the right programs. The one thing I would wish and I would hope for is that the money could get out quicker. We're talking about another stimulus bill when I would guess, I don't have data on this, but I would guess less than 20% of the first stimulus bill is out. And I'm probably high at 20%. So I would like to see, 80% of the first stimulus bill get out and into the economy before we start talking about the second stimulus bill. But their intention could not be better. What they're trying to do is exactly the right things.
Gary Cohn is the former director of the United States National Economic Council. We appreciate your insight here on Yahoo Finance. All the best to you and your family, Gary.
Thanks, Adam. Thanks for having me.
All right, we are watching a rally on Wall Street right now. We're going to have more for you right here on Yahoo Finance after this. Back to Yahoo Finance. We are watching a rally on Wall Street, although the indices are off their session highs. A lot of news this morning, a lot of it coming from the Federal Reserve. But we want to welcome to the program Ryan Payne from Payne Capital Management. One of the things you've been telling folks are the four main reasons to buy into what had been a bear market. Can you go through that with us, please?
Yeah, well, I think there's a couple of things you have to think about here, Adam. I think first off is, look, valuations are a lot cheaper. We don't know exactly where they're going to land right now, but this is my third bear market, and I've got the scars to prove it. And whenever you get pricing that's this good, historically, it's always the best time to create wealth. I think the other thing you have to think about right now is just the dividend yields. They are going to come down a little bit. You're going to see some cuts, but the market's down a lot too. So if you look at relative dividend yields to what you're getting on bonds and cash right now, it's just a huge, huge spread. And whether you're a baby boomer who needs to retire, you're not going to be able to retire off a 10-year Treasury paying 0.7 or 0.8%, especially when you look at inflation. And even if you're in a millennial right now, dividends are going to be a huge part of your return long term. So I think that relative value right now, when you look at stocks, is just tremendously, it's a better deal than anywhere you can get in the bond market right now.
Hey, Ryan, it's Julie. It's good to see you. General Electric became the latest company today to withdraw its guidance and also said its first quarter numbers were going to be materially below where they just had guided them. I can imagine there are going to be more of those. A dividend yield perhaps is cold comfort if a stock's going to go down another 10 or 20 or 30%, right? So how do you sort of prepare yourself for this earnings season when we're probably going to get a lot of headlines like that?
That's a good point, but I think we got to remember now is the market's a discounting mechanism for the future, right? So I think a lot of the bad news is priced in, especially look at the oil sector. We've already seen, I think, one bankruptcy last week, but the market now in energy is actually going up a little bit. So I think what we have to remember here is the other thing about markets is they're very emotional on the upside and the downside. So not only is it a discounting mechanism on the downside, but it usually overshoots. So I have to think here a lot of that bad news, and you're going to see more bad news come out. That's one thing we know between coronavirus deaths. I mean, unemployment today was just abysmal, and the market's up today. Is market's going to get past that information a lot quicker. So I think as an investor right now, you really have to start thinking about the other side of this. I mean, Gary Cohn made some great points about you have to start thinking about how we're going to go back to work. Is it people are going to go in shifts and things like that? But at some point, invariably here, I mean, I'm hard pressed to think the economy is not going to get going again.
Ryan, it's Julia LaRoche. You just brought up some really good points. The unemployment, the initial claims that we saw today, those numbers. I guess though, when you're looking at the markets and then deciding on where you want to put money, how are you deciphering that? How are you taking into consideration who might be less or even more so impacted?
Well, I think first off, you want to do it diversified. I've talked a lot about owning indexes versus trying to pick specific companies, or even if you're going to buy a sector, buy the index right now, because invariably the cream's going to rise to the top, right? The company is the most well-capitalized right now, the ones that have the opportunity to take market share, because a lot of market share is going to be taken. If you have companies going bankrupt, you're going to have other companies that are going to benefit from that. So anything that's capitalization weighted, specifically with indexes, they're going to be the biggest ones when this actually is over right now. So we're definitely looking at doing it in a diversified manner. I think it's really hard to pick individual companies here. In fact, if you look at most money managers, not only do they underperform for the last decade, but during this pullback in March, they actually underperformed the indexes by like a percentage point. So they're not very good at picking the best place to be either. I think the other thing you want to think about too is with our portfolios, we're style neutral, meaning we own everything equal. The things that got hit the hardest are going to probably have the biggest rebound here. So for instance, energy is a great example of that. I mean, you were down to like $20 a barrel. Well, now you're like $25, $26 a barrel on a percentage basis. That's a huge move off the bottom. Other things like financials as well, which were down like 40% at one point, they're probably going to have the biggest bounce here. So it's hard, but they're the places you do want to be adding money. The stuff that gets hit the hardest is going to have the biggest rebound.
But Ryan, aren't you worried about maybe getting burned? Because with all of this easy money available for like Target Corporation, which you pointed out, raising about $2.5 billion in 5-year notes, they'll make it. But we're not going to be able to tell, some of those who should have gone away with all of that easy money and low interest rates out there. So can't you get burned?
You could, and that's why diversification is key here. Because if I'm Target, right? And I'm hoping some of these other retailers are going to go out of business, and some of them will. I don't think any of these bridge loans are going to save. I mean, Macy's may be here, might not be here, but that's a lot of market share that these companies are going to capture. Again, that's why I think doing it diversified here is critical. The thing with investing is you just have to be approximately right? Just buying in here during this dip, I have to think when you look back retrospectively is going to look cheap. Whether I bought it Dow 20,000, Dow 22,000, it's going to be kind of irrelevant. So I think being approximately right, the opposite of that is approximately wrong. We're trying to be exactly right, trying to pick the right companies that could go bankrupt. The opposite of that is exactly wrong. So it's kind of like horseshoes or hand grenades here. You just got to be in the perimeter.
All right, Ryan Payne, thank you so much for joining us from Payne Capital Management. When we come back on Yahoo Finance, we're going to check on what's happening with the Dow, the S&P 500, and the NASDAQ, but we're also going to bring you the latest from the front lines of helping people, how banks are helping through mortgage relief, and of course, the PPP. More after this. Welcome back to Yahoo Finance. We're watching a rally on Wall Street. The NASDAQ up more than 30 points, Dow up 360 plus points, and the S&P 500 up more than 40 points. We are all aware of the historic steps the U.S. government has taken to try and save small businesses. Now we're learning about what the Fed's going to do to help those mid-sized businesses. But the people who are going to have to deliver that money through these loan programs are the bankers in the country. And joining us from Webster Bank is the Executive Vice President, Head of Community Banking and Marketing, Nitin Mhatre. It's good to have you here, sir. We appreciate it. I wanted to ask you, your experience, let's start with the Paycheck Protection Program, the initial $349 billion. They're going to add more to it. That's what the Treasury Department is asking for. But your customer experience so far, what's that been like for your customers?
Thank you for having me, Adam. It is definitely a really good program that's going to help the businesses keep their employees on the payroll and help keep their businesses open. The program was launched on Friday, and it has had a significant number of changes, but I think the banks are ready to roll out the program. And just to give an example, for us, from last Friday itself, we have been able to take applications from almost 12 to 13% of our businesses that bank with us. And we are processing those applications as quickly as we can with the intent to give those funds in their pockets as quickly as we possibly can.
Nitin, it's Julie here. So it sounds like things have gone relatively smoothly for you all, but you said there have been changes already, right? And this is a very quickly changing process. What has the communication been like from Treasury and the other authorities, from the Fed, for example, as you've tried to work through all of this?
The communication has been good. I think the program rollout was a little bumpy, and the guidelines and the application forms and the notes have been coming as a rolling guidance. But the communication has been exceptional, and not just from the banking sector and trade associations like Consumer Banker Association and others. The lines of communication have been open, and we've been giving that feedback constantly, and they're reacting to that feedback. A program of this size is not easy to launch in a day. We recognize that, but we also want to make sure that we're able to fulfill the intent of the program and get the funds in the businesses' pockets as quickly as we can.
Nitin, it's Julia LaRoche. And when you're in the community banking business, you just have such a great read on what is really happening in Main Street America. We've seen the surveys of small businesses. We've seen the initial jobless claims numbers that are really stark. We understand that there's a lot of economic carnage when it comes to the COVID-19 pandemic. Just based on your conversations with your clients, can you give us a read of what you're seeing?
There is a significant amount of concern, and outside of the health part of the health crisis part of the concern itself, it's the concern around the economy. It's this concern about how do I make ends meet. As a consumer, people are worried about, hey, will I have ability to pay my bills? Will my credit get damaged through this process? The businesses are thinking about, hey, will I have a chance of surviving this cycle? And if I survive, what does my new business model look like? And I think that's where Webster Bank and community banks and pretty much all banks are trying to do their best to give that sense of confidence in terms of here's how you could keep your business alive, here's how you could manage your credit as a consumer, because when the other side of the cycle comes through, we want you to be able to be strong financially and get back into business.
Nitin, I want to shift this more to the homeowner, because part of what's going on is mortgage relief. Can you give us an idea about how many of your customers have had to request perhaps some kind of deferral on mortgage payments and how that all works?
Absolutely. And just to give you a little bit of history, Webster's been a bank since 1935, which was started right in the middle of Great Depression. So we were the only bank back in the previous recession that was mentioned as the only bank in the country that had a foreclosure moratorium. So this comes very easily for us. But this time around, it feels like there is good guidance coming from the states and the federal government around the foreclosure moratorium. So just to give you a scale, we've been able to help almost 7 to 8% of our customers already who raised their hands and said they might have difficulties making their payments. And we announced that in the middle of March, and customers have taken benefit of that already. And I think we also work with our state government and the Consumer Banker Association, Connecticut Banker Association, for a public-private partnership that announced not just a foreclosure moratorium for 60 or 90 days, but a 90-day grace period on the payments, no fees or charges for the next 90 days, and also making sure that people who participate in this relief programs don't have their credit scores impacted. So I think there has been a broad-based effort both from the banking sector as well as different state and federal levels.
What is all of this going to mean for you, the bank, financially? Because as you're funneling loans through, I wonder, for example, what your profit, if any, is on those loans. Mortgage forbearance obviously means that you have to then wait to have that money coming in. I imagine deposit growth has slowed, if not reversed, so you're not getting as much interest on deposits you hold. So what does this mean for you, and how poised are you to weather all of this?
Oh, there is significant amount of headwinds here, both with the interest rate environment where it is and this peculiar situation that we're dealing with. But in situations like this is when we go back to our roots and think about what our founder said, where he said, take care of our customers and everything else will take care of itself. So we're focused on doing absolutely the right things for our customers right now, and then think about what it means to bringing back our shareholder value to where we would like it to be. At this point of time, we believe the more we help our consumers and businesses get back to their feet quickly it will help us in the long run. So we're really focused on that part of it.
Okay, Nitin Mhatre is Webster Bank's Executive Vice President, Head of Community Banking and Marketing. We wish everybody at Webster Bank the best and a healthy future. When we come back on Yahoo Finance, we're going to check markets and also a programming note for you. Make sure to watch Alicia Keys' live stream concert from her home for Verizon's Pay It Forward live tonight. That's at 8 p.m. Eastern on Yahoo and Verizon's Twitter. More after this. All right, we're watching the rally on Wall Street here at Yahoo Finance. NASDAQ up more than 60 points, Dow up more than 420 points, S&P 500 up more than 45 points. We are all obviously working from home, broadcasting from home. I bet you've done a Zoom or a Skype or a Google Hangout situation. But our own Dan Halley saved me because my camera wasn't working, and he and our tech support, how to look at great while using your webcam, walked me through fixing the darn thing. Dan?
That's right. A lot of people, we've been doing this for about a month now, working from home, using webcams, and yet still most of us don't know how to do this properly. We still look like we might be in a ransom photo or something along those lines. So let's walk you through some steps to make it easier. The first and most important thing is lighting. When you're using a webcam, you want to make sure the light is on your face. So think of putting a light above your camera, on your desktop, on your laptop, regardless of what you're using. The light should be directly above you. You want to ideally look like this and not like this, where it's all dark. The other thing that you want to look out for is backlighting. So if you have a nice window, that might look nice behind you in your head, but in reality, you're just turning yourself into a silhouette and they can't see your face, whoever you're talking to. Make sure that the light is in front and that you're not silhouetted. After that, you want to talk about positioning. If you have a laptop, desktop, whatever you're using, make sure that it's about eye level. Your camera is about eye level with your eyes. So what you want to do is put it on top of anything. Prior to having a proper tripod, I had my laptop, believe it or not, stacked on a 12-can pack of Coca-Cola. So obviously anything will work. After that, one of the most important things to do is make eye contact with the camera. Look directly in the lens. Nothing breaks the immediacy of a webcam chat than having someone stare off to the left or right or looking down at the screen at yourself. Don't be vain, just look directly at the camera. After that, one of the things you want to look at is whether or not you have a decent background. You want something that is fairly plain. Adams is a fantastic example. Not too much going on in the background, but just enough. It looks great. I right now have just a few books to make people think that I'm smart. Those are props, by the way. I've never opened them. But you don't want something completely blank like you're taking a mugshot, and you don't want too much going on in the background. You don't want to have people walking by or just too much stuff, noise. People will get distracted with that. After that, if you're having trouble with your webcam on your laptop or desktop, think about switching to your smartphone. Believe it or not, something like an iPhone, the selfie cam on that is worlds better than you will find on your new MacBook or even on your old laptop or even on independent webcams themselves. So if you have something to prop up your phone, use that. Just make sure you continue to look right at that little camera. And finally, for the love of God, if you're not talking, mute the microphone. Nobody wants to hear dishes clanging in the background, your dog's barking, your kids crying, conversations that you're having with someone else, the typing of your keys. If you're not talking, mute. Everyone will love you for it. And that's just a little public service announcement for you. Adam, back to you.
Dan, I got more of these Studebaker posters if people need them. And just want to reiterate, light on your face, but as you said, and it's always true, position matters. Dan Halley, thank you very much. Want to turn our attention back to this economy and why what we're going through in 2008 is not the same, or right now is not the same as 2008. Anthony Scaramucci is a guest of this program frequently. He's going to be on Influencers, and you can watch the full interview with Anthony Scaramucci at 5 p.m. today on Influencers with Andy Serwer, brought to you by Verizon. Here's a bit of what he had to say.
The 2008 crisis seemed to be a dress rehearsal for the 2020 pandemic. And so for me, when I look at the magnitude of force that's going to be applied against this from a macroeconomic perspective, I'm not going to be able to time the market. Sure. Could it drop another 5 or 10%? Absolutely. But as you just said about the Warren Buffett essay, 6, 12, 24 months from now, will we be in way better shape than people would have expected at this time? I believe that that will be the case. And so for me, and I tell investors, you have to think long term, particularly in the stock market. You own that business. You're taking the ride over a market cycle. Don't get juked out of your stocks right here. It's never been a good idea to sell in a panic.
Welcome back to Yahoo Finance. The rally continues on Wall Street as we head towards 12 noon. Want to talk about taxes right now. Joining us as part of our Taxes Made Simple segment brought to you by TurboTax is Todd Simmons. He's the tax risk management partner with BDO USA and an adjunct professor with Rutgers Business School. Should also point out, by the way, that you are a former legislation counsel with Congress's Joint Committee on Taxation. So your creds pass muster. Want to talk to you, and it's good to have you here. All of this incredible lending that's about to take place to save businesses, are there tax consequences for people who might access the payroll protection program to save their business?
Well, it depends. The SBA is providing these loans. And of course, if the loans are used for the purposes that are really intended, which is payroll, certain utilities, mortgage interest, rent, what have you, there would be loan forgiveness. And that could have consequences. But if they're not used for those purposes, then of course they need to be paid back. So it really depends on what the business is doing with the proceeds.
In general, it's Julie here. Hi. What do people need to know when they're applying for these various loans or grants or what have you when it comes to the tax implications? Are there any tax implications?
Well, there could be debt cancellation if the loans are forgiven. That's always an issue with loans, and there could be interest expenses that they may have if they're repaying the loans. One thing they have to think about is to be very patient right now with the process as well, because it's very, very difficult right now to get through and to get these loans applied for and processed.
I'm curious, what's happening to Social Security right now? Because the program was already, on pins and needles. What's it going to look like going forward? What's going on with tax collections with Social Security?
Well, that's interesting. The tax collections right now are, I don't want to say to standstill, but I can tell you that IRS personnel are not working as they ought to be and as they normally are. So in terms of tax collections, I'd say that enforcement is down. The IRS has been quite public that they have delayed enforcement on certain tax collections, certain bills. In fact, they're delaying liens and levies for a period of time, et cetera. So, these are things that are just happening because of employees not being around. Social Security payments, I'm not hearing anything about any particular delays in those. So, that right now looks like it's continuing to work.
I'm a little bit outside baseball here, but because you do have experience with the Joint Committee on Taxation, do you expect Congress to rework the tax code once we start to emerge from the worst of the virus and try to get the economy back on track?
Well, there's several schools of thought there. There is I'd say a more immediate thinking that there could be additional tax legislation related to coronavirus. After we get back to normalcy, there is interest in both parties of doing continued tax legislation. There always is. And I think that even before the pandemic, the administration was talking about additional tax cuts and additional tax reform. The Republicans in Congress have one thinking, the Democrats have another. That's always going to be the issue in terms of whether and to what extent they're going to be able to do something. But there is continued interest in continuing to tax reform. Going back to 2017, when we had the Tax Reform Act then, both parties would say there's more work to do. And I think that that will be front and center.
All right. Todd Simmons, tax risk management partner with BDO USA and an adjunct professor with Rutgers Business School. Good to have you here on Yahoo Finance. Thank you, sir.
Thank you.
As we go to break and head towards the 12 noon hour, I just want to let you know that the rally continues. S&P 500 up 48 points. Dow is up more than 470 points. NASDAQ up more than 74 points. Even oil is trading higher as virtual discussions begin with OPEC. We have much more for you on Yahoo Finance right after this. And welcome back to Yahoo Finance. As we watch this rally on Wall Street, we want to understand what's driving it. And Jared Blickery does that for us. Jared?
Yeah, we got a broad-based rally underway. We can see the Dow is up over 400 points. NASDAQ is up about 0.8%. It is a laggard, tech underperforming today. And the S&P 500 up nearly as much as the Dow, about 1.7, 1.8%. And here is the intraday price action. You can see it was kind of a gap and go day, still holding these intraday lows that we have right here. And let's take a look at the week that almost was. We got 12 plus percent in the last 4 days of this week here so far. Got to stay tuned for the close, but not bad. Also going to check out the Russell 2000. That has been outperforming this week. That's up over 17%. And we also have a look at the 10-year T-note yield. That is up or down 3 basis points today, had been up a little bit earlier. And we got to take a look at crude oil because that has been a roller coaster ride. Lots of misinformation and information about the OPEC Plus meeting that is being held on a virtual basis. They're looking for 15 million barrels per day in production cuts, but not sure they're going to get that. The market is kind of doubting that, although it still is up about 3% today. Adam?
All right. Thank you very much, Jared Blickery. As we head toward 12 noon hour here at Yahoo Finance, stay tuned. We've got Diane Swank, the chief economist at Grant Thornton, going to talk about these incredible jobless numbers, the initial claims for unemployment, again, over 6 million. More right after this.
You're watching Yahoo Finance Live. I'm Julie Hyman. A lot of headlines to take you through, so stick with me here. We're seeing stocks rally today. The S&P 500 right now is up about 1.9%. This is the Federal Reserve announces new funding measures and the amount of a total $2.3 trillion in assistance to Main Street, to banks, to businesses. It'll take various forms, including the buying of municipal and some high yield debt. We'll be talking more about that. All of this as Senate Democrats have now blocked the next portion of assistance from the federal government, $250 billion worth. They want more money for things like hospitals and SNAP assistance. On the corporate front, General Electric becomes the latest to pull its guidance for 2020 after saying its first quarter adjusted earnings per share will be materially below the guidance that it recently offered. Also on the markets front, we're still watching oil. That's as we see Russia and Saudi Arabia conducting virtual meetings. The reports are that they have an outline of a production cut agreement. Oil has been surging today. And on the economic front, 6.6 million, that's the number of initial jobless claims being filed last week. So that number continuing to be at remarkably elevated levels. The current case count, according to Johns Hopkins University, of coronavirus globally, about 1.5 million, almost 90,000 deaths related to coronavirus. And here in New York State as well, we are looking at the latest numbers, the biggest increase overnight in deaths, 799, even as Governor Cuomo reports hospitalizations continue to go down. So a lot to get through over the next hour. I'll be helped by my colleagues, Adam Shapiro, Dan Halley, and Melody Hom. Right now, we're going to talk more about that initial jobless claims number in particular. For that, we're joined by Diane Swank. She is chief economist at Grant Thornton, and she's joining us via the phone from Chicago. Diane, if you can hit *6 for us, we can chat about those jobless claims numbers and their implications as well for the broader economy. First of all, 6.6 million, and this to me seems to perhaps, we're only going to see a trend higher because still a lot of folks are having trouble filing.
That's exactly right. One of the things that was really difficult was the upward revisions to last week. We've now lost over 16 million jobs in 3 weeks' time. That's, not far from when we look at the undercounting, the inability of people to file, also people who are now eligible, but their state websites have not been fully updated yet. They just weren't designed to handle the sheer volume of activity that they're having. We're probably well over 18 million. And if you think of what we saw during the height of the losses in jobs during 2008 and 2009, that was 8.8 million. So we're doubling that in the course of 4 weeks' time. It really gets to the sudden freeze the U.S. economy is going on and how rapidly things have done a U-turn and deteriorated quite sharply.
Diane, we watch historic measures taken to keep people afloat, but I'm curious, after we start to reopen the economy, what's the realistic picture? Can you help us see what it looks like putting people back to work? We're going to have 15% unemployment. How do we get that lower?
Yeah, that's really important. One of the key issues is, you don't just we turned off the spigot on the U.S. economy. You don't turn it on when it's still COVID tainted in the waters as rapidly. You have to be very cautious and methodical. One of the points that Chairman Powell made today was that you need a plan to open the economy safely. You want to stay home and stay safe and not give up all of what we've done to curb infection rates and to keep more people healthy and alive. That's very important as we reopen as well. Without a vaccine, we need testing, we need tracking, we need treatments. We need to know that the COVID virus is at least treatable in a reasonable way as we reopen. And also we're going to need protocols. So this is really a complicated process as we slowly reopen. And I think the other thing we have to be cognizant, and Congress has to be sort of be doing its multitasking here and continue to be quite awake at the wheel. And that is that many of the jobs that we had prior to the crisis may or may not be there on the other side of it, even as the economy regains some of its momentum. You can certainly understand that things like this have been an accelerant in the movement from, brick and mortar traditional retailers, which was already occurring, to online. Same to home delivery for groceries, same for delivery for food. And people won't be going out to the movies and getting a dinner anytime soon, even as we reopen the economy, to make sure that it is safe. And I think that's part of the process, is getting through that period, which is a slow ramp up, methodical ramp up, providing people with the means to keep the roof over their head and food on their table through this period. It's not just turn it on and everything's okay again.
Diane, Dan Howley here. I want to ask what you think the ultimate number will be of people who lose their jobs, and then what kind of impact will that have on the nation's GDP?
The real interesting issue is whether or not we really get the small business, which is important because we have already seen the need is greater than what we originally thought. Getting these small business grants, which will allow small businesses to rehire people, whether they'll be able to retain them past the September 30th date is still a question mark, but that will mitigate some of the layoffs we're seeing right now. So we're hoping to keep the net losses in employment to this sort of 15 million level mark. That is still stunning and staggering. But if we are able to temporarily at least put people back on payrolls again with these grants, that will help mitigate it. And then on the other side of it, keep them attached to their employers for at least some of them, after the dust settles a bit, to return to the work they once had work with. And I think that's a very important way of thinking about this. Some people will be able to return to their jobs, some people will not, and that's the hard part. But that's why these small business grants are so important to get out the door for everything from restaurants to companies up to 499 people, to be able to keep people on payrolls, not just unemployment insurance, but keep them connected to their original employers.
It seems to me, though, Diane, that there are some jobs, because there are requirements, of course, through these various loans, the PPP loans, that you keep those people on the payroll or even hire them back if you've already let them go by a certain date. But there's so much lack of clarity in certain industries that I wonder if that's going to leave a lot of businesses by the wayside, that they're not going to be eligible for these loans because they can't financially hire these people back if they don't know they're going to have a business 6 months from now.
That is a real hurdle, and it is. I think it's a real problem. I've talked to an enormous number of small businesses of all different sizes, from 30 people to the restaurants with 50 people, some with only 10. And how do they know what kind of level of employment they'll need? Now, if they keep the workers on, it is a grant, and that's important, so they don't have much to lose on that side of it. But then there's another round of layoffs we could see again in the fourth quarter, and that's what we're worried about, is that, even if they're able to go through and keep the workers on because this turns into a grant and they get it forgiven by the government, that's good until September 30th, but it doesn't determine how many workers they will need on the other side of this and how their workplace has changed. They'll also need to deal with the costs of compliance, of sanitizing workplaces to make it clean, having enough protective personal equipment to be able to protect people if you're serving in a restaurant. All of those protocols need to be put in place before we can safely reopen, and also we need to think of what it costs for many of these businesses to adhere to what are going to be a different standard of sanitation just to keep everybody safe and spacing. You can't have a really crowded restaurant for any time soon. You're going to have tables spaced out. You're going to have people spaced out. All of those kinds of things, of course, are necessary to slowly reopen, but they do have a consequences, as you rightly noted, on how many workers you may have as well and the kinds of workers you're going to need.
Diane, when you think about the recovery, earlier Gary Cohn was on our program speaking about the segmentation or further segmentation that we can anticipate even as workers go back to their offices, right? So there's the A team, B team, making sure there's no overlap. How do you isolate people even over the next year or so to make sure that you're mitigating any of those risks that we're seeing right now? How do you anticipate the definition of full-time work to look like? Do you think that there will be more and more shifts, even for white-collar jobs, sort of like the blue-collar world?
I think you will. I think you'll see it come out and manifest itself in different ways. We're learning what works and what doesn't. Obviously, working from home, as that's what all of us are doing at the time being, that are able to do that. That's a good thing because it also is giving companies sort of the limits and parameters of what is required to work at home. And so it may be separating shifts, not necessarily going through the night or around the clock, but also separating people by days, which odd numbers, even number days, how many people do you have in any given office? Those are all going to be important things to get into the pipeline now so we know how we're going to ramp up. And of course, there will be frictions even as we do this. This is something we think about as economists, that it isn't just a return to normal when the disease is still out there. We have to manage, not everyone's is vaccinated. We don't have a vaccine for at least a year, if not longer. And that's what the most optimistic forecast with a lot of companies out there with vaccines in the pipeline, hopefully, but it still takes a long time to do the kind of trials we need also on treatments. So I think all these things are important to think about. Is we're going to re-enter as the world thaws, as this deep freeze we're in. The world that we thaw into is going to be similar but not the same as the one we left behind.
A lot of adjustments yet to come. Interesting, Diane, you're the second person we've spoken to today after Gary Cohn, who talked about a new, perhaps staggered work schedule for folks. Diane Swank is chief economist at Grant Thornton. Diane, it is always good to talk to you. Be well, and thank you.
Be safe. Thank you.
Well, a lot of different companies have been attacking the coronavirus pandemic from different angles. I want to talk now about the applied health signals idea. It's a sort of a form of telemedicine. Dr. Jennifer Schneider is the president of Livongo Health. She is joining us from California to talk more about what her company does. So I know you all sort of coined this idea of applied health signals, basically where there is remote health monitoring. How are you all putting it into action? And are there applications right now for monitoring people for signs of coronavirus?
Thanks so much for the chance to speak. And first and foremost, our hearts go out to the people whom have lost loved ones in the setting of coronavirus. And we're incredibly grateful for the frontline workers, doctors, nurses, some of my friends who are on the front lines helping in this fight. Applied health signals and what we're doing at Livongo Health is an idea that we're able to remotely monitor the most vulnerable patients, people living with diabetes, high blood pressure, behavioral health conditions. And we're able to do this through our unique ability to capture data seamlessly. So our devices are cellular enabled. So wherever you are, safely in your home, you can check your blood glucose or blood pressure or get on a scale. And we're able to remotely monitor that, upload that to the cloud, and then perform some data science so we can give very specific recommendations directly back to the individual person living with the chronic condition. In the setting of coronavirus, that allows this vulnerable population to stay healthy, to stay home, and to stay out of the areas of infection. We know recently published from the CDC that greater than 78% of all people in the ICU with coronavirus had an underlying health condition, one of these chronic conditions. So this is especially relevant in this time.
Doctor, I want to ask, what real impact is there on folks who are diabetic or do have pre-existing health problems? I know that that's something that goes a lot into how you react to any kind of disease. But in this particular case, are you seeing anything that would point to this being worse than others?
So we know that people with diabetes, high blood pressure are no more likely to contract coronavirus. However, when they're infected, they have higher rates of mortality. We also know that these people living with chronic conditions, the severe isolation is doubly difficult for them because not only are they unable to exercise, have increased stress, but they're likely eating much more pasta. Most of us are doing that, right? The COVID-19, if you will, in terms of putting on extra weight. And so what we've seen from our member population is a 10% increase across the platform of conditions for which we're monitoring our members, as well as a twofold increase in number of members who are tagging that they're stressed. When you check your blood glucose in our solution, you're also able to tag a button that says, I'm also stressed. And we've seen that nearly double in this scenario. So one of the things that we've done at Livongo is make our behavioral health COVID-19 modules accessible not only to all of our members and all of their employees, but also nationwide. We know that this is very powerful and very important to do at this time.
And as you are rolling out all of these tools, I mean, obviously, even before this, you were sort of trying to shift the paradigm in terms of how people deal with their health without having to go to a doctor constantly if they have a chronic condition. How is that then going to be changed by what we're seeing right now? I mean, I guess it would be in your interest, in a way, for this to sort of be sped along by this process. And it seems like it's naturally going to go that way.
I think that's right, Julie. I think remote monitoring in many aspects was here. We have over 800 clients, hundreds of thousands of members for whom we've been monitoring remotely in the setting of these conditions. Coronavirus, I think, in many ways has accelerated remote monitoring as a healthcare delivery approach that is here to stay. And so remote monitoring was in existence before. We've built a great business on that. In this current setting, it was actually accelerating, and I don't think it will go away.
Thank you. Thank you so much. Dr. Jennifer Schneider is Livongo Health President, joining us from California. Be well. Thank you. Let's talk about what's going on. We've been talking a lot about what's going on in the markets. I want to talk about private equity specifically. Rel Rende is Clearsight Advisors analyst. He's joining us once again, as he has before, to talk to us about what's going on in that space right now. Rel, it's good to see you. What are we seeing happen in private equity, right? Because one would think that deals on the one hand would be drying up right now. On the other hand, our valuations coming down, so perhaps there are some bargains being snapped up on the part of PE.
Definitely. Thanks for having me on, Julie. And you're exactly right on both fronts. Now that the first quarter of 2020 is over, we're starting to see some of that data roll in. And as Axios reported just a few days ago, there was a decline from 2019 in both the dollar amount of M&A activity and the number of deals. And the private equity community has had a lot to play in that in terms of in the middle market funds who are dealing with transactions under $1 billion. There was actually a slight uptick in the dollar value from last year. What we're seeing is that a lot of these mega deals, these $1 billion plus transactions that some of the publicly traded firms are doing, have either been put on hold or have been delayed. And that's largely because they just can't borrow the money to finance these transactions right now. On the second point you brought up, it's true that distressed or opportunistic investors are going to be seeing opportunity through the dearth of demand to buy these companies, given that fast forward 3 or 4 months, there's going to be several acquisition targets on the market and buyers aren't going to be willing to spend. So while this is somewhat of a price correction in where multiples have been over the past year, we're seeing a broader continuation of a trend, at least on a deal metric basis, that we've seen for the past 2 years or so. One point was that if you're looking at 2018 to 2019, there was about a 10-15% decline in deal volume. But whenever you look at that to Q1 of 2020, you saw a very similar trend in the low teens. So while overall activity has been slowing down, largely due to the elevated valuations that you mentioned earlier, it's largely at the top of the market. These mega deals aren't happening anymore. While the middle market and lower market transactions, while they're not happening as often, aren't as affected as the top of the market.
Hey, it's Adam Shapiro. I was curious, what kind of, there's going to be distressed assets out there that at least private equity might think it's capable of turning around. Are you seeing any of that yet?
Not just yet, and that's largely due to the financing aspect. Julie mentioned earlier that the Federal Reserve is starting to put in this second layer of troubled asset relief funds out. They're basically lending money to the banks right now so that they can continue to lend to their clients. So while that's not happening yet, we do foresee that happening in the future. These investors in a truly downside scenario are probably going to have to pick which of their investments they want to put their effort towards and which ones they want to move into that distressed or opportunistic bucket. So I'd say fast forward 3 or 4 months, and that's when those opportunities are really going to be starting to come to market.
Of course, we've been speaking quite broadly here, but when you think about the segmentation or industries that seem particularly attractive right now, and I don't want to use the term, but it basically is vulture investing, right? When you think about which industries could potentially be benefiting, are you thinking it's biotech? Is it real estate? Out of the landscape right now, where are you seeing the opportunity?
So the real opportunity is on 2 fronts, because this drastic shift in our day-to-day lives that the coronavirus has unveiled has, one, created opportunities in any and all virtual technology products. So any company that works in the cloud virtualization sector, any company that deals with teleworking or any sort of remote communication is going to be seeing opportunity now because they're on the uprise. They have more users now than ever before. On the other hand, you do see some opportunity, particularly in consumer and retail. That has been probably especially hit. One, because of a lack of discretionary income on behalf of consumers, a reduction in their confidence in the future. Second, due to the skyrocketing unemployment claims. And third and finally, just because people aren't allowed outside anymore. They can't go to stores and buy products. So I'd say in those 2 sectors in specific, you're having one that's seeing a major uptick given an increase in users, and another one where those vulture investors, as you mentioned earlier, are really going to be seeking new opportunities given that those are still valuable assets when things get back to more or less normal. But right now, they just need to power through this tough period.
What role then is PE playing when it comes to restructuring? And again, maybe it's a little bit early to be having those discussions, but I'm guessing there are a lot of businesses that already need cash, and for one reason or another, perhaps the stimulus options that are available are either not right for them or not enough.
Yeah, I would not be surprised if the next 90 to 120 days saw an uptick in minority transactions and smaller deals where instead of a business selling all of itself, it's just selling a part of itself in addition to raise some cash to last for the next 6 to 12 months. Additionally, you're right that restructuring has seen this form of resurgence, particularly on the debt restructuring side. Right now, there's this cash crunch, and immediately after markets tanked a few weeks ago, we saw in our own business that our clients and the businesses that we were working with immediately pulled on their lines of credit. They were borrowing millions of dollars, and in the broader economy, trillions of dollars just to cover their cash expenses because they didn't want the bank to pull that financing. So as that begins to dry up, even with the Federal Reserve putting its resources there, those funds that are more flexible in either offering some sort of riskier debt to companies or offering minority transactions may see an uptick as well, as opposed to outright buyouts.
Aurel, good to see you. Stay well. Aurel Rende is Clearsight Advisors analyst. And as Aurel was just saying, some segments of the economy are doing better than others right now. One of those that's doing well is booze. We're going to speak to the CEO of Drizzly next. You're watching Yahoo Finance Live. I'm Julie Hyman. Well, for many folks stuck at home, they still want to get their essentials, and their essentials in many cases include wine, beer, other types of alcohol. That has helped push sales at Drizzly, the largest e-commerce site for deliveries of this stuff. It's pushed deliveries sales overall up 488%. For the last week of March. We're joined now by the co-founder and CEO of Drizzly, Corey Relis. He's joining us from Colorado. Corey, obviously these are incredibly huge increases in these numbers. Logistically, how are you handling all of this increased volume?
Yeah, it's a great question. Thanks for having me, Julie. I mean, this is a supply chain that hasn't changed a whole lot in 90 plus years since Prohibition was repealed. What we've seen is just a massive mix shift from on-premise drinking, bars and restaurants, obviously, to home. And what we've done is use our technology as well as partner with our liquor stores on the other side to effectively make them e-commerce distribution centers to keep up with demand. As in-store traffic falls, we really need to lean on technology to bring all of this together and be able to provide deliveries to the house and within 2 hours.
Hey, Corey. So I have to fully disclose, I used Drizzly a couple of days ago to send a bottle of champagne to one of my good friends who got engaged during this time of quarantine, which is bonkers. And she was complaining, she and her fiance were complaining that they didn't have any alcohol left as they've been drinking every day. So it was a very welcome treat. I do have to say it was actually reasonably priced and the delivery fee was quite low. So I tried to tip extra. What is the rev breakdown with the drivers, with the liquor stores, with Drizzly as a whole? And do you feel as though this is enough momentum and growth to really keep these liquor stores open on the other side of this pandemic?
Well, thank you for tipping extra for the delivery driver. I think that's a PSA message that I'd like to get out more broadly. To speak about the model, and I think that'll get into the fees a little bit, we bring liquor stores online and we allow consumers to shop across the different shelves, comparison pricing, access a larger selection than any one store, and then with the convenience of delivery on the other side. So there's no markup on the bottle itself. You're seeing the price of the bottle within the store. And then post that, there is usually a $4.99 delivery fee, which then goes to the store to pay for the cost of the delivery. The tip is up to you as to what you would like to provide for the delivery folks themselves. So there's not built-in margin into the supply chain. It's more about enabling liquor stores to come online, accessing consumers where they are, and providing a platform to do something that they really haven't done prior. Alcohol e-commerce is only 2% online coming into this crisis. And I think what we're going to see going forward is, can off-premise e-commerce keep these doors open long enough to return to some sort of new normal on the other side? We feel confident about it. Our numbers are supporting them. And at the same time, it's really going to come down to each store and how they embrace this moment.
I gotta confess, I recently used Drizzly for my wife and I, our anniversary, to get champagne and then some whiskey on the side. I gotta ask, we're talking about the cut that Drizzly takes. Is it just the $4.99 or is there something else in there? Is it similar to a seamless where there's been pushback from certain restaurants about the fee structure?
Yeah, so the $4.99 goes directly to the liquor store. And Daniel, don't feel like you must confess anything. I think all of us having access to a liquor store come to us is a good thing in a time like this. Where we make money is a software fee at the end of each month. So it almost looks more like a SaaS-based platform, less than 10%. And so really knowing the margin of a liquor store, trying to enable them for success is what we're about, because if they don't succeed, then Drizzly can't succeed. And that's really where the fees are what they are, and trying to just bring their shelves online.
It's Adam Shapiro. I was just curious. We're more red wine than anything else. Different parts of the country, what's the demand? What are people drinking?
Yeah, I think it's changed. And this is fascinating. You're going to see the personality of cities in the data. As we started to go into this moment, there was a lot of stocking up, and I think you saw a broad breadth of products being purchased. As it's sort of leveled out and we've kind of become accustomed to shopping from home, you're seeing more of the macro red wines, you're seeing rosé. And then I've also think you've seen craft beer, a lot of IPAs and easier drinking beers really take share in the past days. But overall, haven't seen too much of a mix shift versus what had been previously purchased before the crisis.
Corey, what happens when we're done with this and people venture back out to their stores? I mean, obviously that's going to create a certain lumpiness in your revenue. So from an operating perspective, how are you thinking, as much as any of us can, beyond this current period and what that's going to mean for the business?
Yeah, it's a tough one. And I think we're trying to have the intellectual humility to say, we don't know what's going to happen. Therefore, we need to be flexible on the other side. I think one thing is for sure, awareness for the legality of alcohol e-commerce has grown. Awareness for Drizzly, the platform, and why it is potentially opening up avenues that you couldn't do within a liquor store has grown. So I think there's a new normal there. What that new normal is, we're not quite sure. And at the same time, the technology is incredibly flexible to provide the experience for a consumer that wants something off-premise delivered, or as they walk back into the store, to be used as a tool to help them shop more effectively.
Corey, I have to ask, are you at all concerned, you're seeing this sort of surge during a health crisis. Are you afraid that you're contributing to additional sorts of health crises as people are drinking more alcohol, perhaps more calories in a day, and then of course those liver concerns?
It's the right question, and I can tell you one we're talking about intently internally. And so this is Alcohol Awareness Month. And so while we are providing a consumer good that is in demand, I think that needs to come with awareness. I think that needs to come with education and some messaging on our side to imbibe healthily and to think about how this can complement the good times in your life and bring this to the social aspect when we're largely distanced from each other, rather than something as a coping mechanism. So while we can't enforce that, largely how we want to portray our brand and help people through this time is much more one of social and celebration and being there for the moments that matter.
Corey, thanks for your time. Be well. Corey Rellis is the co-founder and CEO of Drizzly. Appreciate it.
Thank you for having me.
Well, coming up next, we're going to be talking more about getting educated at home at this time. We'll be speaking to the co-founder and president of Homer. You're watching Yahoo Finance Live. I'm Julie Hyman. Thank you for joining us as we see a rally in stocks today. The S&P 500 right now is up about 1.9%. The Nasdaq's gain, though, is just about half that. Oil has been surging today. Now, a lot of folks are home, of course, and a lot of parents are struggling with how to entertain and educate their children. We are joined now by Stephanie Dua. She is a co-founder and president of Homer, and she's joining us as part of our Women in Money segment brought to you by USAA. So Homer, or learnwithhomer.com, is a website that provides learning resources for children ages 2 to 8. Stephanie, there are a lot of resources out there, so I'm curious a little bit about your story of how you got started with this business.
Sure. First, it's great to be here. Thank you. I got started, I was previously the CEO of the Fund for Public Schools in New York City, working with New York City's 1.1 million kids. And one of the things we saw was that you could get pockets of great learning, but it was hard to scale that. So taking something that worked really well in a classroom, or even in a school, and thinking about how could you take that and spread that great learning all over the United States. And that was really the power of technology. So we thought, could you build a company that does good and does well and really solve an important education problem, but bring that to families? Because at the time, my youngest daughter wanted to help learning to read, and I had all these experts around me, and they said there really wasn't anything for families. So I thought it was a great opportunity to build something for parents.
Hey, it's Adam Shapiro. I was curious, you're in Miami. The Dade County Public School System is one of the largest in the country. Do you work in conjunction with school systems to create specific curriculum that you can then use in Homer?
Yeah, not yet. That is my hope soon. What we really do is we give it free to teachers. You know, we're really in the mission of serving families, and one way we can serve families is to serve schools who serve families. It's my passion, you know, is to get in there and help teachers who use the product immediately know the value. And they know, frankly, one of the biggest challenges, Adam, is that it's really hard for a teacher to personalize. So one of the great powers of this technology, and really of ed tech in general, is that we can get down to the child level and think about what does this kid need and how do we personalize their learning.
Stephanie, I think this crisis has really illuminated or exacerbated the divide between people who can have technology and access to even broadband internet, right? So I have a couple teachers who they can have as creative lesson plans as they want for their elementary school students, but their parents at home don't even have internet. So they have to go to their grandparents, perhaps for that couple hours to actually get some school time. How are you kind of bridging the gap here, or how do you anticipate for that chasm to be closed? Because I feel like it's really distressing to see right now.
Yeah, I mean, and it's a huge problem. It's a huge problem. And it's a problem, frankly, we've known about for decades now. And it's a problem that didn't really come to light in this way, this starkly until now. And so in many ways, it's important for us to acknowledge that and to rally our communities, the nonprofits that work in service of communities, the government, the schools, to figure out a mechanism to solve that problem. No one institution can solve that alone, but it is acute that it is that problem. And frankly, technology has an opportunity. If we can close that divide, technology has an opportunity to bring great learning resources to families all over. But it's an important issue that we haven't solved yet.
So Stephanie, right now, what kind of uptick in demand are you seeing? And if you say that if the teachers are the clients as well as the families, like how many new users have you signed up over the past month, say?
Yeah, so we've seen a 300% increase in signups and almost a 500% increase in engagement in terms of daily use, weekly use. So it's been extraordinary. We have an incredible team. We have incredible families that we work with, and we are really a direct-to-consumer business. Our teacher product is really free to teachers. It's really just to support teachers in the classroom, but our primary audience is families, and we've never seen greater demand. And really one of we've always known about the potential of learning, and in particular in the early years, one of the things most people don't know is that 85% of the brain development is before the age of 5, but less than 5% of the resources go towards that. So we really feel proud to be kind of part of that solution right now.
Stephanie, I got to ask, when you're doing something like remote learning along those lines, you kind of lose that one-to-one with the teacher. How do you ensure that that's still there and that every student gets the attention that they need?
Yeah, I think we're learning as we're going. I overheard my daughter, Isla, who's 10, her teacher, Miss Webster, asked this morning, what's the best thing about virtual school? I was curious what her answer was. And she said, the best thing is I get to spend more time with my sisters. So, who are teenagers who have very little time for her. So, you're right. I mean, the one-on-one in particular for the friendships, I think, for these kids who really rely on these social networks, for their social emotional learning, really. So it is something we have not cracked yet, but I think the teachers who are doing this on the front lines that I've spoken with are doing everything that they can to really have one-on-one time, small group time, as well as whole classroom time, using Google Hangouts, and Zoom.
Yeah, that's what my kids are experiencing too. And the biggest thing they miss for sure is that in-person interaction with their peers and their teachers. Stephanie, thank you for your time. Really appreciate it. Be well. She's the president of Homer. And we should let you know, for those of you at home who want to be entertained and have unique ways to be entertained, one programming note, you can watch Alicia Keys' live stream from her home for Verizon's Pay It Forward Live tonight. It's at 8 p.m. Eastern on Yahoo and on Verizon's Twitter. We'll be right back. You're watching Yahoo Finance. I'm Julie Hyman. We've seen stocks take another leg up in the past few moments. The S&P is now up by 2.1%, so we'll keep monitoring that for you. One of the themes that we've been exploring pretty consistently during this pandemic is what companies have been doing in terms of stepping up, helping their employees, redoing manufacturing to help with the effort. We're joined now by someone who has been paying a lot of attention to that as well. That's Rob Chestnut. He is Airbnb Chief Ethics Officer, and he's also the author of Intentional Integrity: How Smart Companies Can Lead an Ethical Revolution. Rob, thank you for being with us. You're coming to us from San Francisco. And so we have seen a lot of companies doing this right now. The fact even that a company has a chief ethics officer, though, speaks to a trend that was already sort of in place and growing even before this. What does the coronavirus pandemic do to that idea of stakeholder equity, of being an ethical company?
I think it puts it right on the front line. You know, integrity is not one of those things that's a luxury that you do, just when things are going well. I think a pandemic, a crisis like this, actually kind of pressure test your character as a company, because the world and your customers and your supply chain and the like, they need you to step up. And so I think the role of ethics is particularly important right now.
What companies were doing it well before the crisis? Because one would expect that they may be able to continue that.
Right. Well, Salesforce has a terrific reputation for doing good. Patagonia has really built a brand around doing things like that. So a number of companies, I think, have been increasingly recognizing over the past several years that there's actually a connection between doing good and doing well in the markets. There are a lot of studies show that companies that are perceived to be ethical are actually outperforming their peers in the marketplace. So you're seeing this trend of companies appointing chief ethics officers and thinking more and more about doing good, even when times are good. And then, of course, now when the need is greater, the focus is increased.
So Rob, right now, when you think about doing good, it's kind of hard to imagine without the capital, right? Because people are in such dire straits. When you look at Airbnb's business, I know you guys did secure that $1 billion investment from Silver Lake and Sixth Street Partners. I know $5 million of that is dedicated to a superhost relief fund. Can you explain as to how that fits into the bigger picture of ethics at Airbnb?
Right. Well, part of ethics is recognizing that you've got multiple stakeholders. So, it was interesting. Employees at Airbnb, actually, a number of them gave up their travel credits that they get personally to help Superhost in the community. Airbnb has also earmarked $250 million to help host to recover from the impact of guest cancellations during the period. So, you have to recognize that you've got guests, you've got hosts, you've got investors, you've got employees, and you need to be thinking about all the stakeholders during a time like this. And you can even think about the community. One thing, a small thing, that even if you don't have capital, you may be able to do some small things to help your community. We came up with the idea that, with all the offices empty all across the Bay Area and really all across the country, there are a lot of office snacks that are just sitting in office break rooms, going stale during a time like this. And so we came up with the idea, there are a lot of homeless shelters right now that need the food and families that are suffering. So we've actually put together an effort, and we've got so far a couple of dozen companies that are donating the unused snacks from their office building to help go to some of these homeless shelters. That's a great example of something that really doesn't cost any money, but it's a sign that you can still care about people in the community, even if your business is going through tough times.
Rob, this is Dan Halley. Your company was one of the big ones that was expected to, file its IPO this year. Where do you see that right now? And how much is this impacting it? And then how much will the presidential election impact that?
Well, those are all tough questions, right? And the pandemic has, actually caused a lot of rethinking. I don't know the answers to those things. Those are all things that we still have to work through and see how the course of the disease goes. Obviously, this is something that's had a tremendous impact on the travel industry, and we're going to have to sit back and take a look and see how the course of it goes and see how it impacts our future plans.
Rob, just thinking about the list of companies that you've actually been rating, it's a really fascinating list. You say Adidas and the U.S. Navy, not a company, are both receiving Fs right now. Zoom gets a C minus for their security concerns, even though there's some great technology. Where would you rate Airbnb? What letter grade would you give your company?
That's tough because there's something in the ethics world called conflict of interest. So I've refrained from giving Airbnb a specific grade. But I'm really proud of some of the things that they've done. They've executives at the company have taken a pay cut in order to, because I do believe that, Simon Sinek says that leaders eat last. I think leaders also have to sacrifice first in times like this. Airbnb also committed to paying hourly workers, the people who are handling security and janitorial and the like through the crisis, which I think is a positive step. And I think Airbnb has, again, stepped up, helping host and helping guests during the process. So I'm pleased with how the company has stepped up ethically during the pandemic.
Rob, I am curious though, what about before pandemic? Because Airbnb has not been without controversy on various fronts, including accusations that it displaces local people in some markets if you're having people just buy investment properties, and that you have sort of illegal Airbnbs that are rampant in some areas. As the chief ethics officer, how do you grapple with that stuff? And how much pull do you have with the leadership of the company in trying to get them to change some of their policies?
Right. Well, I've got quite a bit of pull. I've got direct access to all the top leaders in the company. I was the general counsel at the company for nearly 4 years before I took on this role. And it's something that Airbnb deeply cares about. Airbnb thinks of itself as having a number of stakeholders, including the communities where they operate. And Airbnb isn't successful if they're having a negative impact in those communities. So Airbnb has been engaging in a dialogue with leaders throughout the world, literally, about issues that particular cities may have with Airbnb's business, worked to help set up some reasonable regulations on the business. So I think the critical thing is the company recognizes that these things are an important part of doing business in communities around the world and is reacting to those concerns.
Rob, when you look at the potential for this to all finally be done with and people are able to get back to going to Airbnbs and having their places rented out, how do you ensure rentees' safety, people who are going out and renting, how do you ensure that they're safe, they won't contract the virus from someone's house that maybe hasn't been disinfected properly?
Those are all things that Airbnb employees are busily working on right now. And you'll hear more from the company about that in the coming days. Obviously a huge concern, right? Because guests have to feel safe when they go into these properties, and their health and their safety is of top concern to the company. So we're looking at it.
Rob, thank you. Rob Chestnut is the Chief Ethics Officer at Airbnb. Thank you for your time. Really appreciate it.
Thanks for having me on.
And coming up next, we're going to talk about what you've been doing when you're at home. Apparently, a lot more of you are signing up for Disney Plus. It has had a subscription surge. We'll be right back to talk about that. You're watching Yahoo Finance. I'm Julie Hyman. And we, of course, have seen a lot of things shut down by the coronavirus pandemic, including theme parks like Disney World and Disneyland. On the flip side, a lot more folks are signing up for Disney Plus. The company just announced it saw 50 million subscribers over the past 5 months. The shares, by the way, are up by nearly 5% today. Dan Halley's been watching this trend for us. I don't know how much that offsets some of the declines in other parts of the business, but for Disney, it's probably welcome news.
Yeah, I mean, almost doubling the amount of subscribers they had back in February. That's absolutely massive. And you got to imagine a lot of this is likely coming from not only the launches in Europe recently that they had. They did say that they were delaying in France because of issues with internet bandwidth capacity over there. But you got to think a lot of it has to do with parents that are at home with young kids, and they need to keep them entertained while they also work from home. So this growth, excellent for Disney, but you got to also, recognize that as productions are shut down on different projects across the globe, we might not see as many new offerings on this service going forward as we previously thought. So that could be an issue for Disney Plus. Fortunately, they obviously have that ridiculous back catalog that people can go through for years probably and not watch the same thing twice. So really impressive numbers here. Netflix still doing very well. There are some analysts who think that they're going to see a big bump because of coronavirus. But again, another company that might be hit due to production issues. I'm sure everyone's still watching Tiger King, though.
Yeah, and Dan, if you think about that narrowing window and that new strategy, right, where Onward, for example, was in theaters and then they were going to wait several more months to actually bring it onto the platform. We watched it a couple of days ago, right, just because the chatter was there. And Frozen 2, expediting that release online. I think Disney has a lot of power here, unlike Netflix, where there are a lot of familiar titles that people will gravitate towards no matter what. We've seen all the late night show hosts talking about how their children have watched Frozen 2 80 times in a row, and that's the only film they want to see. So there's definitely that there. And I need to point out that Disney Plus did roll out in 9 new countries, as I understand it, over the last 2 weeks. So this is not just growth domestically. This is a lot from India, from the UK, France, Germany, Italy, Spain, and a lot of these countries, as we know, have been hit hard by the coronavirus. So they're looking for ways to spend their time.
And in the long term, though, don't discount the theme parks reopening. We saw the story yesterday about the steps that Disney is going to attempt to take to safeguard people when they return to the parks. And we had a guest on the last 2 hours that said, look, people are going to want to go back to these parks. And the parks generated over $7 billion per quarter. I mean, it's the largest single generator of revenue for them. So you can't dismiss that.
Yeah, definitely not. Dan Halley, I also want to ask you about not just Disney Plus or Netflix, but all of the other things that people are doing at home on the tech side, right? You've got people probably ordering Rokus right now if they don't have them already, video games. What kind of commentary have we been getting from these companies?
It really is just off the charts as far as people trying to stay engaged or entertained, active, talking to their friends and family. And we're seeing that with these kinds of services, video games, you said, the jump there has been absolutely incredible. We know, I think last month or earlier this month, March has felt like a whole year, so I don't know what month it was. But we saw Italy actually said that the amount of people playing video games was causing a huge hit to their internet infrastructure. And that was when, around the same time, we heard that Netflix was slowing down bit rate. YouTube slowed down bit rates around the world just because so many people are online. It really is the only way that we can connect with people, even down the block, since we're stuck in our homes. I think the long term of this story is going to be, yes, it'll be kind of a bump for a bit, but I think we will see people stick around with these subscription services longer than you might have thought. So they'll end up having kind of a drop off after people are allowed out again, but then it will remain steady for a while.
All right, Dan, thank you very much. And thanks to all of my colleagues here at Yahoo Finance for joining me for the last hour. I just want to bring you up to speed on what's going on in markets here. We have had stocks bouncing around a little bit. It looks like they're now at the highs of the session. The S&P 500 right now up 2.4%, the Dow up 2.1%, the NASDAQ up 1.3%. We have been watching oil prices very closely today. That's because OPEC is holding a virtual meeting and is reportedly going to do so again tomorrow. A particular issue is the dispute that we have been seeing between Saudi Arabia and Russia on depressed oil prices. There are some reports out right now that they've come to some sort of agreement in principle, but it seems like there is nothing that is that concrete as of yet. That said, oil prices right now up by 1.4%. Now that is much smaller gain than we saw earlier in the session when they had surged as much as 7%. So we will continue to watch those headlines, but it looks like traders at the moment are not as encouraged by what they're hearing as they were a little bit earlier ago. We'll keep an eye on that. And just wanted to mention as well, we continue to monitor the developments on Capitol Hill about the next tranche of stimulus. You're watching Yahoo Finance. Keep it here.
Welcome into live market coverage here on Yahoo Finance. I'm Zack Guzman. Right now we have the Dow and the S&P 500 up by about 2.3%. Right now the Dow pacing for its biggest weekly gain since 1938. We'll keep our eyes on that. And it's an interesting move to wrap up the trading week because we have had our fair share of mixes in terms of bad news and good news today. I want to get started with the bad when we look at surging unemployment claims again, hitting above 6 million. We'll bring you those numbers, but not optimistic projections on that front. We also got consumer sentiment numbers just a bit ago, as that number, the reading we got this morning, sinking to a 9-year low, showing the largest monthly drop on record. We also got plans in Washington, D.C. Skidding as the Senate was blocked. Mitch McConnell's plan to add about $250 billion to the $350 billion set aside for small businesses, that got blocked. And that is on pause until what looks like to be Monday. So you could be asking yourself, with all that bad news right now, why are stocks up more than 2%? And the reason being, enter Chair of the Fed, Jay Powell, yet again. We got news out of them, including an injection of $2.3 million in a boost to a Main Street lending program, as well as backstopping that PPP program I was just discussing that has paused right now in the Senate. For more on the reasons why the Fed continues to boost its program, though, I want to get to Brian Chung, who has the details in regards to the Fed's latest actions. Brian?
Well, Zach, just a small correction, not million, not billion, trillion, $2.3 trillion from the Federal Reserve that it announced earlier this morning. This is going to be used for local businesses and also for local municipalities for the first time. The Fed announcing that it will set up a municipal debt facility to buy debt from local municipalities of up to 24 months in duration. So this should provide some relief to these local municipalities that are worried that with an essential freeze on tax revenue, they might not be able to meet a lot of the funding shortfalls that they're facing as they try to wrap up their budgets digits. But more importantly, the Main Street lending facility was something the Fed announced today. They had previously announced an intention to open it up, but provided more detail, saying that it would have a $600 billion facility backed by money from the U.S. Treasury. Keep in mind that the CARES Act passed from a few weeks ago appropriated $454 billion to these types of facilities. And in total today, the Fed blew through about $195 billion of that money. So it still has a little extra money that it could tap into if needed in the future to provide further liquidity. One other thing worth mentioning, a small little wrinkle in the previously announced primary and secondary corporate credit facilities. The Federal Reserve announcing today that they would be expanding the scope of those facilities and the size of those facilities to not only include more money and more purchases, but to also include those that are slightly below investment grade, what they call fallen angels, those with a double B minus rating. One example being Ford, for example, would be a type of company that would see some help under this type of facility if it wanted to sell some of its debt to directly the Federal Reserve. So all of these things really encompassed in the market movement that we saw today, despite the pretty terrible print that we saw in jobless claims, Zach.
Yeah, I mean, and we heard from Jay Powell, and yes, you're right, $2.3 trillion, the main number here, and we think about all of these things getting put together. But you look at these lending facilities, and if you add these last three, I believe that we're now past 10, right? I mean, by my count, we also heard from Fed Chair Jay Powell this morning talking about why he's going to move, why they've done all of this, acting forcefully to make sure that the economy still is able to recover when we move past the shutdown that we're seeing right now. And I think, you know, based on what the market action we're seeing right now, more and more investors starting to believe that the Fed is actually doing everything in their power to make sure that happens.
Yep, it's 9, 10 if you double count the Main Street lending facility, because technically there are two. So that is definitely indeed the case. But Chairman Powell speaking shortly after that $2.3 trillion announcement in a pre-scheduled webcast with Brookings, he used 3 adjectives to describe the Fed's actions today. He said they are forcefully, proactively, and aggressively using their emergency tools right now. Interest rate policies are not the main way that the Federal Reserve is trying to address the economy right now. They are really doing that through these types of liquidity facilities. And again, the Federal Reserve time and time again trying to remind everyone out there that the Federal Reserve is not out of bullets, and especially when you consider the monetary implications of the money that was appropriated to them by the federal government through the CARES Act. The Federal Reserve did not even use half of that number in the announcement today. Keep in mind that the $2.3 trillion figure is a multiplier of the amount of money that was appropriated through the U.S. Treasury. The Federal Reserve says its liquidity facilities can lever up 10 to 1, which means that the Feds could still do more. The question is, where does it see the need to provide that liquidity? And in the future, where will it direct it?
Yeah, and I mean, we keep getting the updates as to why the Fed needs to up its defense here. Just today, again, we got unemployment claims surpassing even the already bleak expectations that were out there. Economists were expecting yet another tough week. I want to get to Heidi Chung with the details on that. Heidi, it looks like more pain and more jobs lost.
Yeah, Zach, the COVID-19 pandemic continues to hammer the U.S. economy, specifically the Labor Department, as we learned earlier this morning. Fresh data from the Labor Department showed the 3rd consecutive week of jobless claims in the millions. The number of Americans filing for unemployment benefits surged another 6.6 million for the week ended April 4th, and consensus expectations for that week were for 5.5 million claims. The prior week's record-breaking figure was actually revised higher to 6.9 million from 6.6 million. So over the past 3 weeks, more than 16 million unemployment insurance claims have been filed, and continuing claims represents Americans currently receiving unemployment benefits. That number jumped by 4.4 million to a record 7.46 million in the week ended March 28th. So looking at the states that reported the highest number of claims last week, topping the list, California again seeing the highest number of initial claims at an estimated 925,000 on an unadjusted basis. Coming in second, we had Georgia with an estimated total of 388,000, Michigan with 385,000, and New York reporting specifically, people in Florida and Texas are having a really hard time filing claims. Of course, those two states are the most populous here in the US. I also do want to bring to your attention that it's not a very perfect indicator, but Google searches are very, very high still for the phrase unemployment benefits. It peaked actually on March 30th and has since come down from those highs, but it's still at a very, very elevated level. So if that is to believe, we still have more pain ahead for the labor market, Zach.
Yeah, and that's true. I mean, I was looking back. You can look at the numbers week over week. We've been tracking that. But if you look back to the percent change we got this week versus before all of the lockdowns really started to take effect in the last week ending March 14th, you look at these percentage jumps for some of these states. Michigan, the largest over that time span, up more than 7,000%, which is just insane to try and comprehend here. Georgia, as you mentioned, Heidi, still showing up on that time period as well. Alabama, New Hampshire, Virginia. Interesting to note, though, that we did see, you would expect California and New York to be the top two when we think about populous states in total number of claims, but interesting to see Pennsylvania surpassing New York in total jobless claims, which is something that you might not expect as well, but just kind of goes to show the way that these economies can be levered to jobs that might not be able to just work from home as we continue to track which states are hardest hit. For more on this, though, and how it pertains to the market action we've been seeing play out, interesting moves there, and potentially an all-clear sign from one of the largest, loudest bullish voices that we have on Wall Street. And he joins us now. Tom Lee, FundStrat Global Advisor, Managing Partner and Head of Research, joins us on the Google Hangout. And Tom, interesting that you've been tracking the way we more quickly than ever really kind of fell into this bear market when you look at history. And you're saying that that's reason to believe that the upside rally, actually getting back to where we were before all this started, should also be relatively quick as well. What's the level that you're watching right now? And should investors be buying this as something more than just a bear market rally?
I think investors should realize that the stock market is discounting information. So we can't tell it what to do. And the fact that it recovered 27.93, it's a big deal because that's a 50% recovery of this crash from February to March 23rd. And if you look back at 1987, 02, or even 08, 09, when the stock market had recovered half of its losses, it was already deep into a bull market recovery. So I think the move today is pretty decisive. And I think it just shows you the playbook that you have to use right now is not your common sense. You can't say, oh, well, everything's gonna be bad, so everything has to go down. At the end of a downturn, the stock market recovers way before fundamentals turn. So I think that's what your viewers have to keep in mind.
Yeah, I mean, that's kind of the counterintuitiveness of what you're raising here, right? Because you would think, all right, if we're so quick historically to come down, you think about peak to trough. The S&P 500 was off, 33% in just a matter of weeks here, right? When you look at it, I mean, you would expect, oh man, things must be bad. We're seeing record unemployment numbers here. So things are terrible on a historical level. You would think that it would need to take even more time to recover, but that's not what you had predicted. When we were back towards that bottom, you went back and looked at the data and said, all right, we fell over that time. It was 6 weeks. Therefore, recovery should only take about half that time if you look back in history. And now here we are, basically 3 weeks of the day later, and we're back at that 50% retracement level. So what does that say here about how we might look in Q3, Q4 later on in the year?
Yeah, well, I think it's important. I think you're bringing up a good point. A few weeks ago, we looked at the 10 declines really in the last 2 centuries of 30% in the stock market. And there's a lot of symmetry, so the speed that you fall tells you how quickly you recover half your losses and actually how long it takes to recover your full losses. And back then, it said if you fell over 6 weeks, you'd be back to 2,800 within 3 weeks, which really shows history is really still a good guide. That same model says we should be making all-time highs in roughly 3 times the amount of time it took to fall, which means if we fell over 6 weeks, sometime in July, August, September, we may be back at all-time highs. And I know it sounds insane, and I know everyone's rolling their eyes, but you know what? We've already recovered half the losses in what was really what history says should have taken place in 3 weeks.
And that's kind of, I mean, it's insane to hear now, but this is after we've already kind of rallied back here, right? And that's kind of the other crazy part of this, is that you made that call that it would play out exactly this way, basically when we're at the bottom, right? If that is the bottom to play out, I mean, that would have been even more insane to think about it. So, I mean, I guess that would only make you a little bit more confident in your call that we would get back to all-time highs, as insane as it sounds, by Q3 here. But, I mean, technicals aside, what fundamentals underlying all this would make you even more confident in that too? Because we keep seeing, as we just mentioned, record unemployment claims. What kind of would be the impetus? Is that to say the Fed's actions are clearly enough to overwhelm that?
I think there's several. I would say I can think of 5 reasons this is happening. So again, I'm not trying to tell the stock market what to do, but I'm saying the stock market is telling us a fierce recovery is probably coming. And I think a couple of things that are really important to keep in mind. Number one, I do think we're undershooting on the healthcare crisis. I mean, the deaths are coming in far lower than expected, and we're peaking a lot sooner. And remember, the faster we end the crisis, the faster we can get back to work. I think another important thing to keep in mind is, and this is a tragedy, but if you look at the income effect of the claims that have been filed and the categories, so far it's about 0.3% of total personal income. Even though it's 16 million claims, it's a tiny fraction, because you remember, we have an unfair economy. There's just so many rich people. The income effect is quite small. The third thing to keep in mind is labor-intensive businesses are really easy to restart. A restaurant, if it already has its lease and it has its equipment and it already has its approvals by City Hall, I remember Chipotle can open restaurants quickly, then rehiring people can be really quick. So I think that the stock market's telling us that the economy is going to be pretty V-shaped. And look back at every bottom, 87, 09, 02, 74, stock markets bottom before jobless claims peak. Stock markets bottom before consumer sentiment bottoms. It always bottoms. It bottoms a year ahead of GDP. So if the stock market's rallying, instead of saying, oh, everyone's really crazy, and they might be, I just think it's telling us we've already discounted the worst.
Tom, it's Heidi here. Not to play devil's advocate, but if we're taking a look at certain aspects of the market, specifically the small caps, I mean, they've had a pretty good week, but for a while now, they've been underperforming the broader market. And a lot of folks look to it to sort of find direction with where the economy is going. So in that case, is it necessarily saying that there's a V shape ahead?
Well, small caps are correlated to really 3 markets. One is high yield. I mean, high yield's really, really tough right now. So if I had to say, what is your risk of being too constructive? High yield is tough, but it's getting help from the Fed. The second is emerging markets, has a high correlation to small caps. And emerging markets isn't going to go anywhere until the U.S. turns back on. And the third is that, small cap stocks aren't as strong as U.S. blue chips. I mean, these U.S. S&P large caps, they're just going to be bigger winners after this, right? I mean, after this, more assets are coming back to America. U.S. consumer was strong before. They're not taking as big a hit as people think. They're going to come back strong. And then, I actually think the stimulus came really lightning quick, which is so good. And, I think policymakers have done a pretty good job. And that's a big deal. That they usually so late in a cycle, they're coming in really early. So maybe this is showing you policymakers can stave off a deeper decline.
Yeah,
but I don't know.
Real quick before we let you go too, I know we highlighted your note on the show on Tuesday, looking at some of these companies, specific stocks that had been hit the hardest, and those might tend to be the ones that would rebound the quickest as well when we're thinking about this. And you mentioned labor being a key element of that. And when you look at the restaurants, I mean, a lot of those were the epicenter of where the pain was. You can look at Darden Restaurants as a key example. If all of what you're saying is true, are you still convinced that those would be good places to put your money despite all the risk if that doesn't come to fruition?
Yes. So I think that people need to use the 08 playbook, which is they have to run into the fire and buy the epicenter of the crisis, because social distance victim stocks didn't do anything, and the government and policymakers aren't going to punish shareholders for that. They got hit the hardest, but they're also beneficiaries of high unemployment because labor cost is the biggest expense for them. As you pointed out, like Darden or Gap, they might have like a $30,000 market cap per employee. So if they can actually rehire skilled people at lower cost, it accrues hugely to an equity shareholder. Just a 2% reduction in salary in rehiring cost is like 10% to the equity. So it's a big deal. And again, I'm not trying to be insensitive because I'm actually probably sounding insensitive. I'm saying that in 08, you had to buy what got wrecked. And what got wrecked in this cycle, it's the hotels, casinos, airlines, the aerospace. These are going to be better companies on the other side.
And as you point out, a lot of that has to do with the fact that the government was quick to bring in aid here too, to hit some of these companies and make sure that they are able to function as well. But Tom Lee, I mean, right now, at least as it stands, we look at that retracement level, what you called, we're sitting there right now above it, 2,800 on the S&P. So we'll see what happens with the second part of that call, potentially all-time highs by Q3. But for now, accurate as you are. Thanks again for coming on. Appreciate it. Always.
Yeah, thank you.
All right,
have a great
Tom.
weekend.
Yeah, you too. Coming up after the break, we're going to be discussing the way that the consumer has been holding up through all this as consumer sentiment, again, drops by its largest point move in history. We'll discuss how they're changing the way that they're shopping when it comes to their online baskets, the details that Adobe has right after the break. Welcome back. The state of the U.S. consumer is in focus today, and we got the latest reading in regards to consumer sentiment out of the University of Michigan Consumer Sentiment Index, that falling from 89.1 in March to 71 in the preliminary April report. That also disappointed forecasts as bleak as they were heading into the reading that we got today. Keep in mind that that drop month over month is the largest drop on record. It's also the lowest figure that we've got in terms of sentiment since late 2011. And it's raising a lot of questions about how the consumer is shopping in times of uncertainty. And of course, a big piece of that has been a surge in the way that they've been shopping online. And Adobe's been tracking that through its Adobe Digital Economy Index. That's the real-time barometer of the digital economy, analyzing trillions of online transactions across 100 million products and SKUs in 18 product categories. And for more on that, I want to bring on John Copeland. He's Vice President of Marketing and Consumer Insights at Adobe. John, thank you for taking the time here, man. When we look at the numbers specifically, though, what's jumping out to you in the shift in the way that Americans are shopping online, and maybe some products that they might not have figured would be something you'd want to buy online?
Yeah, hi, Zach. Thanks for having me on. Really appreciate the opportunity to talk about what we're seeing consumers doing digitally. And as you might imagine, right, with stores dramatically shut down, with all the social distancing going on, consumers are really turning online to try and make up for a lot of what they might otherwise be buying offline. I mean, we've seen, even in the past 2 weeks of March, for example, a 38% increase in totality of online shopping in the US relative to the first half of the month. So it's growing over time. It's actually a really important time for companies to have a strong digital foundation as consumers are looking to reach out through these channels. One of the things that we're seeing, as you might imagine, is a huge increase in what we call buy online, pick up in store. So people still want to be able to go to the nearby store to pick up the goods, but they want to basically purchase it online, know that the inventory is there, know that it's going to be available. And you see a lot of retailers actually also offering things like curbside pickup and other kinds of customer experiences to reinforce, the essence of safety, disinfecting, cleanliness, et cetera. So you see a lot of that going on right now.
Yeah, I guess that would kind of support some of these stores that had put in the efforts ahead of time to make sure that they did have a buy online, pick up in store option. And we've talked about that so much when you compare Target and Walmart and the efforts they've done there to maybe some of the other big box stores, because we saw a surge for those warehouses, even store visits, not even just buy online, pick up in store, but just straight up visits to a Costco or a BJ's Wholesale. So, I mean, how does that kind of impact the way that some of these stores might be thinking about boosting offerings to consumers, maybe whether or not they should be focusing on key categories, since groceries, cold medications, and computers continue to be some of those products that consumers are looking for right now?
Yeah, no, it's a great question. And I think it, not only big box retailers, but even specialty retailers whose offerings are particularly relevant right now with people stuck at home. So, you mentioned computers, and they were up 40%, in the last 2 weeks in March. But we're also seeing things like even fitness equipment. People are buying more fitness equipment online to have at home, right? You can't get into the gym. So you might as well have that equipment ready for you in the house. So the last part of March, we saw a 55% increase in orders for fitness equipment online. Some of the categories that perhaps aren't performing as well, we're seeing sort of the average online apparel store decrease by 13% in sales over the past few weeks, the last 2 weeks of March. But as you were saying, right, categories like virus protection up over 800%. It's crazy if you can even find. So, a good option might be thinking about supply chain, right, for these retailers. How do they make sure these really hot products right now are in stock and readily available?
Yeah, and the last point, too, that I just want to raise from your guys' report was looking at the digital purchasing power for a lot of consumers out there, how much farther their dollar is going in relation to what we've seen in the past, and how that kind of maybe is a key piece of why, obviously, there are reasons why they would be shopping online, but why it could make even more sense now.
Yeah, absolutely. And I'm glad you asked the question. We created the Digital Economy Index almost as a counterpart to the Consumer Price Index, right, which looks at things more kind of holistically across online and offline. But the Digital Economy Index that we have at Adobe is the only thing that's actually looking at actual purchases, right? Because we have visibility into those trillions of visits over the hundreds of millions of products and the thousands of retailers across the US. And we're increasingly adding more countries to this. So we can give consumers, companies, and policymakers real-time information on what's moving. And specifically to your question, year over year, there's been a 3% increase in consumer purchasing power online. But if you go as far back as we have data, which is basically 6 years ago, there's been a 20% increase in consumer purchasing power online across the last 6 years at a total category level. Some categories a lot more. So electronics and apparel, the purchasing power has actually increased even more. Other categories like grocery, right? There's fewer product innovations. It's a thin margin business. There hasn't been necessarily that same level of increase, but on a weighted basis, 20% over the last 6 years, 3% over the last year.
Yeah, even more reasons to be shopping online if you can get some good deals out there. But John Copeland, Vice President of Marketing and Consumer Insights at Adobe, thank you so much for bringing us that.
Yeah, my pleasure. Thank you.
All right, well, coming up after the break, we're seeing Disney stock catching a boost here, up by about 5.5% right now after reporting some impressive numbers for its streaming service. More on that and how teens might be shifting to Disney Plus and Apple TV over Netflix right after the break. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman, and right now we're seeing stocks continue their rally to wrap up the week. The Dow and the S&P up more than 2.2%, heading for one of their largest gains. The Dow is since 1938. We'll continue to track how it's gaining today in the afternoon trade. Right now, financials, the biggest sector, gaining up more than 6%. We'll keep an eye on what happens throughout the hour and beyond. But right now, we're also tracking Disney shares up by about 5.5% after announcing some impressive numbers for its Disney Plus streaming service. And for more on that and more in our Fame and Fortune segment, I want to get to Alexander Canal with the latest finale. I mean, these are impressive numbers from Disney.
Great numbers. Disney Plus surpassing that 50 million global subscriber number. That's up from the 22 million they reported a few months ago. And as you said, investors clearly loving this. The stock up over 5% off of the news here. And what it shows is that Disney is in a really good position moving forward. I talked about last week how they're an early front runner in this streaming fight. And it's not just from these numbers that we have today, it's also from that new Piper Sandler teen survey, which shows Disney Plus gaining a little bit of Netflix's shares amongst the younger generation. So in that survey, teens said they spend an average 33% of their time on Netflix, followed by YouTube and cable television. But what's interesting is all three of those platforms dipped slightly from their fall 2019 results. And a large reason for that was because of the entrance of Disney Plus and Apple TV Plus. Now, of course, Disney Plus only got about 7%, with Apple TV Plus earning 2%. So Netflix still clearly the winner here, but what it does suggest is that there might be room for multiple winners in this space. We still have HBO Max coming out in May, so we'll have to see what happens there. But for now, subscribers clearly loving Disney Plus, and it's gaining momentum.
Yeah, I mean, that Piper teen survey is something that has a lot of people interested in it when we look at kind of the new trends in this new generation and what they're preferring. But still interesting to see that the President Trump got a question about the Tiger King and whether or not he would be thinking about pardoning him. So it does show, I mean, Netflix still has some staying power here, so that's important to keep in mind. That's obviously the leader that they're chasing. But regardless of what platform these celebrities are on, we are seeing a lot of celebrities stepping up to kind of combat the coronavirus crisis right now. A lot of celebrities across the board. What have you seen in terms of maybe the most impactful moves that we've been tracking?
Exactly. So as the coronavirus keeps spreading, celebrities are stepping up, pivoting their businesses and foundations in order to help those most in need. Kylie Jenner is one of those celebrities. Her company, Kylie Skin, has partnered with Coty to manufacture hand sanitizers for Southern California hospitals. Now, this comes after Kylie Jenner maintained her title as the youngest self-made billionaire. She was also top 5 in Piper Sandler teen survey about their favorite social media personalities. So there's no denying that Jenner's reach is very large, especially with the younger generation. So it's great to see her company stepping up in such a way. And also in a similar vein is Jay-Z and Meek Mill. Now, through their Reform Alliance organization, they've been able to provide over 135,000 masks to prison inmates and prison workers in South Carolina, New York, Tennessee, and Mississippi. Now, this is important because prisons can become an incubator for these viruses. It's very difficult to socially distance yourself. There's also a lack of sanitary products like soap, toilet paper, and tissues. So masks are certainly a great start, but it's not just masks that people are struggling to find these days. It's also those basic everyday products. And that's where Jessica Alba and her Honest company really stepped up. They donated 3 million diapers, 20,000 wipes, and other personal care products to families that are now really struggling to choose between buying diapers or other basic necessities. Unemployment is through the roof. People are furloughed, out of work. It's a really devastating time. And one of the industries that's really suffering here is the food and bar space. And that's why Ryan Reynolds finally decided to donate 30% of all proceeds from its aviation gin company to bartenders through May 1st as part of its new Tip Your Bartenders program. He already dumped $15,000 into that program to help struggling workers get back on their feet after this is all over. But these are just a few names out of the many celebrities, many average Americans that are stepping up and going above and beyond to really take care of those most vulnerable and combat this crisis head on.
Yeah, in a way that's on brand for a lot of their businesses and expertise, as well as we've seen. And Alexander Canal highlighting that right there. Thank you so much for bringing us that. We've got another name to add to the list, too, though. If you are into all of the entertainment for good causes out there, tonight we have Alicia Keys on a live stream concert for her home, from her home, I should say, for Verizon's Pay It Forward Live tonight at 8 p.m. Eastern Time. You can watch that on Yahoo and Verizon's Twitter feed as well. Millions of dollars going to small businesses in need. Something fun for everyone tonight at 8 p.m. Eastern Time. All right, well, we're going to take a quick break right now. And on the other side, chat with the CEO of Edible Arrangements on how he was able to shift and pivot into getting much needed groceries to customers' hands right after this. Welcome back to live coverage here on Yahoo Finance. I'm Zack Guzman. Right now, we're seeing stocks maintaining their gains. The Dow and the S&P both up more than 2%. The Nasdaq up a little over 1% right now. We'll continue to track that throughout the day. Meantime, we have a lot of companies out there pivoting to make sure they continue to serve customers through the coronavirus crisis. We've already seen Panera Bread shifting to sell some of the staples that they serve as part of meals to customers who want to come by and get those. And now we're seeing the same thing play out for Edible Arrangements, the company that normally sells some pretty nice gift baskets, now shifting to selling their arrangements in just pure grocery form. And for more on that, I want to bring on the CEO of Edible Arrangements, Tariq Farid, who joins us now on the Google Hangout. Tariq, it's good to see you again. Maybe just explain kind of the way that you saw this play out and how you were able to shift into making sure that you could continue to serve your customers who might not necessarily need a gift or whatever they had been buying before, but now just pure produce getting shipped as well.
Yeah, Zach, first, thank you very much for having me. Just like everyone and every small business, we saw our sales decline 60, 70%, right at the beginning. And the shift happened where we started to get calls and franchisees started to just deliver whole fruit. And as we saw that, we just pivoted to offer some groceries, $19.99 will deliver fruit, no delivery charge. And we saw it spike, thousands, couple of thousand, boxes going out on a daily basis. And it still remains the biggest seller right now. And so it was more, the pivot was because we're a franchise company. We have these small entrepreneurs there at the front lines. They're seeing this more than us. And, we had the fruit available. And then a week later, we were able to add veggies. So now we're doing vegetable and fruit baskets. And then this week we're testing protein. So we'll add some steaks and other things to that and do whatever needs to be done to, one, get our community through it, but more important, get our franchisees through it, keep those jobs in the stores and ride through this, and step up where there's a need.
Yeah, and how hard was that pivot too? Because we see a lot of companies trying to do this, but if you're shifting so far outside of your comfort zone, I imagine it would be kind of tough to scale up the things that you need here. Of course, you already had the sourcing, I would imagine, for fruits and then adding veggies there. So what have you seen on that front, especially as you're dealing with a bunch of franchisees that might need, when we talk about the Paycheck Protection Program, that might need additional funding here to make sure everything's going on. So what have you seen on that front as these efforts get underway?
Yeah, I think because of the need, it was easy. It was easy because our customers needed it. We're here because of our customers, and we needed to step up and do whatever needed to be done. Even my wife was not going out, and she ordered the fruit through one of our local stores. But the pivot is more our drivers. It's our people in our stores. And as we put the call out, there was not a hesitation by anyone. They knew this was needed because our franchisees, these small business owners that live in the community, they're kind of residents of that community. They see the issues going on there. So I think the pivot was easy. The challenge was that we weren't making any money on these. In the beginning, we're losing money on every box we send and everything. But as you take care of the community takes care of you. So we went from -50, -60 to +40. We started to see that people now started to place other orders. People are home. The birthdays must go on, moms must be taken care of. So we started to see the shift of consumers started to add to those products. So that pivot, actually saved us. If not, we're doing well now because of that pivot. So, with that necessity and one, we have to do it. So it's not a question of, was anybody struggling? We had to do it, and we had to do it at a certain price point, and the franchisees did it.
Hey, Tariq, it's Brian Chung here. Just curious in terms of margin pressure. I mean, it sounds like you still have some pretty good business coming in, but are you thinking about maybe trying to tap into one of those PPP loans that a lot of other small businesses are trying to tap into, or maybe even what the Federal Reserve announced that they'd be offering today? Do you see the need for credit at this time?
I would tell you that was such a shot in the arm. And, it's so nice that finally small businesses got taken care of. And I think a lot more needs to be done. It looks like they're doing more. But it was such a shot in the arm, but where people can keep going. There's a lot of confusion. We've been just trying to help franchisees just, kind of circumvent their through this. They're applying and they're not getting responses. So people get nervous that my application even go through. So we're starting to see some of that activity now pay off because they're getting their confirmation emails. They're hiring again. We need to hire, but how does a small business owner that's actually now delivering at less margin just to keep going? How do they, how do they turn around and invest or hire where they can't guarantee a paycheck to the person, let alone, when it's the husband and wife themselves working just to continue the business. So we're now hiring people, we're bringing people back on that, on that promise of, hey, there's relief coming. And we hopefully will see that soon, and we'll see that second tranche that they're working on. But that helped a lot. And that has a lot to do with us seeing the recovery, because we're only as good as the deliveries we make, not the orders that people want to place. So we're able to get those deliveries out now, hire the people, guarantee to them that we can make a paycheck to you and everything. And this is a sacrifice small business owners always take, right? They always pay others first, then they pay themselves. And that's what they're betting on right now, that I am going to get some relief, but let me take care of my staff who is in more need, and I need them more.
And Tariq Fareed, Edible Arrangement CEO, highlighting just a few of the pivots that a lot of small businesses out there across the country are needing to make. But thank you so much for joining us and sharing that. Appreciate it.
Thank you, Zach.
All right, well, coming up after the break, Wimbledon getting canceled for the first time since World War II. Why a savvy insurance move is making sure that it's still bringing in $140 million despite the cancellation. We'll chat that right after this. Welcome back to live coverage here on Yahoo Finance. Right now, we're seeing stocks give back just a bit of the gains that we saw earlier today. The Dow now up just under 2%. We'll continue to track that throughout the hour. Meantime, we're also tracking the impact to sports. Of course, live sports getting canceled or postponed across multiple different organizations here. When you look at the MLB, the NBA, and now Wimbledon as well, getting canceled for the first time since World War II. So there's a lot going on here. For more on the sports space, I want to bring on Religion of Sports CEO Amit Sankaran, who's joined us before on the show. Amit, it's good to see you again. When we look at this, I mean, it's getting desperate out there. When we think about live sports coverage, it sounds like the NBA and ESPN might be moving forward with a horse tournament, something that you might be able to see in front yards, backyards, normally across the country. What are you making of the way that sports leagues here are going to have to get a little creative to bring some live sports to their fans?
Well, yeah, thanks for having me here. Yeah, I think, look, our business is about telling human emotional sports stories, and we believe that sports change lives. We just recently wrote a piece that talked about how in many crises, sports a lot of times is the first thing that elevates and allows people, all of us as societies, to come out of this, whether you look back at, the Boston Marathon bombing or 9/11 and so forth. And so I think that the lack of live sports, I think, has not only huge economic impacts to what you're alluding to around networks and brands and all of the like, but it also puts all of us in an even more difficult position around how do we deal with all this? What's our outlet? Where do we take, the lessons that we all impart from sports, and how do we take those away? And so what I do think, though, it does is it starts to set us up for, amazing moments like the Olympics and so forth, where things will come together and you will have nations come together and be able to think about sports and the collective wisdom that comes from it beyond just the event itself.
And I mean, you've tracked a lot of, I think you're right. A lot of people get some inspiring stories from the players behind the games, not necessarily even the games themselves. I mean, it's kind of just something you watch, pass the time. Obviously, a lot of fans are very passionate about the games themselves, but the stories off the field, off the court are also something that you've documented. And we talked about that documentary on Steph Curry before on the show. But I mean, how can you actually advance some of those stories without the actual live sports going on as well? Is there a fear potentially that maybe leagues might not be able to come back from some of these things, at least in the short term, when you think about what the NHL wants to do with this, when you think about the XFL having to cancel their first debut season through all this? I mean, there are some leagues that are going to be impacted more than others.
For sure. I mean, I think sports, unlike, similar to every other industry, is going to be impacted, are going to be impacted. I think in a lot of ways, the impact is going to lag a little bit because of just, the just tangible issues that exist with proximity and seating in live event spaces and so forth. So I think there are those just challenges. The reality is no one knows when it comes back. It will come back. The question, though, around production and how it impacts us, I think, is twofold. We think about things around, again, it's not necessarily related to the live sporting event, but it is around it. We are leaning in deeply to audio, and I think that's one place that even in this moment, it allows us to go create great content remotely, make phenomenal sound, have editing done, and we have a team that's got a lot of depth of that experience and is working through this, maybe even at an increased pace because people are available at home. And then on video, we have a lot of content we have created, and so there's still a lot of work that can be done. You're right, though, as you get into the times when we need to go out, do more production work and so forth, we just have to work with the realities of the constraints in front of us.
Yeah, and who knows? Maybe there will be some good stories to come out of the horse tournament as well. I'm not sure if I'm too optimistic based on the way that ESPN's been streaming these video game tournaments out there. But for now, we'll leave it there. Amit Sankaran, thank you so much for joining us. Appreciate it.
Thank you. Appreciate it.
All right, coming up to wrap up the show, a silver lining here as more people work from home, just like we are right now. The surge in dog adoptions and foster care for more pets out there. We'll chat with the president and CEO of the ASPCA right after this on That Feel Good Story. Stay with us. Welcome back to live market coverage here on Yahoo Finance. Right now, we're seeing the Dow up by about 1.7%. The S&P giving back a little bit of its gains, now up just under 2%. We'll continue to track that for the rest of the hour and through the close today to wrap up the week. But right now, we're tracking a feel-good story right now as more Americans work from home, potentially seeking the comfort of a new pet. And right now, we're seeing a surge in foster applications for a lot of dogs and other pets out there. For more on that, I want to bring on the president and CEO of the ASPCA, Matt Bershadker, joins us right now on the Hangout. And Matt, when we look at this, I guess if you have more people staying at home, they're going to want a companion for all that. So what have you seen in terms of adoption interest right now?
Yeah, it's been actually a little bit of a silver lining. We have seen two exciting things happen. One, in our facilities in Los Angeles and New York, we have seen a 70% increase in the number of animals in foster. In addition to that, we have seen a 200% increase in the number of people wanting to foster. And at the onset of this crisis, we saw a tremendous spike in adoptions. And I believe that is about both the psychological benefits of sharing your home with a companion animal, the joy, the love, the companionship that comes with all of that, but also the practical benefits. People have been contemplating bringing a dog or cat into their home, figure, you know what, now I'm home. It's the perfect time to assimilate a new family member into my life.
Is there? I fall into the same boat right now, where it's like, okay, I could use a little dog at home to keep me company here. Is there a fear, though? I mean, how does the process work? Because we had been hearing about some shortages in terms of actually meeting the demand for people wanting animals right now. How does the process work differently through times of crisis and making sure that those who maybe are qualified to actually take a pet on get the pet? And then also, are there any fears about once this all blows over and maybe people go back to work, how you might have to figure that situation out?
Sure. We have seen the animal welfare community lean into technology just the way you and I are speaking. So the process for matching a pet owner and a pet has not changed. The same type of questions, the same types of things are being evaluated. What are you looking for in your companion animal? Are you looking for a jogging buddy? You're looking to someone to watch TV with. So those matches are being made based on the same criteria. But really interestingly, for example, we're using Uber to put kittens into foster homes in LA. So we'll do the interviews over Skype or Zoom or what have you, and then we'll put the kitten in an Uber, and the Uber will take the kitten right to the foster's home. So like every industry, we're taking advantage of technology and we're innovating. And some of those innovations, I think, will last past this crisis, right? And that's the beauty of a crisis is you innovate, you become more effective, you become more efficient. In terms of your second question, it's tough to know, but this is what I would say. We see an awful lot of what we call foster failures. Animals that go into foster, and once they've spent 2, 3, 4 weeks in a home, worming their way into someone's heart, it's pretty difficult for people to give them back. But this is what shelters do. They find homes for animals. So if in the event some animals do come back after foster, which is always the intent, to foster as a temporary home, those shelters will be well prepared to find permanent homes for those animals. The benefit of fostering is also twofold. One, it puts the animal in a home-like setting, which only further prepares them for life in an eventual home. And two, it allows the shelter to focus its limited resources on the animals that truly need to be there, victims of cruelty or animals who may have been inadvertently separated from their owners.
And then real quick, just to wrap up here, Matt, I mean, we get in these arguments, dogs versus cats all the time, and what might be more popular when the need is greatest. What have you seen in terms of the numbers there on that front?
You're going to get me in trouble with that one. So I'm going to stay agnostic, but I do want to talk about one other thing, if I may, which is during times of crisis, I think it's important for nonprofits to lead, and that's precisely what the ASPCA has done. We've launched a $5 million multi-pronged strategy. Our work has evolved as a result of this crisis. And this multi-pronged strategy is a $2 million fund for shelters to help them navigate the uncertainty, and 4 regional food distribution points across the country: Los Angeles, California, Miami, Florida, New York City, New York, and Asheville, North Carolina, where we are making free pet food available to pet owners who have been impacted by COVID. Because the safest and best place for a pet is in a home.
Yeah, whether it's a dog or a cat, and we'll take that there, protecting yourself there. I appreciate you joining us nonetheless. Matt Bershadker, thank you so much for joining us. Appreciate it, man.
Thanks so much, Zach. Stay safe.
All right, thank you. You too. All right, we've got much more coming up here on Yahoo Finance after the break. We're going to be discussing more on the front of the coronavirus crisis as cases continue to rise here in the U.S. We'll chat with Detroit's former health director on why Detroit might be the next COVID-19 hotspot to watch and what more can be done there to ensure it does not become another New York. More on that after the break.
Welcome to live market coverage here on Yahoo Finance. I'm Shauna Smith. We have stocks in the green this afternoon, on pace for their highest close in just about a month. Now, the move higher today comes after the Fed announced that it will provide $2.3 trillion in loans. It is unprecedented move from the central bank. That is enough to move the broader indices to the upside. We have the Dow, the NASDAQ, and the S&P all posting gains today. The Dow and the S&P both up just around 2%, with the NASDAQ holding on up around 1% so far. Now, investors seem to be shaking off the weak economic data that we got out this morning. We had that jobless claims number jumping by 6.6 million. So really showing the impact that the coronavirus is having on the labor market. We also got the consumer sentiment number sinking to a 9-year low. So showing some of the concerns out there from Americans just in terms of how big of an economic impact the virus will have on the U.S. and on their personal finances here going forward. I also want to point out some of the headlines out of OPEC. Oil has been pretty volatile so far today. Crude was up over 12% earlier, and right now it actually turned negative, off almost 2% at $24.68 a barrel. Now oil turned negative today as the street awaits some of the details on production cuts from OPEC and its allies. We, of course, will continue to monitor that story, but as it stands right now, with 30 minutes left before the close of oil down just around 1.5%. But let's start with that historic move from the Fed this morning. The Fed unveiling an array of programs saying they would provide $2.3 trillion in loans. Now, this expands the Fed's operations to reach small and mid-sized businesses, also U.S. cities and states. I want to bring in Brian Chung. Brian, I know you are closely monitoring this story, closely watching this just in terms of what this means for the broader economy. What's the latest?
Well, the Federal Reserve announcing it will inject $2.3 trillion of liquidity into a number of markets. It's targeting specifically municipal debt markets. It will actually provide some funding to those that are below or slightly below investment grade, including fallen angel companies of BB minus credit rating, for example. And then most notably, its Main Street lending program, which it says will be able to provide business loans to those that might be too large to qualify for those PPP loans that were launched by the Small Business Administration last week. The Federal Reserve says this is all in an effort to do all we can to support the U.S. economy. Fed Chairman Jerome Powell speaking shortly after that $2.3 trillion announcement today. He spoke on a webcast with the Brookings Institution, and here's what he had to say.
Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
Those three adjectives were really key there: forcefully, proactively, and aggressively. And Chairman Powell really trying to send a message out there that he doesn't want the economy to start up too quickly. He wants to avoid what they call a false start, where the economy would try to get started before the economy is really ready to go, which might risk more people getting sick and extending the economic woes as the economy might have to close again. Again, it's too early to necessarily say if there is a timeline for this. Jay Powell didn't have any sort of projection on how long this would last, only saying and warning that economic data for the second quarter could be bad.
All right, Brian, thanks so much. For more on this, I want to bring in Ben Phillips, VenChair's Chief Investment Officer. And Ben, we were just listening to Brian bringing us the latest of what Jerome Powell was saying this morning. And the one thing that stuck out to me was the fact that he was saying that the Fed will act, quote, until confident that the economy has weathered the storm and is on track to achieve our maximum employment and price stability goals. When we talk about what this means for the broader markets, how is the investment community thinking about the Fed's actions today?
Well, I think I woke up and I was surprised just at the number myself, and I was going back and saying, has the Fed ever done anything like this? And you mentioned it's unprecedented. We've never seen the Fed directly address really small and medium-sized businesses like this. So this is unprecedented. This is historic what they're doing. The reason is we've had 16 million job losses in the past 3 weeks, right? Since they started spiking. That's 2/3 of the jobs created over the past 10 years since the GFC. So it's a big number. The Fed has to step in, Congress has to step in, and we're seeing it in big numbers quickly.
Yeah, Ben, I want to go off that 16 million number that you just read. Do you think that the monetary policy that we're seeing, is it enough? Are we seeing enough come out of the Fed given the huge number of job losses that we have seen over the last 3 weeks?
I think what the Fed has done is substantial. I mean, they have come out with everyone's using multiple kitchen sinks, right? That's the market and colloquialism. It's been a huge number. It's tough to say, right? Because if you look at what coronavirus is doing, what the shutdown really is doing, every week that we're closed in the U.S. is almost a 1% GDP drag. That's just if you kind of put it all together and try to ballpark it. But a 1% drag on GDP from each week that we're closed, that's a massive number. And so there has to be massive efforts from liquidity, from the Fed, from stimulus that really helps support the economy in this very tough time.
But when we try to gauge just the extent of the disruption that the coronavirus will cause, it's obviously very tough to try to put a number on it right now. But when it comes to the labor market, it doesn't really seem like there are any signs of this slowing down anytime soon. How much worse do you think it could get from here?
Well, I think it is going to get a little bit worse, but I think we're encouraged by some of the numbers we're seeing nationally. So if you look at like California, for example, looks like they might have dodged the bullet largely. Some other large states too. So we'll see, how quickly, this thing continues to spread. But New York, obviously, I have lots of friends there, used to live there for over a decade. Our heart goes out. That's the hardest hit area in the U.S., and that's an understatement. But I think if you look at the U.S. as a whole, there's a potential we're going to start opening up areas of the economy and letting people go back to work and start to function more normally in early May. So I'm encouraged. This is going to be a big GDP drag. Everyone's trying to figure out. The key question is, how long does this last? How many weeks are we closed kind of on a national basis? But for us, we're getting a little more constructive, seeing some numbers, some proactive numbers are, I guess, more encouraging numbers lately.
Ben, what do you do in this type of environment? I mean, what looks attractive to you, and how are you identifying those buying opportunities right now?
Yeah, so that we are investing in policy themes, right? So we're looking for long-term changes and really policy. So what's going on right now is like you mentioned, it's unprecedented type policy action. It's not directly affecting our themes. What it is, it's more addressed at the entire market. But themes we're looking at, sports betting has taken a huge whack, right? People are saying we're never going to go to a casino again. A lot of the sports betting names have casino leverage there. So that's something we're looking at. We think that's an interesting opportunity. This energy was already in the doldrums. It was totally beaten down. And now with, potential macro slowdown on a global basis, as you were just talking about, oil prices are, at long-term lows right now. So we're looking at some energy names. There's IMO 2020. That's a policy theme that we still like and actually use this energy weakness as an opportunity. So we'd like adding to something like that. 5G telecom, these themes, infrastructure is one we've liked for a long time because states are spending, but now we're going to see a federal package most likely. So that's just another catalyst for the infrastructure name. So you just have to be nimble. You have to, get out of the names that maybe are holding in that are fairly valued and get into some ones that are deeply discounted. So we're nimble, we're being active, and I think everyone should think for the long term here.
Yeah, but when you are positioning yourself right now, what are you saying, or what is your gauge just in terms of when you expect the economy to recover, and what do you think that recovery will look like? Do you think it will be what we've heard time and time again? It seems like over the last couple of weeks that it will most likely be a V-shaped recovery.
Yeah, the debate's still out there, right? And I think what really matters is how much does this impact confidence? How much does this impact the consumer? Consumer spending is clearly taking a hit right now. I mean, we're seeing certain goods that you can ship to your house, picking up. We're seeing groceries pick up. But really, overall, if you have 16 million people losing their jobs in 3 weeks, that does not bode well for future consumer spending. So I think Q2 is really just going to be, hopefully a wash. And we're going to say, it's going to be a very negative GDP number. That's a foregone conclusion. But if we can get kind of Q3 people back to work and clicking, this could be a shorter recession. And we've talked about, I posted something on LinkedIn even, that when there's an event-driven recession, it's the shortest version. It's usually 9 months long on average. So that was a little encouraging to us too. When there's this shock that's so, out of left field, it tends to be a shorter-lived recession. So we're a little encouraged by that.
All right, Ben Phillips of Event Shares, Chief Investment Officer there. Thanks so much for joining me this afternoon.
Thanks.
As I said, the broader markets are moving to the upside. The Dow now up just around 360 points. One of the leaders in the Dow today is Disney. Disney stock up just over 5% so far. And the move to the upside comes after Disney Plus service revealed the fact that it has more than 50 million subscribers. That's almost twice as many as the company had reported just 2 months ago. So here to talk more about this, I want to bring in Tuna Amobi, CFRA Research Senior Analyst. And Tuna, thanks for joining us this afternoon. It was pretty big numbers that we got out of Disney just in terms of the success that they're seeing in Disney Plus so far. What did you think of the numbers?
I have to tell you, those numbers were actually better than we expected. And going into this, COVID-19, extended stay, we figured that the streaming platforms were going to be one of the major beneficiaries of a spike in in-home viewing. With all the social distancing, et cetera. So Disney Plus, having launched last fall, I think they were really off to a terrific start. These numbers we're getting globally as they continue to launch in Western Europe and a host of other international markets yet to come, I think really tells us that they are far ahead of the pace that they had set out. If you remember in April when they had the Analyst Day last April, they set out projections of 60 to 90 million globally within 5 years. Now 50 million in just 5 months, I think seems on a track to obliterate, those 5-year projections. So if anything, net, Disney Plus should be a net beneficiary. I should also add that some of the numbers that we're getting from Nielsen in terms of the spike in streaming viewership, Disney is right there in the mix of potential beneficiaries. That being said, last week the company had put out some guidance regarding COVID-19 and potential impact on the theme parks, the film and television. So there's been some significant disruption. We should really temper expectations going into this next earnings. That being said, I think investors can take some comfort that Disney Plus should be a net beneficiary and should provide a bright spot when they report earnings.
Yeah, Tuna, I wanted to go off of that just in terms of we got this huge number when it comes to Disney Plus, but how does that news compare to the fact that Disney still has their theme parks closed around the world? Movie theaters are still closed just in terms of getting out their new content, their new movies. I mean, how do you think that will all shake out for Disney, at least in the short term?
In the short term, I think the impact in terms of the numbers is going to be significant. There is no sugarcoating that. Remember, the streaming business is still a loss-making business and will remain so for quite some time. So as much as they're adding all these subscribers, they're still spending heavily on content and marketing. But when you have the theme parks closed now for weeks and potentially months, you're talking about hundreds of $millions of a hit in operating income. You're kind of losing a significant amount of leverage. You're incurring fixed costs as you go along. So it's going to be really ugly. I don't know how else to describe it when they report the quarter. So I think investors should really temper their expectations, especially, and not just this quarter. We're talking about something that could linger for the rest of this calendar year. That being said, I think Disney is as well positioned as any company within the media and entertainment space to ride this out. This is a time that their balance sheet flexibility should serve them right. We've seen them tap the capital market several times in the past month to shore up their liquidity and flexibility. So net, I believe they should emerge from this crisis in much better shape than a lot of their peers.
Hey, Tuna, we have Bob Chapek, the new CEO, just in terms of how he's been able to navigate this uncertain time. There's been talk just in terms of companies, obviously, like you were saying, needing to be nimble. They need to change their business models, at least to some extent. Are you expecting to see any lasting changes here in Disney's business model as a result of coronavirus?
We've been asked that question time and again. I don't really think that there's any need for them to dramatically change their business model, nor do I think that there's necessarily any asset that could be a candidate for potential divestiture. We know that, Bob Chapek is an operating guy. He's cut his teeth around many of the traditional businesses that Disney is operating. He's got some steep learning curve in the streaming business. So I don't really expect any kind of major change in the core strategy, so long as Bob Iger continues to be involved in the day-to-day role, in an executive chairman role until 2021. But with the COVID situation kind of throwing a wrench in the whole strategy, frankly, I wouldn't be surprised if Bob Iger decides to stay a little longer just to steer the ship and integrate Fox and make sure things are up and running. But ultimately, this depends on how long this COVID outbreak continues, and really no one is certain about that at this point.
All right, Tuna Moby, CFRA Research Senior Analyst. Thanks so much for joining me.
Thank you so much.
Well, coming up here on Yahoo Finance, Zoom is under fire for its privacy practices, and now one big tech giant is telling its employees that it's not allowed to use the app on their work computers. We're going to dig more into that story right after the break. Welcome back to Yahoo Finance. We have live coverage of the markets here for you. Again, the Dow, the S&P, and the NASDAQ all holding on to gains. The Dow and the S&P both up 1.5%, so well off the highs of the day. One stock that we are watching today is Amazon, and we're watching that after Jeff Bezos made a surprise visit to an Amazon warehouse and also to a Whole Foods store amid worker safety concerns. Now, warehouse workers and Whole Foods employees have called for the company to better protect their workers during the coronavirus outbreak. And you can remember some of the protests or some of the walkouts that we saw staged over the last couple of weeks because of that. Sabeel Marcellus joins us now with more on this story. And Sabeel, was interesting just in terms of the video that Amazon tweeted out of Jeff Bezos walking through the warehouse and also through the Whole Foods store.
That's right, Shauna. So I was watching that video. Basically, Jeff Bezos visited an Amazon warehouse and a Whole Foods store yesterday. The company put that video on Twitter. And in that video, you see Jeff Bezos show up at the warehouse, get his temperature checked. He's wearing a face mask and he's walking around greeting employees, thanking them. He even says to one, "I would shake your hand, but obviously, he can't do that right now." I can totally relate to that one. He also asked one of the Whole Foods workers who has this clear shield that separates him from shoppers how he feels about that. So this seemingly impromptu visit is not out of the blue because Amazon has been facing a barrage of criticism, as you mentioned there, Shauna, for not stepping up safety precautions for workers. In fact, last month, Jeff Bezos sent out a memo to employees saying that there's no manual for a situation like this and that the coronavirus pandemic is creating stress for everyone. But that memo came a day after 4 senators asked Jeff Bezos to step up protections at warehouses. So what we've seen is that last week, there were walkouts at 3 Amazon warehouses in Staten Island, New York, in Detroit, and in Illinois. Also on Monday and this week, there was another walkout at the Staten Island warehouse because the employee who organized the protest was allegedly fired for organizing it. Meanwhile, Amazon is saying, well, that's not why he was fired. He was fired because he violated social distancing guidelines. So what Amazon is doing right now, they're downplaying the walkouts, but they are stepping up safety measures, such as more intense cleaning at facilities. They're also requiring that workers clean and sanitize their stations at the beginning of a shift and the end of the shift. They're also taking worker temperatures and giving out face masks.
All right, Sabeel, thank you. We're also watching Zoom today. Now, Zoom has exploded in popularity over the past couple of weeks with millions of people working from home. But Zoom's growth, though, has been marred by concerns around its security and also its privacy. So yesterday, we talked about the class action lawsuits facing the company right now. Well, now there's also news today that Google is telling workers that they can't use Zoom on their company laptops. We have Dan Howley following this story. And Dan, we've been talking about the explosion of growth that Zoom has been seeing over the last couple of weeks, but that really, though, has been capped by some of these security fears and some of the privacy concerns that have been creeping up because of the recent developments that we have all heard about.
Yeah, this is really interesting. Google basically telling employees, look, you're not allowed to use Zoom anymore on your company-issued laptops. You can't install it. If you have the desktop client installed, it's just not going to work anymore. And part of this is obviously the security issues that the company has been facing. Talk about having end-to-end encryption when they actually didn't. Talk about the Facebook data leaking. Facebook that people never explicitly agreed to, the data mining that connected people to LinkedIn. The list just goes on. But this also could point to the fact that Google has its own enterprise-level chat software called Meet, and they might just want their employees to use that, as well as the fact that the security is an issue. Now, they do say, however, that employees can continue to use browser or on mobile. The big difference here is on a web browser, if you don't install the plugins that they ask you to use, you're just running it in a browser as normal. There's nothing installed on your computer at all, so you're nice and clear. And mobile, basically the same thing. You would be able to use it without issue. So I think this is a kind of repudiation, again, of what's happening for Zoom. There are issues with security, with privacy, and we'll continue to see more companies go forward. But I mean, today we just saw, Jerome Powell using Zoom during his speech today. So more and more high-level executives, high-level people in government are using this platform, and we're still hearing more about security issues. Again, 4 class action lawsuits being proposed now. So we just don't know where it's going to go from here.
Yeah, and Dan, I mean, what do you think just in terms of the severity of this in regards to how it will impact Zoom going forward? Do you think that will be enough to really disrupt their business? Or do you think this is something that people will be able to move past in the future?
I think maybe in the future people will be able to move past it. Look, people are still using it now. The news is spreading about the issues they have, but again, Jerome Powell just used it today, so it just speaks to the fact that it's so ubiquitous at this point because of COVID-19 lockdowns, forcing people into these different types of programs. There are plenty of other offerings out there that you can use. Zoom is saying that they're working on issues with their security and privacy. So we could see in the future some kind of pullback. People start to, use something else aside from Zoom, or when the news of this spreads more widely among regular users, they may start to leave it and use something like FaceTime for just general chats with friends and family. That can support 32 people as long as you have an iPhone, but you still use it. I think that eventually Zoom will see issues with this, though, as far as user numbers.
And well, as it stands today, I know the stock has been under a tremendous amount of pressure the last couple of weeks, but today shares are moving to the upside, up just around 4%. Dan Howley, thank you. Well, coming up, the FCC and FTC are clamping down on robocalls touting free COVID-19 test kits and also home cleaning services, amongst other things. So we're going to talk about how enforcers are curtailing coronavirus robocall scams right when we come back. Welcome back to Yahoo Finance. Coronavirus text and phone scams have been a big topic over the past couple of weeks. Maybe you have received some phone calls pitching free coronavirus test kits, some phony remedies, or maybe even cleaning services. Those initially escalated at the beginning of the outbreak, but it's interesting if you take a look at the data in terms of what we are seeing today, because they've actually started to taper back a bit. So for more on this, I want to bring in Jonathan Spalter, U.S. Telecom, the Broadband Association CEO and President. And Jonathan, thank you for joining us this afternoon. Let's start with the robocalls and the number of text and phone scams that maybe some of our viewers have experienced since the coronavirus outbreak. Now, U.S. Telecom, it leads the industry's traceback group, which traces the source of illegal robocalls. So you're exactly the right person to talk to about this. What have you seen just in terms of the number of calls that have been placed over the past couple of weeks?
Well, sad to say, and just to start out, Shauna, that there really are still some bad actors that are out there that are trying to take advantage of our most vulnerable population in this national emergency. And it's not just here, but it's around the globe. The good news, though, is that the country's broadband providers have gathered together under U.S. Telecom's industry traceback group to go after them. We've been sharing information and insight in real time to trace back right to where the sources of these bad calls are coming from, and sending that information right over to our law enforcement agencies here in the government and also at our attorneys general across the country. The good news is that it's had an impact. We've seen downstream scams that have been stopped right at the start, not just by going after the bad actors, but by going after some of the under-the-radar providers that have been letting in some of these junk calls into our networks. We've alerted them, and they've shut down access to those bad actors. So the good news is that the COVID scams are beginning to trail off, but we still have work to do. And that's why we are all working together vigilantly to go after these bad guys using our technologies and tools to trace back across the hops on our network and make sure that these bad actors are not scamming us, but are going to jail and going on perp walks.
Yeah, it's interesting when you take a look at some of the numbers. One of our producers gave me the numbers from UMail, and they were talking about how the number of robocall volumes declined from 4.8 billion calls in February in the US to 4.1 billion in March. So there's still a huge number of these calls taking place. When we talk about the decrease that we've seen recently, is this something that you think will just be a short-term thing, or is this something, have we been learning different tactics or different approaches that could make sure that this lasts for the long term going forward?
No, I'm very optimistic that this is a harbinger of even more aggressive efforts against robocallers and illegal scammers. And it's not just our traceback efforts, but we have been really innovating and putting online a range of technologies, stir-shaken technologies, consumer education tools, much closer coordination and tight coordination with law enforcement agencies at the state level, at the federal level, to move not just from civil prosecution, but to criminal prosecution. So it's an all-hands-on-deck approach here to make sure that we're going to see these trend lines not just go down, but to continue to go down.
Yeah, Jonathan, I want to switch gears here a little bit and just talk about what we've seen in the telecom industry overall, also just in terms of since we have a large number of people really across the world working from home at this point. Now, US Telecom is an organization that represents a number of very large telecom companies. I mean, some of those are parent company Verizon, also AT&T, Twilio, Oracle, just to name a few. How are networks holding up at this time, and are they performing as they were designed? Are they performing up to the potential that we had hoped for under a circumstance like this?
And the answer is absolutely yes. Our networks are actually performing. We're meeting needs. We're not exceeding capacity, even as traffic continues to shift during the daytime and as more of our economy goes home to work. And that's not by accident. It's because there have been years of investment and innovation. Last couple of years are trailing around $80 billion of infrastructure investment annually by broadband providers to ensure that our networks are architected in the right way with advanced technologies, caching, virtualization, data centers, and also IP-based network methodologies that allow us to actually manage traffic efficiently, including during surges like we're seeing now in traffic. In fact, just last week, it was up 20%, the week before 25%, according to the numbers that we're monitoring. But our networks are strong, we're on the barricades, and we're continuing to make sure that they're going to meet the needs of every consumer, regardless of what they are, regardless of where they are, and that's our commitment.
Yeah, Jonathan, it's interesting when we compare what's going on here in the US to what's going on overseas over in Europe, because there has been reports or stories, obviously, that the streaming platforms in Europe have slowed down a little bit, that they haven't been able to keep up with that demand. Why are we seeing a difference of what's happening here compared to what's happening overseas?
The difference really is about the extent of network investment in our networks. Here in the United States, we have been investing significantly more in ensuring that our networks can be not just resilient, but scalable, that we're advancing towards 5G networks using all of the available technologies that we've been actually deploying. And the reason that there has been differences in the network performance really has to do with the fact that we've architected and invested in our networks here in the United States in ways that have surpassed other areas, including Europe.
Yeah, Jonathan, I want to follow up on the 5G comment that you made. There's some reports out there, some thought that maybe this coronavirus outbreak, that it will delay some of the 5G efforts here in the US. What do you think?
I don't think so. We've been working very closely with our colleagues at the Federal Communications Commission. They are dead set to ensure that 5G related spectrum auctions can proceed aggressively. We're not letting up on investment or architecting those networks. We're really advancing our test beds and deployment schedules. Yes, there are challenges that are operational that we're facing in the short term, but our goal is to continue to lean in as an industry and ensure that we're going to actually deploy and lead globally in 5G technology.
All right, Jonathan Spalter, U.S. Telecom, the Broadband Association, CEO and President. Thanks so much for joining me.
Thank you very much.
Coming up here on Yahoo Finance, Detroit, the center of one of the worst coronavirus outbreaks in the country, is expected to hit its peak of new cases this week. Coming up, we'll talk to the former health director of Detroit just about what the city is seeing at this point, what the containment efforts have been like, just in terms of trying to flatten the curve of the coronavirus in the city and in the state of Michigan. We'll be right back. Welcome back to Yahoo Finance. Let's get to the latest on the coronavirus. Worldwide, number of cases topping 1.5 million at this point. Right here in the U.S., number of cases are now more than 432,000. The U.S. death toll continues to climb with nearly 15,000 deaths right now. But there is a little glimmer of hope in some of these numbers. There are signs emerging that the new coronavirus cases may be leveling off for now in some cities. And for more on this, I want to bring in Dr. Abdul El-Sayed, epidemiologist and the former health director of Detroit. And Dr. El-Sayed, thanks so much for joining me this afternoon. I want to start just focusing in on Detroit and what we're seeing in the city there. It is one of the worst coronavirus outbreaks in the country at this point. From your time as the health director of the city and from what you know in terms of the containment efforts right now, where does the city stand in trying to contain the virus?
Well, folks are doing all that they can to try and contain it. That means everything from building up an alternative location for medical care, a sort of MASH unit, so to speak, and then also trying to get out testing access to folks in rolling out some of these fast result testing. That being said, you know, when we talk about an epidemic, I really want to step back and just make sure folks understand that it's not just about the pathogen, in this case, the coronavirus that causes COVID-19, but it's also about the agent, the host and the environment. And for right now, when you think about why it is that Detroit is getting pummeled so hard, why it is that so tragically African Americans are suffering this disease far worse, it's because you've seen the environment, our society, pummeling the hosts for a very long time. Whether it's lack of access to stable housing, lack of access to high quality food, lack of access to good education, or the fact that so many people are choosing between going out and earning an $11 wage, for example, working in the back of a kitchen to save their livelihoods versus staying home to save their lives. That is an impossible choice that too many people face. And so we're seeing that happen to folks, and we've got a responsibility to understand why it's happening and what we need to do about it.
Yeah, when we talk about why it's happening, I mean, it's interesting when we even discuss the fact that there's still a shortage of tests out there. So the number of confirmed cases is likely far lower than the number of actual cases that could be out there at this point, particularly in lower income areas. Do you think it's fair to say that we're underestimating the burden that this disease is having on the lower income communities and minorities at this point?
Almost definitely. You know, you think about the high probability of what a disease case looks like for somebody who's affected. They get sick, but their sickness never rises to the level where they need hospital care. And so they stay home. They never get a test. We don't know about it. And in that circumstance, right, we know that folks are living in housing with other folks and they're exposing them. And so the majority of cases don't actually get counted. What we're seeing is largely driven by the serious case count that we see. And of course, the death count, which also may be an underestimate simply because there's a difference in what you classify as a COVID-related death and otherwise. And so this is a far bigger burden than what we're measuring. And we have to understand why it is still moving so fast. It's because a lot of the transmission of this case, of this disease, just goes uncounted and therefore underobserved.
Yeah, Dr. Assad, I mean, when there's so many more cases likely to be out there than the ones that we know confirmed at this point, the fact that we're still seeing testing shortages really almost across the board at this point, what do you think that tells us just in terms of our timeline of this? I mean, how long do you expect it to be until we hit a peak here in the US?
Well, Sean, I'll tell you, based on the best available modeling that's driven by evidence, we're looking at a peak coming sometime in the next 2 weeks. At the same time, however, once we get past that peak, it doesn't mean that we're out of the woods. In order for us to really be able to tamp this pandemic down and make sure that there's not a resurgent cases and another wave, we're still going to need mass testing capacity, because what happens next is what's called contact tracing. We want to know who is exposed, identify the people they may have exposed, and ideally get them all testing so that either we isolate them if in fact they have the disease or a test hasn't resulted yet, or allow them to go about their lives. And so even when we let off of social distancing, and we're not there yet, but even when we let off of social distancing, we need something to be able to make sure that this doesn't start spreading again and we get yet another peak. And so we're still not out of the woods. The resources that we need, we still need. And in fact, the next phase of dealing with this pandemic is going to require testing, perhaps even more than we need it right now.
Yeah, and I wanted to switch the focus here from testing to treatment, because there's different timelines out there. And when I've been talking to various doctors over the last several weeks, there's different degrees of hope, I guess I would say, just in terms of how fast we could get a possible treatment, how effective it will be. Where do you stand on that, just in terms of the fact that we will get something, hopefully relatively soon, that will be effective in treating the virus?
Well, look, there's a lot of research happening right now. We're seeing an unprecedented level of collaboration between scientific communities, not just in our country, but across the world. And we do hope there will be a treatment, but we've got to let the science take its course. The fact of the matter is that we have a process in which we understand how a drug goes from being just a drug that in theory may help to something that we know is safe and effective. And that requires randomized controlled trial experimenting. And that means what you do is you take a group of people, you randomize some to getting the treatment, some to getting a placebo, and then seeing what happens. Because at some point, even for medications that we know are safe for people who are dealing with other diseases, they may not be safe either given the disease process that we're dealing with right now with COVID-19, or at the dosage that we require with COVID-19. And so it's really, really important for us to let the science take its course. And we're seeing that happen right now, but we've got to make sure we wait for those results, and then we allow our medical communities to use these drugs responsibly. And so I've got a lot of hope that there is a lot of very promising potential treatments in the pipeline. But right now, the science just hasn't been clear that there is a clear treatment, a clear quote unquote cure, or even a vaccine that is safe and effective against this coronavirus.
Yeah, Dr. Assad, it's been clear just in terms of the strain that this virus has put on our healthcare system over the last several weeks. in New York City, for example, there's been lots of fear just in terms of running out of potential space, running out of beds. We've seen hospitals almost construct tents outside of where they are located, just in terms of being able to hold the bodies, being able to hold more patients. What do you think this outbreak has showed us about our current healthcare system?
That it is generally run for profit, and that a for-profit health system just does not work when we're dealing with a global pandemic. And let me just explain why. If you look at a hospital which is run as a business in this for-profit healthcare system, it gets most of its margins on elective procedures. Of course, when you're facing a global pandemic, you cancel those elective procedures. So now we have hospitals that are both battling COVID-19 in a fight for their lives, and also battling bankruptcy because they don't know how they're going to pay their bills tomorrow. Not only that, but every hospital that runs as a business is taught these quote unquote just-in-time procedures in terms of contracting for its supplies. Just in time is fine when you're trying to reduce your overhead. It's not fine when you're dealing with a global pandemic. And now we're seeing a run on personal protective equipment. And then beyond that, the bigger moral question is whether or not it's okay that 10% of our population doesn't have health insurance at all, and then another 50% have their healthcare behind a paywall because their deductible is so high in the context of a global pandemic. The Kaiser Family Foundation calculates tongue-in-cheek this deductible relief day. And for folks who don't understand what a deductible is, it's the money that you have to pay out before your insurance starts to pay in to pay for your care. Deductible relief day in 2019 was May 19th. Right now, we're in April. That means the majority of people who have a deductible are still busy paying it off. And that's a real problem because people have learned to ignore symptoms like a fever and a dry cough, which, by the way, are the symptoms of COVID, but also the symptoms of all of the other flus and colds and other diseases that people deal with this time of year. So people have learned, don't go to the hospital or don't go get care for this because, well, you're going to get hit by a bill on the back end. And that leaves people extremely vulnerable in a moment like this. And so I hope that this is a wake-up call for our country to realize that if we want a healthcare system that's able to rise to the challenges of a pandemic like this, then we have to rebuild it so that we have the ability to guarantee everybody healthcare, to guarantee access to the basic resources for our frontline staff who are battling this pandemic, and make sure that our hospitals aren't battling both a pandemic and bankruptcy at the same time.
Dr. Abdul El-Sayed, for Detroit's former health director, also epidemiologist. Thanks so much for joining the show this afternoon.
Thanks for having me, Seana.
Coming up here, restaurants are racing to adapt to the coronavirus outbreak as millions of Americans are being asked to stay at home for the next several weeks. Coming up, we'll talk to Mandy Shaw, CEO of Blaze Pizza, all about this right after the break. Welcome back to Yahoo Finance. The coronavirus pandemic is having a devastating impact on the restaurant industry. Black box intelligence data, which tracks what we're seeing in the hospitality sector, showing that same-store sales at restaurants declined more than 65% in the last 2 weeks of March. So joining us now to talk more about this, we have Mandy Shaw, CEO of Blaze Pizza. Mandy, thanks for taking the time this afternoon. Blaze Pizza, you have a number of locations across the U.S. You have more than 340 locations across the U.S., Canada, and the Middle East. I know you're a franchise organization, but to what extent is the coronavirus disrupting your business at this point?
It's severe, and it was overnight, right? Like many restaurants, we had a dine-in and delivery and carry-out business. But when dining rooms were mandated to be closed down, we had to pivot almost overnight and change to regulations on an ongoing basis. So we still have folks that are allowed to come in the restaurant and go down the line to get their pizzas, but they can't sit and eat. So we had to innovate a lot of new curbside carryout and different ways for people to get their pizzas. Phone ordering, which was actually on the decline as an industry, right? But is back now because not everybody's comfortable with apps and web type functionality and those sorts of things.
You're saying that you're still offering delivery. We've been talking about how a number of companies are staying open, but of course there is the concern out there just in terms of keeping employees safe and what needs to be done in this type of environment. What is Blaze Pizza doing just in order to ensure your workers out there that they will be kept safe and they don't have a reason to worry by showing up to work every day?
Yeah, absolutely. It's a great question because the restaurant business is all about people, actually. So making sure that they're safe is paramount to us and our guests as well. We have door signage that actually also tells you if you've been sick in the last 24 hours not to enter the premises, and that's part of a staff protection measure. We started shipping out masks to all the restaurants, and especially there are areas that are starting to mandate it now. Staff in the restaurants, we had an optional policy where if they wanted to choose to wear them, they could, but we have a vendor of ours actually making craft masks for us in the restaurants. We have hand washing on a rotational basis where people are asked to wash their hands. We wipe down any of the high touch surfaces, door handles or anything like that every 15 minutes with peroxide based or other cleansers that actually kill the virus.
I know that I was reading some of your business plans, of course, ahead of the coronavirus outbreak. And one thing that caught my attention was that you were rapidly expanding the number of stores that you have, the number of stores open. Has the pandemic changed at all your expansion plans or really any part of your business model at this point?
It's surprisingly no. We all know this is going to end. The shock of the restaurant business is you have to minimize capital expenditures now so that you can last through and then have the jobs ready for when everything comes back. Blaze is well positioned to be one of the brands that actually succeeds really strongly once the virus starts to tamp back down. We can open dining rooms back up and or just the delivery business stays as a primary component of what we do. So we've got restaurants under construction right now that have not stopped building. We've got new franchisees who are still calling us and asking to get in. And the stuff that was in the pipeline is still well on its way.
I mean, I wanted to talk about what Blaze Pizza is doing in this time. You participated in the Great American Takeout. It's gotten a tremendous amount of buzz over the last several weeks. So tell us about this and just what it's doing to help small businesses, to help restaurants during this very uncertain time.
Yeah, sure. It's restaurants are a community. Like I said, it's people, it's fun, it's family, it's friendly, and we all care about each other. So it's a coalition of 400 plus restaurant chains and brands that have said, we want you, the American consumer, to eat out at least one more time a week, and it's every Tuesday. And we've seen significant sales. And it's not about sales to the restaurants, it's about keeping people employed and making sure that that money stays in the system, like I said. So as the virus passes, we'll be able to succeed and open those jobs back up for people. The other thing the Great American Takeout is doing is raising money for people. And just like the restaurant relief funds that are out there, saving money for employees so that the ones that need assistance can get grants and assistance for their families and family meals and those things.
Mandy, real quick, just in terms of you being a leader right now of Blaze Pizza, of the restaurant industry, coronavirus is having such a devastating impact on the restaurant industry as a whole. What's the message that you want to send out to your employees or to some of your colleagues, some other restaurant owners or corporations at this time, just in terms of what you could expect going forward here, at least in the short term?
Yeah, I think it's being innovative. And again, if you keep people first, one of the Blaze core values is valuing the people behind the pizza. If we're trying to find ways that we give a pizza to some of the employees that come in, right? Or we're donating to hospitals, and that kind of support across the system is really important. I think the idea is mutual support of the industry. This is still one of the last places where a person without additional education or any advanced training can get a job, work their way up to, say, a general manager position where they're making $80,000 to $100,000 a year. It's entrepreneurial access for people that want to start their own businesses. So it's vitally important that we work together to make sure that restaurants come through this and come through this strong.
All right, Mandy Shaw, Blaze Pizza CEO, thanks so much for joining me this afternoon. Well, we have just around almost an hour left in the trading day, just over an hour left in the trading day. And it looks like the rally is losing steam. We have the S&P still in the green, but at its lows of the day. The Dow now up only 191 points, and the NASDAQ barely holding on to the green, up just around 0.1%. Well, coming up here on Yahoo Finance, Amazon halting its third-party shipping service. We'll talk about what that could mean for UPS and FedEx right after the break. Welcome back to Yahoo Finance. We're keeping a close eye on the markets this afternoon as we close in on the last hour of trading. Now, the rally is losing steam. The Dow now up only 75 points. The S&P up just around 0.5%, right around its lows of the day. And the NASDAQ turning negative, off just around 0.2%. Now, the broader move, the reason that we're seeing this rally lose steam has a lot to do with what we're seeing in oil right now. Oil extending its losses here, off just around 7% at $23.35 a barrel. And of course, we were waiting for the latest out of the OPEC meeting, just in terms of potential production cuts and what that could mean for the broader crude market. Well, moving over here to talk about the latest that we're seeing in the shipping industry. So Amazon is shifting its strategy just a little bit. Now, the company halted its third-party shipping shipping service in order to focus on its own shipments. And that, of course, was a service that competed with UPS and with FedEx. Now, UBS is out with a new note today and it's talking about just what we could expect from UPS going forward. Emily McCormick has more on this. And Emily, it's interesting when we take into account what potentially Amazon's move, whether or not that could have a big impact here for UPS going forward.
Right, Seana. And in the near term, what UBS is saying in its note is this will be a near-term positive for UPS as well as for FedEx because it removes that layer in the competitive landscape for shipping. But at the same time, on net, as we look out at the coronavirus pandemic and its impact on the industry overall, it's likely to have a net negative for UPS. And that's because this is really hitting the business-to-business shipping side of the industry, which tends to be the higher margin portion of the business than on the e-commerce side. So yes, UPS as well as FedEx and Amazon are seeing that uptick on the e-commerce delivery business, but because that's a lower margin portion, overall that is going to be negative to margins and to profitability overall. So here's what UBS had to say. They said, we expect the current stay-at-home response to COVID-19 to boost UPS's e-commerce volumes in the near term, and UPS's total volume performance may be more moderate versus the decline in rail and truckload volumes. However, the sharp decline in high-margin, small to medium-sized business volume plus growth in business to consumer could exert a significant mix margin headwind. So their calculation is for a 100 basis point decline in operating margin. They did reduce their 2020 EPS estimate to $6.05 a share from their previous estimate for $7.02 a share. And right now we do have UPS shares trading just a bit lower right now, 98.40 each, and that's just down about 0.5% as we speak.
All right, Emily McCormick, thanks so much. Again, we have the broader markets losing a little bit of steam here. The Dow now up only 125 points. Keep it right here. We'll have the last hour of trading for you next.
All right, good afternoon, everybody, and welcome to Yahoo Finance Live. Miles Udland here in New York. Let's take a look at this market. We've got a little bit of a sell-off here. I think we might say a lot of bit of a sell-off here as we head towards the final closing bell of this holiday-shortened week. Looking at the major averages now, all three, well, the NASDAQ just tipping into red figures there. The S&P and the Dow, they're up less than 1 percentage point. We've given up the vast majority of the gains that we saw earlier today after that big announcement from the Fed. For more on today's market action, let's bring in Jared Blickery here. Jared, for what stands out to you in this market? Because we were just chatting before we came live, and you were just saying this is not a very constructive close as we head towards this long weekend.
That is correct, Miles. And it's a nasty sell-off. It just began about an hour or 2 hours ago. Been watching it live. Let's take a look at the markets here. We set the Dow up still 150 points, but it was up substantially more. And it looks like my computer is frozen, kind of, but I think we just switched to the S&P 500. And here we go. Here's today's price action, actually over the last 2 days. So we can see that we've been holding on to most of the gains, but we are in violation or in danger of violating this trend line here and giving up most of the gains that we worked on over the morning. And let me just bring up, this is the intraday chart for today only, and the Fed announcement is somewhere down in here. And there was a huge rally off the lows in the overnight market that happened at 8:30 a.m., $2.3 trillion. And the fact that we're just giving this back at the end of the day into a 3-day weekend just tells me that people aren't really wanting to hold a lot of risk over the weekend. The only good news is it could be worse here. Also seeing the 10-year T-note yield now down 4 basis points, had been positive a few times, especially early on in the session. And we'll just take a look at our heat map here. This is going to be the Dow. And we can see kind of a mixed picture, some of the bigger tech names to the left, and also Visa. Those are in the red, had been green earlier, but tech has been lagging all week. In fact, let's take a look at a 4-day chart that goes back to Monday. And if we sort by performance here, we can actually see that Raytheon, after completing its merger with United Technologies in the upper left, that's up 28%. And we got the materials company Dow, followed by American Express Financial Company and Goldman Sachs, and then Boeing, just kind of in the same theme that we've been talking about. A lot of these names were really beaten down. Then if you look in the lower right, we got Procter & Gamble and Walmart. Those are up the least, and those are, of course, staples. I will say just one more, if you can bear with me here. We're going to look at the sector action. Real estate up almost 20% on the week, along with materials, financials, and then utilities. So defensive, value, and whatever real estate is right now, those have been leading this week.
Yeah, I think it's hard to say, Jared, whether real estate is a safety trade, which it had been, whether it's just a disaster because no one pays their rent anymore, but it's something to nibble on. We can leave the jury out on that one for the time being. Of course, as Jared mentioned, the big news today, another announcement from the Federal Reserve. In this world, it seems like a long time if we haven't had an unprecedented Fed action in 3 weeks. But that's how long it had been since we last heard from the Fed. Brian Chung joins us now for more. And Brian, let's start with what the Fed announced this morning, and then maybe we can get into some of the comments we heard from Jay Powell later in the morning.
Well, first they threw the sink, and then they fired off their bazookas, and now whatever you want to call it, but it's $2.3 trillion that they announced this morning before the market bell. This will cover a number of new, again, unprecedented types of liquidity. It's trying to backstop, first of all, the municipal debt market through a separate facility that'll buy short-term debt from states and cities and even some counties for up to 24 months in duration. It'll also target Main Street business lending through their Main Street business lending facility, which they had previously announced. We're finally getting more details on that. $600 billion, which would be was supported by some money from the U.S. Treasury that was appropriated in the CARES Act passed a few months ago. And then another big bit of news expanding the existing primary and secondary corporate credit facilities to take on some high yield debt. But all of these things came just before Jay Powell was set to speak in a webinar with the Brookings Institution, where he said the Federal Reserve is going to do what it can to try to help support the economy. Here's what he had to say this morning.
Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
So Chairman Powell really trying to illustrate that using these three adjectives, kind of, wanting to message to the American public that really the Federal Reserve still has a number of bazookas left, if you want to call it that. Keep in mind, the Federal Reserve used $195 billion of the $454 billion that were appropriated by Congress in its actions today, meaning it still has over half of that money to use for other liquidity facilities, meaning we should watch the Fed to see if it does anything else if market conditions or liquidity ends up becoming a problem elsewhere. Miles?
Yeah, and Brian, I think at this point, it's well established that the Powell Fed is certainly being more proactive and I think a lot more creative than we've seen Feds be in the past. And I think that Ben Bernanke got a lot of credit for what happened in 2008. But with the benefit of hindsight now, I think there was maybe a lack of creativity out of that Federal Reserve. And I think it goes to something Powell brought up today, which is the explicit and clear coordination that they have with Treasury, because Treasury is a group of elected officials, right? That's an administration that people voted for and they want certain policies. And I think it's interesting this morning to hear Powell talk about what he thinks is the duty of the Fed, not to just act unilaterally and act independently, but act in concert with people who are accountable to voters. It's a very different conception, I think, of the Fed than maybe the academic one that was held, just 10 or 20 years ago.
Absolutely. And what's not only unprecedented about the nature of these facilities, because again, as you mentioned, these types of things we've never seen before. We've never seen the Fed go directly into, fallen angel level of debt to try to prop up and make sure that there aren't a wave of defaults. So we haven't seen them go directly and buy muni bonds through these types of facilities before. But when you mentioned the coordination between the Fed and the Treasury, you actually had Jay Powell using his remarks this morning to pretty explicitly lay out that that's not a preference. That's not necessarily a nice to do kind of gesture that the Federal Reserve does. That's statutorily required. So the Federal Reserve does have emergency lending powers under Section 13.3 of the Federal Reserve Act, but it can't just go out and directly buy things. So we have to understand that the Federal Reserve does require the approval of Treasury when opening up these types of liquidity facilities. And we could argue to what degree semantically you even want to characterize some of the actions today as the Fed going out there and providing $2.3 trillion of loans to the economy as quantitative easing or trying to expand its balance sheet. It's separate. The Fed's not buying a lot of the direct things that it announced today. These are actually being purchased through a special purpose vehicle that's being funded and provided with equity or credit protection from the U.S. Treasury. It's not technically the Fed adding munis or adding ETFs that are high yield onto its balance sheet. And I think that's an important distinction for a lot of people that are watching this.
And, as someone who wants the state to expand its fiscal capacity, I love to see it. You love to see the Fed saying there is no limit to the money that can be spent. But Jay Powell essentially saying to Mnuchin, and Mnuchin gets the message, maybe all lawmakers don't, that they have to say how much the Fed can do, and then the Fed goes and does it. And that is exactly what's happening here. All right, Brian Chung, thanks for that. We'll talk to you later in today's program. Let's move on now to the coronavirus. I'm bringing Anjali Kemlani now for the latest, Anjali, on where case counts stand here in the U.S., around the world, and whether those curves that we have seen some encouraging news out of in the last couple of days are indeed continuing to flatten as we head into what the administration has told us will be the toughest couple of weeks of this outbreak.
Absolutely, Miles. And it is turning out to be a really tough week. If you could just look at the epicenter really in New York, which reported more than 7,000 deaths in total now. And that's an increase of almost 800 in just one day. Saw their deadliest day today. Meanwhile, we know the numbers globally, more than 1.5 million cases and over 93,000 deaths. In the US, the total is more than 450,000 with more than 15,000 deaths in total. So yeah, we are seeing, that trend continue where while the death rate does increase, and this is obviously as a result of, cases that were seen 2 weeks ago, that's sort of playing out in terms of those who are on ventilators or those who were in severe conditions passing, unfortunately, we are seeing a decrease in hospitalizations, including in New York City, New York itself, as well as in New Jersey. So promising news, for the outlook. And that's exactly what the experts in the coronavirus White House task force did say would happen. Meanwhile, we also did hear some good news. Prime Minister Boris Johnson is in fact out of the ICU, but he's still in the hospital right now, waiting to being monitored for continued symptoms. Miles.
All right, Anjali Kemlani with the latest on the coronavirus update there. All right, let's move on to the week that has been for President Donald Trump. We'll bring in Rick Newman now for the latest Trump-ometer score. So Rick, we've talked over the last couple of weeks about kind of the difficulty, I think, in judging this particular outbreak with the context of what we wanted the Trumpometer to do, which was measure Donald Trump's economic policies and how they changed economic behavior here in the U.S. But this morning, another startling number on initial jobless claims. We've now had about 15 million people file for unemployment insurance in just the last 3 weeks. What's the Trumpometer telling us this week about where things stand in the U.S. economy?
Well, we've got the stock market up nicely, about 10%, it looks like so far this week. So the market apparently is optimistic about some kind of breakthrough coming in the relatively near future. However, terrible news on jobs, as you point out, and this market rally is pretty flimsy. This could be a bear market trap, as we've been discussing all week. A couple other things I'm watching, Mild. First of all, the economy now depends on an urgent public health response. Right now, it's not about economic factors, it's about public health measures. And there is still no plan from the Trump administration for reopening the economy. We've talked about this so many times, but we have to keep repeating it. We need massive widespread testing for the coronavirus. We need antibody tests and many other things in place before businesses can reopen and people can get back to work. And we're just not seeing it. So there have been several sad readings on the Trumpometer during the last few weeks. That's the lowest level. He's ticking up 1 notch this week, merely failing, but I think we could have some bad news coming in future weeks.
Yeah, I think, Rick, it's going to be really interesting here to watch. And, some people I've talked to in the market, they think that the next 2 weeks is when there's a handoff, as it were, from the market focusing on the coronavirus data, which, as Anjali outlines, is still startling, but getting relatively better in the U.S., and a firm handoff to how much we react to that economic data. Because, Powell was asked about it this morning, and he kind of punted on the question, but it's something we've discussed here almost every day, which is on the other side of this reopening, we're still in recession, right? And there's still a really long way to go. And you don't just reopen and everyone runs back out and makes up those trillions of dollars in lost activity we're going to see in April and May.
I'm puzzled about what makes investors so optimistic. We haven't had second quarter earnings yet. We're going to start reading at bank earnings next week and a bunch of earnings after that. They're going to be first quarter earnings and they're going to be down, but second quarter earnings are still 3 months away and they're going to be dreadful. And I just don't understand how investors bidding up stocks think businesses are going to reopen and people are going to go back to work. Flattening the curve does not mean it's safe to go outside. You've got to press that curve all the way down to the floor almost before businesses can reopen. And we're talking about it, but I'm not seeing it. I'm not seeing the light at the end of the tunnel that Trump says he is seeing. I just need to know, what is going to persuade people to go back to work when everybody knows the virus is still out there? We haven't done anything about it. Is wearing a mask going to be good enough? Is more hand washing going to be good enough? I just don't think so. So I remain pessimistic. I think we still have to get over a major hump here.
And Rick, one thing that has been made clear in my mind is that local officials matter more than ever before. Perhaps people who didn't even pay attention to what their governor had previously said seem to be tuning into daily live streams, daily updates. When you think about how important Trump's rhetoric actually is at this point, even Nikki Haley was penning an op-ed in the New York Times, I think yesterday, saying, the attention should actually be put on all of your local governors, because this is very much, a city by city, state by state thing. We know that the state of California actually declared a national emergency, I think a week and a half before Trump even did. So how vital is Trump's rhetoric here, even in terms of getting businesses back open?
It's a great point, because Trump does not have the authority to reopen anything except the federal government. He cannot order states and cities to allow businesses to reopen. That's up to governors and mayors, and it's up to the businesses themselves, and it's up to employees. So you've got, look at the map of what's happening in the United States. So we're getting close to a peak of infections and deaths in places like New York, where many of us are, and in New Orleans and Detroit and some big cities, but it's just starting to pop up in some smaller cities and also in some rural areas. So we're going to have these cascading closures. And even when it is okay for some businesses to go back to work, it's going to start very, very gradually at first. And what's it going to take to reopen restaurants? This is just a question for normal people in cities. When are you going to go feel comfortable going back to restaurants and sitting next to people and not jumping off your chair when you hear somebody cough?
Yeah, those trendy.
It's a long ways off.
I know that all I do when I watch television now is I remark at how close everyone is standing to each other, because it's still jarring. And I wonder how long that's going to go on for, at a minimum.
Well, think about this. What does everybody do now when you hear somebody cough? You go, and you look around to see how close that person is to you.
I mean, I would even say this, Rick, like I don't hear anybody cough because I'm not around anybody. So like we need to first be comfortable being in the vicinity of another human who isn't someone that lives in our home. And then we can start worrying about what it's like when they cough, which, and to your point, I don't imagine it's going to be like a not jarring, disturbing experience. But
yeah, so we've been through this many times, but it bears repeating until we get there. We need massive testing, and very concerning. The Trump administration indicated this week that it actually wants to get out of federal testing and turn it all over to the states and to the cities. I don't think that is the right way to go.
And I don't think that those states have the capacity to do that as well, because they, as per our previous discussion with Brian Chung, they play by fiscal restraints. The federal government does not. All right, coming up on the other side of this break, we're going to talk about one of our favorite companies here, Tesla, and Adam Jonas's call out of Morgan Stanley that the company could end up stronger than before on the other side of this coronavirus recession. We are back with that call right after this. All right, welcome back to Yahoo Finance Live. Miles London here in New York. We've got 40 minutes to go in this trading week. Looking at the markets here, coming off our lows of the session, the Dow and the S&P now up about 1% as we head towards, again, what will be the final closing bell of this week. Let's turn now to our call of the day. Today, we've got a couple familiar faces for final round viewers here. We've got Adam Jonas, Morgan Stanley, out on shares of Tesla. And Jonas writing about Tesla's competitive advantage possibly increasing on the other side of the coronavirus shutdown. And Rick Newman, I think no one disagrees that Tesla has an advantage in the electric vehicle space and that there's a lot of things Tesla does far better than its competition, which was expected to come online soon, but maybe is facing some setbacks here. But I just find it's kind of like, to my mind, is buying a Tesla or is electrifying your house or your car, how far down every consumer's personal shopping list does that fall as a broad concern on the other side of this? Really goes back to our behavioral conversation on, okay, maybe a Tesla is cool, but if 2021 was your target year, does that roll to 24, 25, 26 after this?
We're going to find out. This is basically Tesla's first recession as a real automaker. This is a cyclical industry, whether you're a luxury brand or a mainstream brand, and it just stands to reason that Tesla's going to get hit just like everybody else. So Adam Jonas's point in this note is that Tesla basically has first mover advantage in the electric vehicle market, and I think that's reasonable. It's their whole company. It's all they do is electric vehicles. They don't do gas powered vehicles. So that's where they put all of their R&D, and they are ahead on that. I think you have to think about the other side. First of all, the other automakers have been through recessions before. They have been preparing for a downturn for a long time. And they also have gas vehicles to fall back on. Now, what have we been seeing lately? A plunge in oil and gas prices. That is going to hurt demand for electric vehicles, at least among people who like them because they think it might be cheaper than a gas vehicle down the road. Tesla is a premium brand, so their buyers aren't as worried about that. But this is going to be a giant downturn in the auto industry. And sure, on the other side, the big automakers may have to put off R&D into electric vehicles because it's a relatively small part of what they do, which could help Tesla get ahead a little bit more. But that's way down the road, man. I mean, Tesla has to get through this giant ditch first.
Yeah, and I think another thing we haven't yet talked about is China, right? And it was interesting to even track COVID-19 from the China angle and see what kind of repercussions there would be here in the US. And the Shanghai Gigafactory, of course, initially met with skepticism, wondering about Elon Musk's timeline, had been relatively successful. And then, of course, a couple months into opening, they had to shut down because COVID hit them hard early on. I think, according to Jonas's note, he points out that China Passenger Car Association says Tesla's sales hit a record high in March. So we anticipate that demand may still be there on the other side of this as China slowly recovers. And then another point, as Rick was mentioning, of course, there are other players in the space. We're supposed to be expecting that electrified Hummer, but all of those additional things have been delayed, right? People who perhaps were waiting out, maybe were saying, hey, I don't want a Tesla, I want this OG car that now has an electric spin to it. They would have to wait an additional year, 2, 3 years to potentially get that in their hands. And then the upstart here is Rivian, right? And they have delayed 2 of their models to 2021. So I think just the landscape at large, in this case, being deeply entrenched, having household name recognition certainly helps.
Yeah, I mean, this is a giant hit to any company that makes cars. Let's remember, Tesla wants people to think of it as a technology company. It is, but it's also a manufacturing company, and it's a cyclical consumer company. It is highly sensitive to downturns such as the one we're seeing now, and that includes in China. I mean, there's a big downturn in China too, and Tesla vehicles are a premium product there as well. So Tesla's going to be hurting. So we have to wait and see what happens to Ford and GM, for example. I don't think GM, for one, I don't think they have said yet that they are delaying development of that electric Hummer. That's a real high-profile electric vehicle for them. But there's speculation that they're going to have no choice. I mean, there's a giant crimp on cash flow at all the automakers right now. Something has to give. So what's going to give? We don't know that yet. But Melody, you're right. The speculation is, since this is not yet the bread and butter for companies like Ford and GM, electric vehicles, good chance that that's where they delay some of their spending so they can get back some of the spending just in the big trucks and SUVs where they make their money.
Yeah, and I will say there's a lot, I think from a fundamental standpoint, a lot to be desired about the way that Tesla has capitalized itself. But one thing you can say is they're pure play in the EV space, and they are not going to have any of the problems that a Ford or GM or other competitors are going to have in terms of just trying to hunker down and survive the next 18 months. Tesla, I think, has a little more flexibility there. All right, coming up on the other side of this break, we're going to talk to Financial Freedom CEO Julia Carlson on how to rebalance your portfolio to take advantage of low rates right now. We'll talk about that coming up right after this. All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. It's time now for Retirement Ready, brought to you by Fidelity. So we've seen a lot of dislocations in the market. A lot of things about investing now are different than they were just a month ago. How can retirees and savers maybe take advantage of some of that? We're joined now by Julia Carlson. She is the CEO of Financial Freedom. So, Julia, I think a lot of retirees are just normal folks like us saving for retirement, have 401ks, IRAs. We're just trying to maybe forget our passwords right now and not look at the damage that may have been done. But what are some things that we can do? We've talked a little bit on the show about rebalancing your allocations if things got out of whack during the last month.
Yeah, thanks for having me. And of course, if you were in retirement and you had a balanced portfolio, then for sure, most likely, things got out of whack here. So considering to rebalance your portfolio definitely makes sense. Hopefully that may have happened a week ago when the markets were lower. We've had quite a comeback here. We are not adding risk to portfolios at this moment, but I think rebalancing to how you should be allocated would be very appropriate.
And then we've seen rates come down a lot. There's been many times over the last several years when it's been like, all right, you got to refinance now because rates will never get lower. And then they always did go lower. So what are some things that people can do right now maybe to take advantage of those?
Yeah, for sure. I would recommend looking at your mortgage and calling your banker, calling your mortgage company, seeing if it does make sense for you to refinance. Also, what we are doing for our clients is looking at Roth conversions. So this could be an opportunity right now where if maybe you are still working and you if your income is going to get jeopardized this year and you have a lower income, it could make sense to do some Roth conversions at this time and then allow your portfolio to come back and recover inside a Roth IRA.
Hey, Julia, Rick Newman. I've seen some reports with concerns that some companies that are at risk of closing have 401k plans they administer on behalf of their employees. It could be a couple 100,000 companies, each with a bunch of employees who would be at risk. Should you be doing anything if you think with your 401k, if you think your company might close, or does that just all get worked out?
Boy, so it would get worked out, and it would to be able to take action now, you'd have to make sure that your plan had in-service distributions. So if you were concerned about that and your plan allowed for in-service distributions, that would be something that I would consider if your company was going to be at risk of closing. But it would be figured out. I mean, that is what ERISA is for.
Yeah, I guess if your administrator doesn't go out of business, then I guess that your money would be secure in that fund. Is that correct?
Well, correct. Yes. Yeah. Well, secure in the funds. Yes, the funds that, it doesn't guarantee the value, obviously, but yes, you will have those funds in there.
All right. Julia Carlson is the CEO of Financial Freedom. Thanks for joining us. Have a great weekend.
Yeah, thank you.
All right, coming up on the other side of this break, we're going to talk to Sam Hendel, the president of Levin Easterly Partners, about this market, how we may have overshot on the rebound from those lows, and if there are any similarities to the financial crisis as we navigate this period for investors. We're back with that conversation coming up in just 2 minutes. All right, welcome back to Yahoo Finance Live. Miles Udman here in New York. Let's take a look at this market and bring in Jared Blicker here. Jared, we talked, I think, exactly 30 minutes ago, and the market was really selling off here. We're now bouncing considerably off those levels. More volatility in this market as we head towards the week's final closing bell.
Yes, we are seeing the markets bounce back here. S&P 500 up 1.5% now. And we're going to look at the intraday price action on a candlestick basis. We can see that we took out the lows of the day. We had new session lows here, but now we are rallying pretty strongly. And we'll have to see anything that happens in the last 30 minutes, really subject to large influxes of money or outfluxes of money for that matter, especially ahead of this 3-day weekend. But I want to spend a little time on crude oil. That has been one of the big drivers today. And we can see that we had, it was all the way up to about 28.5, and then it just sold off on all this disappointment over OPEC. Looks like OPEC, meaning Saudi Arabia and Russia, they're going to agree to about 8.5 million barrels per day in production cuts. But the market was thinking maybe as many as 15 million. And so without any further cuts, there's just a lot of disappointment here. You can see 22.5. That's a pretty low number. We had been in the high teens about a couple of weeks ago, but really a lot of disappointment here today with crude oil in that OPEC Plus agreement.
All right, Jared Blicker with the latest on today's market action. All right, let's bring in our next guest. Sam Hendel is the president of Levin Easterly Partners. And Sam, the last time we spoke, it was a couple days after the Super Bowl. We were about 3 weeks away from the first confirmed COVID case here in New York City. The world, in a word, was in a completely different place. And so now we're in this environment that's very much a crisis period for investors. As you see the landscape right now, are you trying to draw any comparisons to prior periods, or is this kind of, you're just going to see what happens and just sort of be patient with this market?
Yeah, I think the corollary is really the 2008, 2009 period. It's different in a way because 08, 09 was really driven from the inside. It was the financial, it was Wall Street that collapsed, and that reverberated out to Main Street. And here you have a completely exogenous event that's really starting to hit on Main Street. And you're seeing some pockets of distress. The shadow banking market on Wall Street has been very weak, but the Fed has stepped in nicely here to really provide a put to the market. But I do think, for our purpose of investing, we're really trying to go on the same playbook, buying good companies that are down in value, down in price, and have catalysts to unlock them, and not trying to call a bottom here.
And so I guess, Sam, as you look to these opportunities, I mean, have you been more aggressive than you would have been deploying capital into some of these names you really like, or are you still kind of exercising some caution, not because you're trying to pick the right timing on any of these names, but just because at a time like this, it's often, or many people often say, it's more prudent just to have more dry powder, just in case kind of something happens?
Yeah, I mean, I think that what we're doing is not trying to call a bottom on, when business gets back up and running, and really just trying to be, trying to pick good stocks. I think it's very difficult to know the long-term effects of what this is going to do to certain industries, certain companies, and there's not that much information, and a lot of it will depend on when there's some a pharmacological cure to ameliorate symptoms, and I think that'll sort of drive when businesses get back to work. But trying to call when everything's going to be normalized is difficult, and I think there are going to be some real long-term effects from this crisis.
Hey, Sam, Rick Newman here. So I have a softball question and a real question. Softball question: is that book over your right-hand shoulder really called 1001 Beers?
It is called 1001 Beers. It's a great book.
I thought so. Excellent. What is your outlook for how we get these businesses reopened? When do you see that happening? And what is the phase of the starting over, if you will?
So you have certain industries that are still operating. Some of the essential supply chains that we need, in particular, food. The farm season is actually going well. People are still getting food into the supermarkets. It's a little more challenging to get it than it used to be, but. I think that we are going to start, and there's a political element as well, that the politics want the economy to get started again. And that'll probably drive things a little more to start sooner rather than later versus maybe the healthcare community that would want to be more cautious. But I think it'll be a slow start, and I don't think it's going to be business as usual. After September 11th, travel still took a long time to come back. And I think, unfortunately, the social distancing is going to be a thing until we have a vaccine, until we have something that cures the symptoms of this disease and lowers the mortality.
All right, so Sam, let's just talk about a couple of names that you like here and a couple of companies that you think are well positioned. And I guess I would ask along those lines, were these names that you had already been looking at, prior to this, or did you come into this period and say, well, I think this, that, the other about how the recovery goes, and I like these names for certain reasons that are new to me at this point in time?
Yeah, I'll mention two new positions that aren't new to us in terms of knowing the companies, but they're new in our portfolio. One is International Paper, and the other is Tyson Foods. And part of part of the really downdraft in the market was a huge dislocation and a lot of good companies that wouldn't be as affected by the COVID-19 crisis as their stock price might have shown. So International Paper, it's a cyclical business, but it has a defensive component. About 75% is for packaged food, for e-commerce, and with COVID and everyone at home, the only thing people are purchasing are things online and food. So they make all the corrugated boxes. They make the corrugated paper that goes into the boxes that we're all getting from Amazon, and that business is benefiting from what we're seeing, with the big change in everyone's lives. And similar is Tyson Foods. Tyson stock went from 95 down to 45, and they do have exposure to the prepared food market, so food in cafeterias. And we spoke to the management team. They're like, yeah, we're taking all of our lines that we're doing prepared foods, and we're just converting them to packaged food because on the packaged food side, they couldn't sell enough of it, and it's actually higher margin business. So that stock's rallied a little bit from the lows, but we still think it's really compelling here because their business is actually better in this environment in many ways than it was before because of the quantities of food that people are buying in their homes.
Yeah, it's interesting. I think just, specifically on the Tyson point, we're all learning so much as people who maybe didn't think about supply chain distribution on the differences between commercial, residential, restaurant versus consumer, all that stuff, and how that breaks down for companies. All right. Sam Hendel is the president at Levin Easterly Partners. Thanks so much for calling in, and we'll talk to you soon. All right, coming up on the other side of this break, we're going to talk a little Disney Plus, racking up a record 50 million subscribers in just 5 months. We'll talk about how Disney has been able to leap ahead some of their streaming competition and what's next for them as everyone stays at home, presumably watches more content, but how much do they want to pay for all of it? We'll discuss coming up right after this. All right, welcome back to Yahoo Finance Live. Miles London here in New York. Let's take a look at this market quickly. We got 16 minutes to go in today's trading session. The Dow, S&P both up over 1%. NASDAQ, the relative laggard here. But again, we were looking at the market losing pretty much all of its gains as we came on the air at 3, but now a little bit of stability as we head towards the closing bell. We'll keep an eye on that over the next 15 minutes. Let's turn now to some news out of Disney released just last night about how many subscribers their Disney Plus service has, over 50 million around the globe. And Melody Hom, I think, it's another reminder of, one, how well Disney was positioned ahead of Disney Plus. I think they've done a good job in getting some pretty big numbers in these last couple of months since the launch back in November, and also brings to mind, like, how big can this thing really be? Because in many ways, the coronavirus, the perfect catalyst for a new streaming service, especially if you have the brand recognition Disney does.
Yeah, brand recognition and, of course, backlog of content. I think the key differentiator that we had speculated all along was that they just have archival footage, right? Anything from The Lion King to recent movies like Onward, just narrowing that time of distribution between hitting the theaters and then hitting the platform. They can squeeze that. They can make it available today, right? And that's what they did for that newest film, and even films like Frozen 2. But I want to say that the global expansion has been a lot more rapid than anticipated. And as we know in the analyst community, it's all about managing expectations, right? So in this case, Disney actually managed it pretty well. We know the latest number, 50 million, that's the update to 29 million, which was first disclosed in February. So if you think about the growth even over the last 2 months, with or without coronavirus, I think entering the Indian market and entering a lot of Western European countries, which of course many of those countries have been hard hit from COVID-19, actually, the India partnership with their local service Hotstar makes up 16% of the total user base right now, which just shows how much appetite outside of the US there really is. And then just thinking about moving forward, earlier today, Gary Cohn said on our programming that this is a perfect taster, amuse-bouche, for when the Disney parks reopen, right? So for a lot of kids who had never been to Orlando or to Disneyland here in LA, this is going to be on their minds as people look for that comforting vacation. If they're going to be traveling, they want to go somewhere they know that they love. So I can anticipate this is going to be the perfect pipeline for future Disney projects, which have been on hold, unfortunately.
Hey guys, we've been talking all week or all month really about some businesses that just happen to be in the right place at the right time. The other online gyms, of course. And I keep thinking to myself, yeah, but how many of these new subscribers are going to stick around once we start to go back outside and go back to the places we used to spend our time? So, Melody, do analysts think that Disney's going to keep all these new subscribers, or do they think that some of them will sort of trail off at some point?
I think the overall sentiment is wide shock that they were able to reach this milestone so early. Analysts were thinking that they would hit that 50 million in 2022. So to your point, a lot of, I think 30% of the user base, they signed up with that free trial with Verizon. So we have to give our parent company, I guess, a lot of credit for making up a huge bulk of this. But I think it's stickier than anticipated. We talk so much about, once you binge watch one show, you'll quit this platform. We realize that's not the case with platforms like Netflix, at least, where there's always a new piece of content, a new morsel to bring you back. So I think if Disney is able to ramp up production post-pandemic, you can anticipate that $4.99 is not that much per month that people will be actively thinking about quitting.
I think the question here for me, Melody, is you look at how big that number is. So 50 million, and I think it really comes down to replacing ESPN's lost revenue, right? So ESPN is now in the low 80 millions of households, and ESPN is probably getting, between all the regional networks, like $12, $13 per subscriber, something like that. How much can Disney make up what they know is going to be a decrease in not only its revenue, but most importantly, its profit out of the ESPN business with Disney Plus? And I think, as you mentioned, the $4.99 price point, very attractive right now. I wonder how aggressive Disney wants to be in getting that price point from $4.99 to wherever it settles out at, $8.99, $11.99. How much more can they bundle in there to try to drive more value out of this, and actually some profit? Because right now it's a loss maker, but ideally this is a new profit center for the company, 5-10 years down the line.
Exactly. And I do anticipate, especially with the Hulu ownership now, as they continue to bring on more premium content, which, to be honest, that word premium has gotten diluted, right? With the advent of all of these streaming services, we don't really know how to differentiate all the time between a Showtime and an HBO, and then something that would just air on CBS. So I think it's going to be very difficult and challenging for Disney to actually up this price point from here, because we know that initially there was so much happiness and sentiment around this price point, because at first it felt like there was no chance they could compete if they were going to enter at a $7.99 or an $8.99. I think it'll be difficult to keep consumers if they double that. I can see an incremental $1 or $2 perhaps really changing the landscape, though.
All right, Melody Hom, the latest on Disney Plus's potential future trajectory here for subscribers over the next several years. Coming up on the other side of this break, we're going to talk to our old friend Joe Fahmy about what he makes of this market rally as we head, well, I guess it's a rally. We'll call it a rally. We'll talk to Joe about whether he thinks it's been a rally off the bottom and what he makes of this market period right now. We are back with that conversation coming up right after this. All right, welcome back to Yahoo Finance Live. Miles London here in New York. We're joined now by Joe Fahmy, Azure Capital. Joe, it's been a while since we've talked to you, man. Good to see you in these interesting circumstances. I guess I'd just start with what you're making of this market right now, how you're thinking about a market where everything kind of felt like it changed overnight, and maybe now we've had some time to let at least some of the dust settle.
Yeah, no, thanks for having me on, and great to see you. I wrote an article for you guys for Yahoo Finance. It was about 2 weeks ago, and I was basically trying to say that, you know, to remain, it's okay to be cautious, but not to get too negative on the markets. And I was saying that I was fairly optimistic overall for a couple of reasons. First and foremost is the market's a discounting mechanism, meaning it tends to trade on what's going to happen 6 to 9 months from now. So I was just telling people to be open-minded that it's possible that the market is possibly discounted and priced in all the negative news already, and just to be open-minded to that.
And, you know, Joe, I remember talking to you back in 15, 16 about the idea of we were entering a new leg of the same kind of post-crisis bull market. And that really thinking about it from 2009 to whatever point in time we were at was misunderstanding the market. So I think there's been so much conversation now about actually 18 to now was a cyclical bear market, and this is just the end of that period. I mean, are you thinking in periodization right now, or do those kind of distinctions not really do much for you in terms of framing what's happening in this moment?
Yeah, that's a great question. I think people should be more concerned with, it depends on you if you're a trader or if you're an investor, be more concerned with, whether we're in an uptrend or a downtrend. And if it's a longer term time frame, people could say we're in a big, huge uptrend. If you have a shorter term time frame, this could be a rally within a bear. But I don't get too concerned with those, specific characterizations of the market. I just look to try to follow what the big institutions are doing, what individual stocks are doing. And that was another thing I mentioned that in that article, is that a lot of stocks surprisingly snap back pretty close to all-time highs or new highs in a lot of the growth areas. So that's what I'm using to judge the health of the market versus getting caught up in all the macroeconomic stuff.
Hey, Joe, it's Rick Newman. What are stocks anticipating in terms of earnings? I mean, we're barely getting into first quarter earnings, and that's not even going to be the worst of it. Those are only going to partly reflect the coronavirus meltdown. Second quarter earnings still 3+ months away. How much bad news can the market take from earnings?
I mean, that's great. I think it's just sector specific. So I noticed a lot of software names coming back pretty hard. I noticed a lot of biotech names, medical products, semiconductors that have a little bit more stability, where they have solid backlogs and so forth. Your question's great about there's also a lot of unknowns in the airlines, in the cruise ships, in some of the beaten down sectors, hotels that are going to get affected by this, in retail. So I'm trying to more focus on the strength and sectors that won't be as harmed, or business as usual, where they can still operate pretty well, especially in something like software, versus the ones that are pretty obviously going to get hit. Now, overall to the markets, that's the big unknown to what kind of number you throw on the S&P as far as earnings to give the S&P a proper multiple.
So, Joe, is it fair to say that the market anticipates a meltdown in the sectors that are getting hit the hardest, but it might be a real warning sign if we saw negative earnings surprises in tech, for instance, or semiconductors, or someplace that seems to be less sensitive to this?
Yeah, I think the market already has priced in. Any company that comes out with a negative warning or they're going to discontinue guidance, I think that's pretty much everyone's expecting that. I think the key will be any sort of guidance they can give. And I think in the next, for the remainder of the year, and I think in the next 3 to 4 months, we'll get an idea, a better picture of that.
And, Joe, it just sounds to me like I hear you saying basically the strong names that got us here are the names that are probably going to get us to the other side of that. Does it seem to you like, just given the way this shock came in, that, those areas that had been outperforming and the areas that had big, strong secular growth stories, that's probably where to look as we look, 12, 18 months down the line?
Yeah, that's a great point. I mean, yeah, of course, things are going to get hit short term, but there's still tremendous growth in many software and, let's say, medical products and semiconductors. Let's pick those 3 sectors because they've popped up the best. There's a lot of growth in there. Of course, they're going to get hit short term, but when you have companies growing 20 to 40% top and bottom line, when we recover, there's still a lot of people moving to the cloud, and chips, as we know, go into pretty much everything. So, those are the sectors that I'm going to be focused on that probably will rebound the strongest.
All right, Joe Fahmy is the managing director at Zor Capital. Joe, great to talk to you. We'll talk to you soon. Stay safe, and hopefully we'll meet you in person sometime soon.
All right, thank you.
All right, coming up on the other side of this break, we're going to have the final closing bell of the week market, hanging on to some gains as we head towards the bell. We're back with that right after this.
Welcome back to Yahoo Finance Live. We are counting down to the closing bell on a day when we've seen the markets back up, despite that big number we got early this morning on the unemployment claim, 6.6 million for the week, bringing that 3-week total to more than 16 million. Certainly not weighing on the markets, at least for now. We are seeing the Dow up 200. And there is the closing bell. Let's get back to the numbers here, though. The Dow up 270 roughly at the close. The NASDAQ up 57. The S&P 500 up 38. Some big moves today, not just on the unemployment claims, but we also got that big news from the Fed expanding its toolkit, announcing a $2.3 trillion injection. We also saw some big moves in oil today. It jumped as much as 12%. On that initial news from Reuters that the Saudis and Russians had agreed to an output cut of 20 million barrels a day, but that certainly throughout the day, doubts about whether that agreement had actually been reached, and we are now seeing oil down as well. Let's kick things off today with what happened over with the Fed. Brian Chung joining me now to talk about that $2.3 trillion injection. So Brian, we have seen the Fed essentially throw everything at this. And this latest injection here, not just targeting small businesses in terms of loans, but also really targeting the local level, the cities and the governments that are certainly going to be a big hole on the back of this.
That's right, Akiko. The Federal Reserve had a number of announcements this morning, a lot to unpack in that $2.3 trillion in loans that it plans to use to support a number of markets. The big headline being those on Main Street, a lot of those businesses that have under 10,000 employees, which kind of were wedged in a difficult spot where they were too large to access any of the loans through the Paycheck Protection Program offered by the Small Business Administration. The Fed saying it'll offer $600 billion to those businesses through U.S. banks. Another announcement is that they'll actually backstop the municipal debt market as well, offering to buy some debt from cities and counties and states from across the country with a duration of up to 2 years. And then lastly, some tweaks to some previously announced programs that would actually expand their scope to take on some below investment grade debt, what they call fallen angels, BB minus types of corporate debt, which it had not announced prior to that. So the Federal Reserve announcing that it basically is going to expand the amount of backstop that's trying to put into the market as liquidity concerns do continue amid the business shutdowns. But Jay Powell speaking shortly after that $2.3 trillion announcement, saying that the Federal Reserve will do more and can commit to doing more. Here's what he had to say in a webinar with Brookings.
Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
So as you can hear, Jay Powell right there using those three adjectives to describe the Federal Reserve's efforts here: forcefully, proactively, and aggressively. And Akiko, I do want to remind you that the Federal Reserve does have another scheduled FOMC meeting this month that will come on April 29. It's not entirely the case that the Federal Reserve won't do anything until that point in time, but worth mentioning that the Federal Reserve does have that on their calendar. Keep in mind the Federal Reserve burned through $195 billion with its announcement today of the $454 billion that were appropriated to it and the Treasury through the CARES Act, which means the Federal Reserve could still do a number of other things. So worth watching there.
Okay, stay tuned. I know you'll be on top of that. Thanks so much for that, Brian. Andy Serwer, I want to bring you in. We heard from Jay Powell there. He was asked at the end of that talk with Brookings, what his message to the country was. And he essentially said, look, there is every reason to think that we can be back on the road to recovery fairly quickly if people stay indoors, if people continue to follow the social distancing regulations that are in place right now. What did you take away from what we heard from him today?
Well, the Fed keeps stepping up, Akiko, and, it's a little bit scary because they keep having to do that. And it's sort of like, the coronavirus on the one hand and the Federal Reserve on the other hand, and it's a mano battle. But, the news is not good on the economic front. I mean, almost 17 million people have filed for unemployment over the past 3 weeks. And so, at first we heard about the Fed using a bazooka and maybe it's an RPG or a howitzer or a field gun at this point, but we keep relying on the Federal Reserve to bail us out, essentially, to stabilize us, to keep us afloat. And, you know, Gary Cohn, President Trump's chief economic advisor, former chief economic advisor on Yahoo Finance earlier today, said that they've basically gone into every equity class except for equities to support the economy. And to me, I think that's two things. It's necessary, but it's also a little bit scary, quite honestly.
Well, I think, Andy, you know, what's interesting about the Fed here is that if you look at what they've done in 2008, they've not only, you know, blown past that, but they've done many multiples more than what was done in 2008. And there were a lot of fears on the other side of that of what would happen to everything, as it were, given the Fed action. And I think, you know, maybe the market's fears will end up being unfounded here, right? Or, you know, to say it this way, if the market's not worried now about what the Fed is doing, maybe there will be reason to be fearful of how the Fed has acted in 5 years' time. But I think there's a lot of insight into how the Fed is thinking about this from what Powell actually said in his speech this morning. And there's one line that I've been thinking about all day where Powell said, "None of us has the luxury of choosing our challenges. Fate and history provide them for us." And I think it's a reminder to market participants, to us as citizens, to the Fed as, you know, monetary policy officials and so on, that I think there are valid reasons to worry about what the Fed does. At the same time, this is the hand we have, and all we can really do is trust that our best intended actions will be enough when this is all over.
Fingers crossed, I guess, is what we can say at this point. All right, Miles, thanks for that. Let's get out to Jared Blickery, who has been tracking all the market action today. Jared, what's on your radar?
Well, crude was on my radar this afternoon because there was some huge swings, and we're going to pull up some charts here at the Wi-Fi Interactive. Here's the S&P 500 up 1.5% today. Not a bad day, although we did have some late day selling because of the crude oil market, and we can see that in this chart right here. This was pretty violent, but we did manage to rally into the close. Russell 2000, another outperformer, up 4% today. Oh, and by the way, it's the best week for the S&P 500 since 1974, and best week for the Dow in 2 weeks, although if you go by points, it is the best week ever. But here is that crude oil chart I was talking about here, and just a really volatile, violent day on a percentage basis. Huge swings. We went from about over 28 down to about 22 and change. And all that has to do with the fact that OPEC Plus, that's really Saudi Arabia and Russia, are only going to cut 8.5 million barrels. That's my big takeaway. But I think what's really the tailwind for the market here is the Fed. Brian was talking about that $2.3 trillion in additional capacity or lending capacity and stimulus, and high yield is just exploding today. So the Fed is going to be buying the disgraced, what is it? No, the fallen angels. And, you know, the Fed is going to get its toes in some energy here. And I don't know if that's a good thing or a bad thing, Miles and Akiko.
Okay, Jared, let's turn to the top headline today on the coronavirus front. Certainly, we've been tracking, of course, the daily numbers coming out. We're inching towards that 500,000 mark for cases here in the U.S. I want to head out to Anjali Kamlani with the very latest on that front. Anjali, there's been a lot made about, you know, some of these communities that have been especially heavily affected by the virus, African-American communities, Hispanic communities as well. What more are we learning on that front?
Yeah, Akiko, unfortunately, you're right. We are heading to a very, poor number when it comes to being able to control this. And this comes at a time when we're battling the idea of testing versus what that means for the country. Are we in fact testing enough, and are we finding these cases in time? So as we know already, New York is getting hit pretty hard, but what does that mean for the rest of the country? We're starting to see those major metro areas really pop up with cases. We know that Detroit is also a major center, Chicago as well. And so looking at that, we've also been able to identify that the minority communities have in fact been disproportionately affected. We've seen that while African Americans make up, say, 13% of the population, 33% of them have been affected by death. And so that's coming from a report from the CDC, which is limited in scope, but it does give us a preview. And we're hearing anecdotally as well as through records from states that are in fact tracking this. And so it touches on a point that was pretty relevant actually before the outbreak, which is that social determinants of health do in fact affect the ability ability for different communities to access health and to get the treatments that they need. And that's coming to light here. And I've heard a number of health experts say, while the president and while Governor Cuomo and others are saying, oh, this is really perplexing, we have to figure out why it is, they're saying we already know why it is, and it should have been addressed beforehand with things like mobile testing sites and making sure that there was in fact access and more attention paid to African Americans and Latinos in terms of testing. So as we know, there was already a shortage and already a limit on who was being tested, but more attention should have been paid there. So we'll see how this pans out and whether or not the coming weeks do in fact show a continued trend line there. But we're waiting to see on that, Akiko.
Yeah, no question. One of the things we've learned throughout the last several weeks is just how glaring those inequities are and how that's likely to increase on the back of all this. I'm curious, you talked about the availability of testing, and now that we know that some of these communities are more heavily affected than others, have we heard from sort of local governments about whether they're likely to shift the testing, or is this really just about availability overall?
We do know that Governor Cuomo today did in fact say that there will be attention paid to that and more testing done for African Americans. And we're waiting to see how other states as well respond. We know that a number of them are paying attention and tracking closely. So while we do know that there is still a limit in terms of who does get approved for testing, we're hoping to see that number does increase when it comes to these minority populations.
And, Anjali, I was talking to a doctor in New York City just the other night, and she was telling me, some good news potentially, which is that the ERs there are starting to get a little bit more quiet, which maybe points to the flattening of the curve. Another thing she told me, which I wasn't really aware of, was the death toll numbers that you see, which are so horrifying, but that they only reflect the deaths that are in hospitals. So correct. Actually people who are dying at home, and I don't know if we have any idea of what percentage, say if you've got 5,000 people who've died, well, are there X thousand more who died at home or aren't even counted, right?
Right. So there has been debate about that. And I know that the White House task force has, in fact, heard some of these anecdotes as well, and whether or not funeral homes are, in fact, reporting these cases out. We know that it's a really tumultuous time with so much information, coming at them. So it does remain to be seen whether or not they're counted, in which states they might have already been counted or not. But there have been concerns about over or under reporting. And that is generally true, just as we're talking about testing, over or under reporting on whether or not these cases that exist are actually counted. So the numbers, while we watch them closely and continue to track them, as I've said before, epidemiologists use them as sort of a gauge of where the virus is spreading rather than an actual factual number.
Okay, Anjali Kamlani, appreciate that update for us today. Let's turn our attention back to the markets today. And we are looking at a specific stock here, Tesla, for our call of the day. That stock up more than 4% on the day after Morgan Stanley put out this note saying the disruption caused by the pandemic could end up being a positive for Tesla. Now, specifically, analyst Adam Jodas pointing out that the cutbacks in investments from some of Tesla's competitors could end up giving Tesla a big boost. Miles, you took a look at this note. I mean, I'm not sure the argument that suddenly because some of the competitors aren't necessarily investing, consumers are going to go directly to Tesla, because we don't really know what the behavior is going to be like, the consumer confidence is going to be like on the back of this, right?
Yeah, I think there's really two concerns there. And the one you flag with consumers gets a little bit short shrift, perhaps, in this note. But I think, if you're working from an assumption of X number of people are going to buy electric vehicles, and therefore Tesla has an increasing percentage of those consumers, then I guess slight dents in consumer confidence you can explain away through that model. But I do think there is a lot there when you consider the pressure Tesla's competitors are going to come under. I mean, they bring up GM as an example. GM has a lot of problems in its traditional auto line. And I think if electric vehicles and expanding that line and improving their technology, I mean, those are considerable capital outlays for a company that, like many other companies, is going to be facing a cash crunch in the second half of this year. And so, while I'm certainly not a huge Tesla bull, I think there's a lot to the idea that the way Tesla's singularly focused on electric vehicles does enable it to perhaps gain a relative advantage over competitors on the other side of this, even though the overall size of the electric vehicle, the high-end electric vehicle pie might shrink. If Tesla goes from 60 to 80% of that, maybe they can come out fine on the other side.
Well, Miles, the tenor of this note was something that I was talking about a couple days ago, which is on a relative basis. I think Tesla could emerge from this in better position than, say, the legacy automakers. However, I caution you, I caution me, I caution all of us having any kind of preconceived notions because of this coronavirus situation. And I was talking to Adam Marath, who is the GM of our Autoblog property, our sister property here, and he was saying how Jeep orders are trending upwards because the thinking is that once people are out of this thing, they're going to want to hit the road and go outside and explore and really have a vacation. So, the if-thens that will emerge from this crisis are just so unknown. Because what I was thinking with this note is that a lot of people were buying them and it will sort of continue and the other guys will continue to worse. But, Jeep, it's part of Chrysler, right? Who knows?
And, Andy, to that point, and now just to make it anecdotal, right? You left New York. I'm sitting here in New York thinking, is this the place that I want to be for as long as I thought? And so then if I leave, do I have to buy a car? I would buy a car. And I think there's an assumption that auto sales, because they were so hard hit during the last crisis, would take a similar kind of dent for, your Fords and your Jeeps and your other traditional automakers. But, and we don't know, but if there's an acceleration of out of the city into the suburbs, maybe there's a larger generation of auto buyers out there. Now, I'm not going to be buying a $50,000, $80,000 car. I'd probably buy a used Honda, but still I'd be buying a car. Whereas previously I was, not thinking about it for 5 or 8 years.
Well, and the other argument on the bad side of this, right, is that not just with cars, but specifically with electric vehicles, there's been a lot of notes that have been put out about this whole issue of climate change being put to the back seat now, because a lot of companies are not necessarily going to want to invest in that front. So you have to think that that's going to hurt a company like Tesla, even if people who are going to buy EVs are still going to go out and feel confident enough to go. You have to wonder if the investment is still going to be there at a time when companies are still going to be struggling.
And Akiko, gas prices probably going to be cheap for a long time.
Exactly. So there's one more case against it. All right, we're going to head out for a quick break, but coming up, we're going to be talking about one organization that is pitching in hospitals, of course, in huge short supply of some of these critical medical supplies. We've got one company who is helping meet the need there with 3D printing. We're going to hear the story behind Make for COVID on the other side of the break. Welcome back to Yahoo Finance Live. Well, amid the shortage that we've been hearing from a lot of these hospitals for these critical medical supplies, one company is stepping up in an unusual way, 3D printing technology, using that technology to, of course, help fill the need for some of these critical supplies. Let's bring in Harris Kenny. He is Kenny Consulting Group Principal and the organization behind Make for COVID. Great to have you on today. Let's start by talking about exactly what Make for COVID is doing right now to help some of these critical supplies get to these hospitals.
Sure, thanks for having me. So Make for COVID is fitting in this rapid response need where you have larger manufacturing organizations are turning the wheels of getting their production lines shifted and ramping up big orders. And then you've got volunteers on the other end who are making little one-off donations and things like that. And Make for COVID is a co-op that's really operating in the middle. So we've delivered close to 6,500 pieces of PPE. We're scaling up to 10,000 units a week. And we're doing it with a distributed manufacturing base by having a bunch of different small businesses and libraries and people at home contribute. So it's that scale plus the speed is what Make for COVID is doing that's really different.
How closely are you working with some of the local governments? I know in places like LA, for example, the mayor there specifically reaching out to 3D printing companies that are based there to try and sort of, streamline the process. Are you getting a lot of inquiries on that front?
Yes. So that is how Make for COVID got started. Governor Jared Polis here in Colorado basically put out an ask saying, look, we need help making PPE today. And so the organization was started in response to that. And it's the close relationship with the hospitals and local governments. One quick example, the Civil Air Patrol, we've been partnering with them and they helped with an airlift and flying PPE out to Gunnison, a couple hundred miles outside of Denver, because the town is shut down and the roads are shut down. So in close concert with rural hospitals and folks all over the state to get this equipment delivered, those relationships are the thing that's been tough because everyone's busy right now.
Hey, Harris, just a question about the actual manufacturing process of what you guys are doing, because, I remember, I guess it was 8, 9, 10 years ago, 3D printing, very buzzy technology about how it was going to change a lot of different things. But it seems like there have been a lot of stories now about, where 3D printing fits into PPE and other kind of industrial goods. So where's that technology coming? How complicated is it for you guys to get this stuff out the door? And what pieces of equipment exactly are you guys making?
Yes, so that's a really important point to make. So there's a couple of different ways that people are using digital fabrication, 3D printing, laser cutters. The most basic, sort of you imagine like a crawl, walk, run. The most basic thing is a face shield, which uses a 3D printed component and then a PET transparent material. And so those are printable. We've got standard operating procedures that are reviewed by physicians and approved to keep everything clean. You've got more industrial, like metal 3D printing that's being used for replacement parts for ventilators and things like that. Our project right now is focused on where there's an immediate need, but we've got some longer term engineering teams working on some of those more advanced potential ways to help.
Hey, Harris, how did you get into this?
Well, it's a collection of a lot of different people. The organization has over 1,500 different volunteers now from across the state and a lot of familiar names. A lot of small business owners, people from the maker community, and everybody's volunteering. And so it's really spidering out. But the spark was definitely Governor Polis's call for saying, look, we need help right now. Because I think you're seeing with the multinationals and the international trade supply lines, there's a lot of headlines and there's a lot of people butting heads. But at the end of the day, there's doctors who need equipment immediately. And they don't have time for these larger institutions to sort of figure out what they're doing.
How much capacity do you have? I mean, if you look at all the 3D printers you've reached out to that you're working with, how quickly can they turn things around and how significant of an output are we talking about?
Well, it's been happening, growing quickly. We're trying to grow exponentially and trying to grow faster than the virus is spreading. And we're hopefully going to be hitting 10,000 units a week of these face shields that we're making. But we've also got some small and mid-sized manufacturers coming online. There's a cut and sew apparel company in Denver that's looking at switching over to making fabric masks, and they can make 50,000 units a week. There's injection molding companies that are getting involved, and they can make tens of thousands of units in a single day. So we're seeing that we're getting more sophisticated as more people join in.
You're certainly filling a big need, a growing need. Harris Kenny, great to have you on today. Harris Kenny joining us on Make for COVID. We're off for a quick break, but coming up, we're going to be speaking to a familiar face. Andy Serwer sat down with Anthony Scaramucci, the former White House communications director, to talk about the Fed's monetary policy. We'll have that interview for you on the other side of the break. Former White House communications director Anthony Scaramucci is weighing in on the Trump administration's handling of the coronavirus outbreak. And he's also taking a look at where the economy can go from here. Andy Serwer had a chance to speak with him and joins me on that conversation.
Yeah, Akiko, I mean, talking to Anthony Scaramucci is always a wide-ranging conversation, right? Because that's just his nature. But I talked to him in this case a little bit about the income and wealth gap in the United States and how that is connected to the coronavirus pandemic and how that may play out. Take a listen to what he had to say.
This is a big, big seismic global event, and I hope it'll cause people to take a pause, take inventory of what's really important to them, and recognize that it's in our best interest, and again, through market forces, to close the wealth gap and to find ways to fortify people who may be blue-collar workers or lower middle income people, give them opportunity and to make them feel aspirational about their lives, but also their children's lives. I think somebody looking back on this period of time, and let's call this period of time from 2007 to where we are now, and somebody took a snapshot of that 13, 12, 15-year period of time, they would say that the monetary policy, the accident of the monetary policy, which was very healing after the crisis, probably created some of the income divide. And I'm not saying anybody did that intentionally, but when you lowered rates like that, the people that held the assets, they got the inflation. You didn't get much wage growth, you didn't get much wage activity. People did return back to work, but I think that's where the anger is.
In other words, I think what Scaramucci is saying is that the coronavirus pandemic and the economic fallout can exacerbate the wealth and income gap, and that will have to be addressed. And I think that's actually a really good point. Now, whether or not when we address it, Anthony Scaramucci is the next U.S. Senator from the state of New York is another question, because that's definitely something that's potentially in the cards.
Andy, did you ask him about that?
Oh, yeah.
What is he saying about that?
He said, I won't lie that I've thought about it and considered it, and people have talked to me about it. And but right now, I'm in trouble with my wife, is what he said. That old chestnut or something that I can't do it. But I listen. I don't think it's impossible.
Look, Donald Trump's the president, and anything is possible at this point. But I would just say on the point he made about inequality and all that stuff, I think like he's saying we need people to be aspirational. I actually think we have the blueprint in front of us. It should be a $40,000-$50,000 a year job to be delivering groceries, or to work at a grocery store, or to work, and picking packages for Amazon. Like, that's clearly a middle class job. We talk a lot about reindustrializing the economy. That's the reindustrializing. Just these jobs should be much higher paying than they are right now, I think.
Oh, I think that's a good point. And, whether or not that becomes inflationary or not. Actually, it's interesting. Let me take a step back. Right now, with the relief we're getting from Washington, it's akin to UBI. So, we might be sort of experimenting with that inadvertently. So that's interesting. But I agree with you. I mean, I think that if there are not protections of some sort that come out of this, or higher wages either mandated by the government or simply because market forces demand it, I think that would be a shame. And I do think that, ultimately it is going to be something that comes out of the share of wealth that the very richest people in America have. And either they pay it directly or indirectly. And so I think that this could be a time where we see things change. I mean, at some point it's going to have to shift back. Otherwise, the wheels will fall off.
Did he have a specific solution, though? I mean, he talked about inequality. That's just something we've heard a lot of our guests talk about. What specifically does he think the administration needs to do?
Yeah, of course, as a member of the Republican Party, he was a little bit loath, Akiko, to suggest that government programs were the solution to that. But he did, say that ultimately that things were probably going to have to get mandated by the government, either in the form of, taxes or other programs. The earned income credit is another favorite of some of those folks. So those are the kinds of things that he talked about.
Okay, and you can catch the full interview at 5 o'clock today, Eastern Time. Influencers with Andy Serwer, brought to you by Verizon. Thanks for that, Andy. All right, we're off for a quick break, but coming up, we're going to be talking about the World Bank and the IMF flooded with aid requests from developing countries. Is there enough aid there to go around? We're going to be discussing that on the other side of the break. All right, there we go. Unmute myself. Okay, another quick check of the markets as we round out a shortened week. All three indices in the green, and Jared Blickery joining me here. Jared, S&P 500 having its best week since 1974, which is pretty incredible when you consider some of the data that we got out today.
Yeah, well, I mean, the data is going to be bad for a while. The Fed is in the market. Another $2.3 trillion today. I think that's behind a lot of the price action this week. We can see over the last 4 days in this holiday shortened week, up 12%. Now, the caveat is we have the best days and best weeks during bear markets, but the S&P 500 did manage to rally on a close-to-close basis 20% or more this week. And so according to some people, that is a bull market. I don't believe it yet. But let's take a look at the VIX. VIX has been trending down. We see almost cracking 40 here. That would be a development that a lot of people would like to see to support the bullish equities case. And then the 10-year T-note yield, it's down 4 basis points today, but by my math, it's up about 15 basis points or so for the week. Importantly, break-evens have increased substantially. And now here's the US dollar index. It's trending lower. That's what we want to see. No funding pressure. The Fed has really been in the dollar swaps market with other central banks as well. And here's crude oil. Wow, what a volatile week for crude oil with the high and the low being made today on that OPEC plus disappointment, only going to cut 8.5 million barrels so far. More on that next week. And then gold just hit a 7-year high today, above 1,700, almost at 1,750, I believe. That would be that high there. I haven't seen these prices since late 2012. And then here's our Dow heat map, and we're going to go to a 4-day look and sort by performance, and we can see some of the big winners here. Dow Inc. up 30.7% in the upper left, followed by Raytheon, now merged with United Technologies. And then we got some financial names, Goldman Sachs and American Express and JP Morgan filling out 2, 3, 4, and 5 here. And then Boeing. I say this a lot, and we say it a lot, but a lot of these markets or a lot of these market leaders right now are the most downtrodden names. Finally, here are the sectors that are leading this week. Real estate up 21%, materials, financials, utilities, discretionary, energy, industrials, all outperforming. And so that is kind of justifying what the yield curve is expanding here. And I guess I'm going to send it back to you. We got 3 days here, and we'll see what happens next week, Akiko.
Yeah, the market closed tomorrow. And of course, investors certainly could use a breather given some of the volatility we've seen. Thanks for that, Jared. Well, as the world, as major economies around the world push through record stimulus to stem some of the declines, economic declines, we should point out, stemming from the coronavirus, we've seen a lot of the developing countries turn to the IMF and the World Bank for aid. And I want to read you some of these numbers. The Wall Street Journal reporting that more than 90 countries have reached out to the IMF about bailouts, while at least 60 have applied for World Bank programs. And you look at the outflows here since January, $96 billion flowing out of EMs. That is triple what we saw during the financial crisis. Miles, I want to bring you in for this conversation because, we've been talking a lot, of course, focused a lot on naturally what's happening here in the U.S. with the outbreak and the economic impact, as well as some of the Western countries, places like China as well. But we keep hearing that it's the developing countries that are going to get hit the hardest, not just with the outbreak, because they don't have all of the medical supplies and the infrastructure in place. But this really points to the fallout that we could see beyond the 2-3 months that we're talking about here in the U.S.
Well, it makes me think about the conversation we had with Anjali earlier in the program about how, communities of color in the U.S. and lower income communities are bearing the brunt of the coronavirus on the health side. And I think when you look at the economic damage, the less privileged countries around the globe are likely to bear more of the economic responsibility. And, we talked about this morning. We bring out the Fed with these big numbers and, the BOE monetizing the debt today and the ECB saying they're going to announce a big package. Well, when you are, the UK economy, when you are the Euro area, when you're the United States, you have the fiscal space to do, quote unquote, whatever it takes. When you're Burkina Faso, you can't print money that is then taken seriously and not create hyperinflation, right? I mean, when Zimbabwe has hyperinflation was at 5-6 years ago, and tens of billions of Zimbabwe notes are worth $1. I mean, that's what happens for most countries in the world who are not sovereign issuers. And so the Fed has a lot of capacity, unlimited capacity, really. And I think that is something that we're using here in the U.S. to soften the blow of the crisis. But the IMF program is about helping countries that rely on U.S. dollars, a finite supply of U.S. dollars, to make their finances work, and they have to balance their budget. They have to enter austerity programs, and I think that that's the 2021, 2022 story that we're only starting to see the outlines of right now.
Akiko, aren't you impressed by Miles's knowledge of the Zimbabwean economy? I know I am. I thought that was pretty good. Hey, listen, you guys.
One story at Business Insider about the hyperinflation in Zimbabwe in 2015.
Nicely done. So, Akiko, you said 90 countries, and actually, it sort of almost struck me as low. I mean, there's 195 countries. It gets a little fuzzy at the ends, but they're basically 190 or so countries out there. And so, certainly, I think we'd agree that that number is likely to go up. And it sort of reminds me of the whole wave effect of the coronavirus. And, at first you're like, well, these countries have applied for aid, and it goes from 5 to 10. And then the list, instead of becoming the countries that have applied for aid, would be the countries that won't. In the same sense, it's like, these are the states that have coronavirus infections. And then you change the list to, these are the states that didn't. Remember, West Virginia was the last state. And then, the same sort of thing with colleges. These are the colleges that are closing. And then, then there's one college left open, Liberty. So it'll be interesting to see if there are any countries that, are unscathed. Now, some of the developed countries won't ask for this type of aid, of course, but that number will definitely get smaller and smaller. And it's just interesting, this wave effect, I think, that we see here that touches almost everything with regard to coronavirus.
Yeah, and Andy, to your point, it does make you wonder if some of these countries get left behind. We're obviously focused on, what happens when that curve is flattened or starts to flatten, as you could argue in some states. We've already seen here in the US, and you look at countries like Italy and places like Spain, where we're starting to see a bit of a slowdown, if you can call it that. But, well beyond that, there are still going to be other countries that are going to have to deal with this virus. But as the developed nations move on, are those countries going to get left behind? And I guess it points to sort of the larger conversation we were having earlier, Miles, which is about the inequities that exist and that kind of being exposed even more so on the back of this. You do have to wonder, there's been debates about the World Bank program as well, right? I mean, how effective have they been? And is this kind of a time for them to step up?
Yeah, I think it raises a very, very hard problem to solve, because the austerity measures, that the World Bank program and the IMF program are, programmed to put on nations, right? That you have to cut spending, you have to have more fiscal discipline in order to get access to these funds. They've been shown to be a disaster. These things don't make economies stronger. They don't help populations. Fiscal discipline at the national level, regardless of the size of the nation, isn't a way to unlock success for anybody's citizens. It's just, the arbitrary way that the IMF goes about instilling discipline on its borrowers. But a sovereign is a different kind of borrower. And so I think it's a very interesting problem for the next, 10 or 20 years. What do future generations of World Bank and IMF leaders think about how the world's most prosperous nations should go about supporting the world's poorer nations? Because the way we've gone about it kind of in this, post Bretton Woods era, right, since the 70s or 80s, has not had very good results. You've got Paul Singer seizing warships. What is that about, right? That's an outgrowth of how the IMF runs its programs. And I just don't think that there's going to be a lot of tolerance for that internationally as well as nationally, I think, going forward, because it's just, to me, it's just laid bare the failures of so many of these, kind of neoliberal programs, if you will. And I just don't think that it's a sustainable path for the lenders or for the borrowers.
Yeah, you certainly hope that this is kind of that moment where they can maybe pivot to something or step up in some way. All right, we're gonna head off for a quick break again, but coming up, we're gonna be talking to celebrity shout out service Cameo about what they are doing to help in this time of the coronavirus and how they're raising some funds as well. We'll talk to the CEO on the other side. Welcome back to Yahoo Finance Live. We've seen a lot of celebrities, of course, over the last several weeks step up to the plate here to donate funds to help, whether it's hospitals or those who have lost their jobs in this time of a public health crisis. And our next guest is pitching in their own way. Cameo CEO Stephen Galanis is joining me. And we're here to talk about something called Cameo Care. So walk me through what exactly your organization is doing, working with some of these influencers to raise funds at this time.
Sure. So, over the last few weeks, as every single athlete, actor, celebrity suddenly finds themselves on the couch just like us, all their concerts are canceled, their meet and greets postponed, their games canceled. They've been reaching out to us to ask, hey, how can I engage with my fans and help cheer people up during this time? So from April 16th through April 18th, we're creating something called Cameo Cares, where 100% of all the bookings on the site during those 3 days are going to go to COVID relief charities. And our goal is to raise $1 million for a charity those 3 days.
So for those who aren't familiar with the actual service, what Cameo does, when you say the bookings, you're actually connecting some of the fans with these athletes and the actors, actresses, right?
Correct. So you can go to our website, cameo.com, browse from between 30,000 different athletes, actors, influencers, celebrities, and get them to send you a personalized video shout out. And yes, Flava Flav is on there.
Yeah, let's talk about Flavor Flav a little bit. And how do you connect with someone like that? I mean, how do you recruit people, or do people sometimes come to you and you reject them? There's like, hey, you're not a celebrity. How does that whole dynamic work?
That's our secret sauce. If I told you, I'd have to kill you guys. No, just as a joke, we have 50% of all of the talent that we get on the platform. We recruit. 25% come inbound, and then 25% actually get referred from other celebrities that are having a good time on there. So, for example, this time last year, we saw that Snoop Dogg kept popping up in Ice-T's videos, and Ice-T ended up referring Snoop Dogg to the platform, and that's been one of our best channels to get to talent.
And Stephen, I guess we've now communicating this way is normalized, right? I mean, like the Today Show is now distributed on Zoom and whatnot. Is that a tailwind for your platform, that it's not weird for people to get a cell phone video from someone? I mean, yeah, Instagram is all cell phone videos, but there's the pretense of being on air, as it were, I think has been dropped in some way. And everyone realizes this form of communication is pretty much just as good as any other, and people are going to be more comfortable doing their meet and greets and stuff like that via whether it's Cameo or just other services like this.
Totally. And, I remember 2 years ago when we were just getting started and I came and saw you guys in the very early days of this platform. It was a revolutionary thing. Today we have over 30,000 different people on it. And, for the last few years, we've always pitched talent as Cameo is a Comic-Con at the palm of your hands. In a world where there's social distancing, we're seeing a lot of talent that had told us no for the last 3 years because they were too busy, suddenly come inbound. Last month, our new talent acquisition was up 78%, and our bookings have been up over 200% over the last 3 weeks.
Hey, Stephen, just looking at some of these people, it's just crazy. Who are some of your favorite wackadoodles, celebrities on here, and do you have some crazy stories? You got to have some stuff has happened.
Oh yeah, we've done 75. We've done 750,000 of these since we started now. So there's been a bunch of crazy stories that have happened. Right now, the Tiger King cast are the ones that are absolutely killing it. So basically, it's other than Carol Baskins and Joe Exotic, you can book pretty much anyone from Tiger King, and some of their cameos are crazy. Actually, just this week, one of the players on the Los Angeles Dodgers got a cameo from one of the Tiger King casts, who actually revealed that a 7th episode is coming out, or an 8th episode is coming out of the Tiger King, and suddenly we were on the cover of TMZ and every celebrity gossip page. Variety, that's where the news was broke. So, this week that was the crazy one.
And Andy, I'll just add, I know someone, I don't know if the name Jax Taylor does anything for you, but it does for people my age, got him to do a cameo as a wedding gift for someone else. So that's how I've seen it used in the wild.
Oh, wow. Okay. I want to see Rod Blagojevich, that guy. I mean, God,
I don't know, Andy. I don't know.
If you have a birthday coming up.
I think we ended at Tiger King, right?
Yeah.
Is that kind of our? Is that where we set the bar
I
here?
don't know. There's a lot. There's a lot, Akiko. Puggy Small. I mean, it's pretty wild in here. I could get lost for a very long time, Stephen, up in that cabin.
Okay, Stephen, we're going to check in with you. Maybe you have additional requests coming out of this.
Drag queen.
We'll check in with you. Stephen Galanis there joining us from Cameo. Appreciate your time.
Thanks, guys.
All right, our last break of the week. We have a shortened week, but we're going to take a look at how the market settled yet again and see what our panelists are looking to next week. We'll be right back. All right, we are wrapping up a shortened trading week. Tomorrow, of course, is a holiday, at least on a positive note, after what we saw last week. But Jared, let's go around the table here, virtually, so to speak. Jared, what are you taking a look at? You mentioned the Fed's balance sheet.
Yeah, we just got the latest figures out at 4:30, and here is the Fed's balance sheet going back about 12 years, and it has just gone out of sight recently. It's now topping $6 trillion for the first time ever. Since March, it is up $2 trillion, so basically outpacing any QE 1, 2, 3 or twist operation in history, at least in the U.S. Akiko.
$6 trillion. Andy, what do you have on your radar going into next week?
Well, I was just thinking, Akiko, looking at Jared's spike chart, what does that remind you of? It looks just like the employment claims spike chart, doesn't it? So that gets back to what I was saying at the top of the hour, which is to say, it's the Fed versus the economic wipeout that we're seeing here. And boy, we better hope it works. I think that's going to be the story, going forward. Yes, we're going to have earnings season coming our way pretty soon. And I think we're going to be talking about flattening curves, and the weather's going to get warmer, and there's going to be more talk of recovery and getting back to work. And when can we do that and all that? I don't think that's going to be for a while. But the big thing is really a fight between Washington, D.C., fiscal and monetary policy, and the virus and the fallout.
Miles, a fight between the fiscal monetary side. I mean, we've seen this play out before. It looks like, at least based on what we saw out of Washington today, there could be more butting heads on that additional phase of the stimulus we've been hearing about.
Yeah, I think there's definitely a sense, they got that first package out the door so everyone can take a victory lap, and now we can get back to the business of politicking. But, it's interesting. Andy kind of looks at earnings season and says, well, I'm looking past that. I'm excited for earnings season. That starts next week. We're going to get the big banks. And I think what's going to be interesting about this earnings season is that we're going to hear so much commentary about things we know, right? Everything's a disaster and companies withdrawing guidance. And at a certain point, maybe we'll grow tired of that. But I think in every earnings call, there's going to be some nugget that really illuminates for industry X how acute the pressures have been as a result of coronavirus. And I think that also speaks to what we talked about earlier, which is the coming weeks, and maybe next week is the week where we transition away from the market looking only at the coronavirus curve, and the market starts to look at what is happening in corporate America, what is happening in the economy, because I think there will be some confidence on the virus front this time next week, quite a bit of confidence perhaps if New York trends and others kind of hold in. But then we're getting back to the reality of, oh, so you mean that revenue was down 80% in 1 month, and we're going to see some really shocking numbers. So excited is the wrong word, but I'm interested to see earnings start to really come in earnest, and that begins next week.
Well, and that's when investors can actually take a nugget away, right? I mean, so much of what we've known, at least factually, is just based on the cases of the virus. So we'll certainly get a little more clarity, at least on that front next week. All right, that's going to do it for Yahoo Finance Live. But I want to tell you about a programming note here. We've got Grammy Award-winning artist Alicia Keys on Verizon's Pay It Forward Live series. That's coming up tonight at 8 p.m. Eastern on yahoo.com and Verizon's Twitter page. You certainly don't want to miss that. We've heard our producer Pras singing that Alicia Keys song in our ear. I don't think he's going to come on, but that wraps it up for a shortened week. Hope you all have a lovely 3-day weekend. We